हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का सेशन। फिलहाल के लिए देखोगे मार्केट को, कमोडिटी मार्केट ओपन कल एक सेलिंग का ट्रेड बनाया था क्रूड ऑयल में। टारगेट रह गया था थोड़ा सा, नाउ ऑलमोस्ट इज गोइंग टू अचीव, थोड़ा सा रह गया है। तो अभी यहाँ पर वापस बाय मत करना, मैंने बताया था। नीचे आता है ये फाइनल टारगेट रहेगा। इस एरिया के आसपास देखेंगे, फिर से वापस बाइंग प्लान होती है नहीं होती, हो सकता है यहाँ से पुल बैक आए, बट नॉट इंटरेस्टेड ओवर हेयर। इस चीज़ का ध्यान रखना। बाकी नेचुरल गैस में भी कल एक सेलिंग का ट्रेड था, टारगेट रह गया था थोड़ा सा। ये भी आने वाला है, यहाँ पर एक सपोर्ट जोन है, यहाँ से एक बाइंग का प्लान है इसमें। वी कैन एक्सपेक्ट बाइंग फ्रॉम हेयर इन इन नेचुरल गैस, ठीक है। फिलहाल के लिए ये है। बाकी 12:30 इंडियन मार्केट के बाद लंदन सेशन ओपन होगा। इवनिंग पे 5:30 न्यूयॉर्क सेशन, 7 बजे यूएस मार्केट ओपन। उसके अलावा कोई और डेटा आज नहीं है, देर इज नो डेटा शेड्यूल फॉर टुडे, सो रिमेंबर दिस। फिलहाल कल की लेवल है, तो मेनली मुझे लग रहा है अभी नेचुरल गैस का ही ट्रेड बनेगा नया। सेलिंग वाले निकल जाना, सेलिंग वाले फुल प्रॉफिट बुक करके निकल सकते हैं नेचुरल गैस में स्पेसिफिकली। क्रूड ऑयल में थोड़ा सा टारगेट है, वेट करेंगे, यहाँ पर बाई मत करना फिर से, ठीक है। कल का जो बाइंग एरिया था, यहाँ पर वापस अब बाइंग नहीं होगी। इंडियन मार्केट की बात करें, इंडियन मार्केट ऑल्सो ओपन राइट नाउ। इफ यू लुक एट द इंडियन मार्केट करेंटली ओपन एट हल्का सा गैप अप कह सकते हो। निफ्टी फ्यूचर और बैंक निफ्टी फ्यूचर में ओपन इक्वल टू लो बना है कैंडल, पहली कैंडल, एंड मार्केट इज रिकवरिंग। कल क्लोजिंग होते हुए थोड़ी सी बाइंग जरूर आई थी, ओवरऑल तो नेगेटिव ही था। अभी फिलहाल के लिए ओपन इक्वल टू लो विद कैप अप, 1% पॉजिटिव है। बैंक निफ्टी भी लगभग 1% पॉजिटिव है। ओपन होते ही सडनली बाइंग आई है दोनों ही जगह। देखते हैं रिकवर करता है नहीं करता, कल के हाई के ऊपर निकलता हुआ बैंक निफ्टी राइट नाउ। बिटकॉइन 70,000 पे स्टक हो गया, कल 70,000 के नीचे आ गया था एक टाइम के लिए, तो 69,000 के आसपास, बट स्टिल होल्डिंग। गोल्ड सिल्वर रिकवर किए हैं। कल मैंने आप लोगों को एक चीज़ बोली थी, गोल्ड फॉरेक्स में 4 आवर टाइम फ्रेम की जो कैंडल थी, एक के नीचे क्लोज नहीं करेगी, वो नहीं करी। ठीक है, याद होगा आप लोगों को, कल हमें बात करा था 2:30 से 6:30, 6:30 से जो 10:30 के बीच की कैंडल होगी, वो क्लोज नहीं करेगी, नीचे नहीं करी, रिकवर करी, और वहीं से मार्केट रिवर्स किया। अभी भी एक्सपेक्टेड है थोड़ा और गिरेगा आने वाले टाइम में, देखते हैं। करंटली ट्रेडिंग एट 4,700। एमसीएक्स में हल्का सा गैप अप, सिल्वर 3% अप है, गैप अप है। फॉरेक्स में 2% अप, करंटली ट्रेडिंग एट 74। कल वापस 65 के आसपास का लो बनाया था फॉरेक्स में, नाउ इट इज रिकवरिंग। लेट्स सी वापस रिजेक्शन लेता है ये तो, अगर ठीक है। नेचुरल गैस में यहाँ से थोड़ा सा एक बाइंग का प्लान रहेगा, कैंडल का ध्यान रखना, ओपन इक्वल टू हाई अननेसेसरी ना बने। और कोई मेजर न्यूज़ तो नहीं है जिसका कोई डायरेक्टली इम्पैक्ट मार्केट पे देखने के लिए मिले अभी फिलहाल के लिए। लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम। ठीक है, और कोई न्यूज़ वगैरह आती है तो विल सी दैट। देखते हैं, बाकी क्रूड ऑयल थोड़ा सा नीचे और आना चाहिए यहाँ से, ठीक है। लगभग 300 पॉइंट और एक्सपेक्टेड है फॉल होना चाहिए, होता है तो बढ़िया रहेगा। कोई डेटा तो नहीं है, लेट्स सी कुछ और न्यूज आती है तो। हाउस जीओपी वेलकम्स 200 बिलियन पेंटागन रिक्वेस्ट, 200 बिलियन डॉलर पेंटागन रिक्वेस्ट टू जंप स्टार्ट रिकॉन्सिलेशन 2.0। House Republican balance at the Pentagon reported 200 billion price tag for Iran, but many are embracing the eye-popping number to help energize the stall reconciliation process. Wow. GOP leaders has struggled to build consensus around a reconciliation 2.0 package. लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम। इंडियन मार्केट तो कम्प्लीटली बुलिश फर्स्ट कैंडल पे आज, कैप अप के बाद फॉरेक्स फ्यूचर में। According to the Syrian Observatory for Human Rights, 300 prisoner swap took place between the transitional government and the Syrian Democratic Forces. US is accelerating the deployment of thousands more Marines and sailors to the Middle East. कैंडल देखोगे ओपन इक्वल टू हाई बनी है क्रूड ऑयल में, टारगेट तक पहुंचता है तो लेवल से अभी भी लगभग 300 पॉइंट एक्सपेक्टेड है सेल ऑफ इन क्रूड। तब बीच में कहीं रुके बट बीच में एंट्री मत करना बाइंग में, प्राइस को गिरने देना थोड़ा सा और। बाइंग अच्छी आई थी, मार्केट काफी देर साइडवेज रहा था लेवल पे, याद होगा आप लोगों को। हुआ ऊपर से रिजेक्शन लिया कल थर्ड टाइम के बाद ब्रेक करेगा, काफी देर साइडवेज हुआ, सपोर्ट पे आया, बाइंग दिखाई, फिर साइडवेज हो गया, फिर रेजिस्टेंस को हिट किया, फिर काफी स्ट्रॉन्ग रिजेक्शन लिया, पुल बैक और फिर सेल ऑफ वापस। प्राइस एक्शन बना है, मैंने आपको पहले ही बता। ऐसा प्राइस एक्शन बना था यहाँ पर ये कल, जब लास्ट टाइम प्राइस यहाँ पर आया था। लुक्स लाइक ये ब्रेकआउट की तैयारी हो रही थी, नहीं कर पाए ब्रेकआउट, यहाँ से रिजेक्शन मिला है, तो चांसेस कल है, मैंने बताया था ये सारे एसएल जाएंगे एक साथ। ठीक है, तो ये निकल रहे हैं सारे एसएल, ये निकल रहा है पहला एसएल, इसके नीचे दो एसएल और हैं। प्राइस शुड इवेंचुअली रीच 8400 450। कि नेचुरल गैस को भी चेकआउट करोगे। इनका ट्रेड है यहाँ से वापस प्लान देखते हैं, ये मुझे रेंज बाउंड ही लग रहा है आज भी, 285 से लेकर 305 के बीच में। ठीक है, 285 के नीचे कहीं अगर सस्टेन किया तब बात अलग है, तब फिर हम एक्सपेक्ट कर सकते हैं प्राइस विल फॉल टुवर्ड्स 270 की ओर चले जाएंगे, अगर ये इस एक्सपेक्टेड सपोर्ट जोन को होल्ड नहीं करता। इम्पोर्टेंट रहेगा ये जोन आपका, यहाँ होल्ड नहीं किया तो फिर नेक्स्ट सपोर्ट आपका 265 से 270 के बीच में रहेगा। वो भी लेवल काफ़ी बार टेस्ट हो गया, देखते हैं होल्ड करेगा नहीं करेगा इस बार। जब तक ब्रेक नहीं करता तब तक तो नॉर्मल ही है। नेचुरल गैस थोड़ा बेरिश ही लग रहा है, पता नहीं क्यों। समझ नहीं आती है, तो मुझे लग रहा है प्राइस नेचुरल गैस का थोड़ा बेरिश ही रहेगा। क्रूड ऑयल में आई एम स्टिल एक्सपेक्टिंग ये रेंज जब तक है नीचे 8400 450 इट इज एट गुड सपोर्ट। इसके नीचे सस्टेन किया तब फिर थोड़ा बेरिस हो सकता है ये भी, अदरवाइज until unless this level is hold. ओवरऑल देखोगे क्रूड ऑयल कोई बहुत ज़्यादा ना बेरिश है, ना बुलिश है। फ्रॉम लास्ट 12th ऑफ मार्च लगभग पिछले 8 दिनों से एक रेंज के अंदर फंसा हुआ है। मोमेंटम आया था अपसाइड ऑल टाइम हाई, वहाँ से वापस 7300 गया, रिकवर किया। रिकवरी के बाद एक रेंज बना दी है इसने ऑलमोस्ट 900 पॉइंट की, 10% की रेंज के अंदर ही चल रहा है अभी। ना अप साइड पे निकल रहा है ना डाउन साइड पे। लिक्विडिटी ले चुका है अप साइड से, देखना पड़ेगा डाउन साइड से लिक्विडिटी लेता है। ठीक है, पहला एसएल तो इनका निकाल दिया, इसलिए जिस तरह का पैटर्न बनाया है, कल का जो बॉटम बना था 8800 वाला, इसके बाद दूसरा लेवल समथिंग 8550 रहेगा, एंड देन फाइनली द सपोर्ट जोन। Iran permits additional Indian ship, Iran to allow additional Iran to allow additional Indian ship। ये तो इंडियन शिप फिर से आ रही है स्ट्रेट ऑफ हॉर्मोज से, ईरान ने अलाउ किया है, विच इज अ गुड साइन। लास्ट ट्रेडिंग सेशन है, ज़्यादा रिस्क भी मत लेना। कल परसों मार्केट वैसे भी क्लोज रहेगा, नेक्स्ट वीक भी काफ़ी छुट्टियां हैं। नेचुरल गैस में फिलहाल के लिए यहाँ से एक बाइंग रहेगी। अभी और कोई ट्रेड तो मुझे लग नहीं रहा है बनेगा। क्रूड ऑयल में थोड़ा सा और स्पेस है नीचे आने का, वहां तक आने का वेट करेंगे। नेचुरल गैस इज ऑन द फ्रंट।
And that's up for debate.
Ruth, thank you so much for that. Fascinating. Our chief correspondent for FX and rates in Asia, Ruth Carson there, still to come. As Indian equities regain some ground after their worst single-day fall in nearly 2 years, we'll get market insights exclusively with billionaire investor Ramdeo Agrawal. You don't want to miss this. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersetchi in Davos, Switzerland, and this is Bloomberg.
Welcome back. You're watching Insight. We're keeping an eye on Indian stocks, which are rebounding after Thursday's heavy sell-off. The Nifty slumped over 3% yesterday, closing at its lowest in nearly a year. For more, let's bring in Bloomberg's Manika Doshi in Mumbai. Manika, it's hard for Indian stocks at this point in time, just trying to find that floor.
Well, absolutely. This was, several months ago, an overvalued market, and now we're seeing the full wrath of several collective issues play out on this market. As you pointed out, we've had in the past the AI impact, and now more recently, war, higher energy prices, all of that weighing on Indian stocks. Now, I think there are a couple of points to make here. Some of the most valuable sectors in this market, even sectors that foreign financial institutions are most heavily invested in, have all each had their distinct problems. So like I said, IT has been bearing the brunt of AI for the last several months. Consumption, where the recovery was moderate, now is being impacted by fears of an inflation pass-through because of higher energy prices and what that means for overall consumer confidence in the country. And then finally, you've got banks or financial institutions, again, a sector that draws a vast number of foreign financial institutional investors. And just as of yesterday, we had a new governance crisis of sorts with what went down with HDFC Bank. So distinct challenges on all of this. We're about 10% lower on the year, which is a good place to maybe start considering buying stocks, except no one knows how long this war will go on for and how much further prices will fall.
Exactly. Manika, stick around. Joining us exclusively now is market veteran and billionaire investor Ramdeo Agrawal. He's chairman and co-founder of Motilal Oswal Financial Services, one of India's biggest brokerages. Good to have you with us. You've been one of the biggest bulls in India, but here we are, the market experiencing one of its worst times in about 3 decades. How can you remain upbeat about the Indian market?
Yeah. Hi, good morning. Actually, when you talk about 3 decades, I think this is the 4th time market is in a major correction, or you can say even mini crash kind of situation. We saw it in first big one was 60% correction in 92, then 50% correction in 2000, another 50-60% correction in 2008, and recently in COVID we had 30-35% correction. So I would say this is not as severe as GFC 2008 and all. But more recently, what we saw in COVID, it is that kind of a correction. It's geopolitical. I mean, nobody knows what is going to be the length and extent of this global damage. But I think the markets have responded, and at least Indian market, which has become a little more expensive in recent past, has become kind of a little more fairly valued, I would say, at current prices of about 23,000 around Nifty. We are at reasonably priced. Year on year, we are still flat. 12 months basis, we have not gone any lower. So I would think that, yes, there could be some more correction, but we have now clearly reached a investable point. I would say market is very fairly valued right now.
Ramdeo, what would you be buying? What's looking attractive then?
Now values are all over. I mean, it depends on what's your view on India and what you would like to be. Banks are very prominent here. They're largest profit contributor to the Nifty, and they are in last 40 years they were never in this kind of shape, and they are growing at about 14-15% at an aggregate level. But there are banks which are growing at 25-30%, and they are available at less than 1 time growth. So the peg is less than 1. Balance sheet is clean. Net NPA cycle is also kind of at their best. So I would think that you should start with the bank, and then your whole lot of automotive is the one which is seeing massive resurgence. So there are sector after sector, and the main point is that now the broad market is kind of reasonably priced. Growth is all over there because we are growing at about 7.5-8%. So the corporate earnings growth are going to be about anywhere between 10 to 12% for the next 12 months. So yes, we have challenging spot in tech, which was one of the darling of the market. So that's the one thing which I have no idea whether AI looks to be in the short run a headwind, but in the long run, I think they are the guys who are going to deliver AI solutions to all the corporates all over the world. So I would think that they have long-term future. Short-term, there are some challenges.
So you're saying that the Indian subway companies, that sell-off is overdone?
Not overdone, I would say, but it is done in the sense that one round of if you see long-term averages, if we are available at 20p, our earnings are still looking good despite this war. I mean, yes, it has done some damage, But I still don't think that earnings will be, it will get some hit. But say if it was growing at 12%, it might come to 7-8%. That's the situation right now. But if things really go to $150 or something like that, I don't think market needs to correct even more.
A lot of these software companies have operations overseas, and they will be impacted by the currency. The Indian rupee today marking yet another record low, breaching 93. It is at 93 for the first time ever. How do you think, the weakness in the currency will factor into the outlook for these companies?
Yes. So this currency thing is a double-edged sword. For the exporters, it is a kind of a boon. And for importers, it's a big challenge. So we have very large importers and all kinds of supply chain is into the global markets. And hence, even domestic consumption has an impact of currency devaluation. So I think it will be inflationary. And to that extent, even corporate profits will be challenged in the short run. But one is hoping that this entire, this geopolitical crisis is somewhat more temporary in character. Maybe it may last for 3-4 months. That's the belief in the market. But if actually goes and stays at $125+, I think we have to rethink entire corporate profits, how the inflation goes, how the corporate profits build up, who are the winners, who are the losers. That's a different calculation altogether.
Ramdev, hi, this is Menaka in the Mumbai office. Since we're talking sectors, I wanted to get your view on banking. I know you just expressed a fairly positive view on banking, but what's your take on what went down with HDFC Bank yesterday and that sudden exit of its chairman?
Yeah, it's as surprising. This is supposed to be the best governed bank, actually. And they're the people who set the standards in the market. Banking valuation starts from HDFC Bank. So clearly, particularly for private sector, they were the kind of a torchbearer. And now this chairman resigning, and there is no explicit, even with the con call and all, we were trying to figure out what actually happened. So I don't think in public, the knowledge is that much. It's very unfortunate what happened. So the bank has been passing through some kind of a challenge after the merger of HDFC and HDFC Bank. And transition, I think the bigger problem is the leadership transition from Aditya Puri and his team to the new set of people, and that too at the time when the merger and all these complications there. So I think this is a phase in which the brilliant institution available today, large unpopular company, I would say, and I would think that the way Indian economy is likely to grow at 7-8%, I think there will be fair share for HDFC Bank to perform. Particularly, if there is no managerial problem in the sense that there is no problem with the governance, there is no problem with the balance sheet, P&L, NPA. Those are typical things in a lender's book you would like to you suspect in this kind of situation. But I'm hoping that this credibility of the top management is restored very quickly. But you can get these banks at 15-16 multiples. I talk about last 12 months at this point of time. So I would think that I would be batting for HDFC Bank rather than going against.
All right. I think the other two sectors I wanted to talk to you about were consumption and infrastructure. There is concern now that there was already a very moderate recovery, and through energy prices, inflation might pose a new headwind for consumption. Again, a set of stocks reasonably overvalued or expensive, some might say. How do you view that?
Yeah, the consumption pickup. See, whatever consumption was interest sensitive, like things like automotive, it came back like the very moment, like in September, they gave the GST cut from 28 to 18, which is, I would think, India is one of the biggest tax reform or tax giveaway in my knowledge. So it was across the board, and the impact of that is very clearly visible in the pickup in the consumption. Automotives are growing almost at 25% in volume terms. So you look at the insurance, where they have cut the GST from 18 to 0%. There, the growth is more like 35-40%. So I think there are a lot of resurgence in this thing, and this is still a market which is growing at about 9-10%, 11% in terms of nominal, 7-8% real. and there are sectors which are growing at least 1.5, 2 times of the GDP growth rate. So there is a lot of opportunity for corporates to invest, and well-managed corporates will be able to grow at about their earnings at about 15%. So as the index has corrected to 20%, 20 times multiple, I would think that these are times when the value seekers, those who have the value style of investing, for them it's a terrific time to start building the portfolio and have some patience for the bottoms to be formed.
Ramdev, on consumption, do you feel like the GST gains that might have accrued to the sector will now get neutralized by whatever energy pass-through we may see over the next few months in terms of inflation, making it tougher for any kind of uptick in sales to sort of sustain over a period of time?
Clearly, Menka, I mean, the supply chain cost increase. I mean, everywhere that packaging, the transport, the logistic cost, everything goes up, and it starts building up N-1, N-2, N-3, and finally it comes to the consumer. So clearly, government is trying to take as much blow as possible by not transferring it in the fuel prices and things like that. But industrial side, I don't think government can do anything. It will be mark to market. And if the war gets prolonged, then clearly it will take away the lot of benefits of tax concession which has been given in September. So yes, you're right on that count.
I also want to ask about your continuing interest in infrastructure. It has been a vibrant sector over the last few years. But again here, commodity inflation passing through to companies like cement or sectors like cement, and also an element of maybe overvaluation playing out there. Are you still significantly bullish on infrastructure?
Yeah, long term, the gap between India and the rest of the world is the infrastructure. So infrastructure spend will be as big as what government can afford with the tax collections. So I think as a tax collection is going to be more like 12 to 14% compounded on local currency terms, I think we'll keep seeing more than fair share of money going to the infrastructure. So you have to be bullish on infrastructure for many decades to come. Forget about next year or something like that. But the short-term challenge of the inflationary pressure coming because of this geopolitical situation, that's what allows you to buy the stocks at low prices. I mean, at more lower prices, like say L&T or some other stock, they're down 20-30%. I think they have more than more than taken care of the current challenge on the external front. But I mean, I'm saying that it has probably priced for $110, $115 of oil. But if it were to go to 125, 130, I think we don't know. I mean, how much more it will damage to the earnings.
Ramdeo, you talk about infrastructure. India increasingly wants to be an AI hub. How do you play that AI ambition in India through infrastructure plays?
Yeah, so I think in India we don't have direct play on technology. We are more user and user of the AI and for individual, for the corporates and for the clients. So I think there is no direct play on AI in India as far as I know. There are small companies and most of them are unlisted space. But what I see is that a lot of finance banks, they are saying that their credit costs, I mean the way they, one of the companies where we have invested is a digital lending company. So they are able to use, first thing is the cost of the technology is coming down. Second, they're becoming far more smarter in lending. So the credit cost, which was say 3%, that would come down to 2% with the help of AI. So the AI is being used here in India as a much more smartly than actually providing AI as a technology to the world. So that's a fundamental gap. So we will be slow to use. I mean, actually we will be fast to adopt, but it will be visible in the cost and the earnings as we go forward.
Ramdeo, you're renowned for identifying 100 beggars. I'm just wondering, could you share with us which companies actually have the DNA?
Yeah, so that's what I'm saying, that if you see the next 15, 20 years, at least, I mean, for compounding, you need, for a big compounders, you need few decades, not years. So if you see two decades or 2.5 decades of India, we are going to go from, say, $4 trillion of GDP now to more like 16, 17, $20 trillion by 2042 or 45. And in that phase, it's one of the most compounded economies. That's what I think one has to understand when one compares one with Korea or Hang Seng or many other regional markets, emerging markets. This is one very smooth 7-8% growing economy, and you can compound it into next 20, 30 years because per capita GDP is still less than $3,000. So even to catch up with the global average of 10, 12,000, 14,000, I think that will require more like 25 years of 7-8% of growth. So, and what is required to grow at 7%, that's all in place, and we have demonstrated that we grow it like that. So like banks, I mean, you cannot grow any economy without having a growth rate of plus 3-4% to the nominal GDP. If nominal GDP is growing at about 11%, you are talking about 13 to 14, 15% compounded growth in the credit, and hence you'll get a lot of lenders, small, mid, large, and in EIB era, even large lenders, they can grow at about 15-17%, and the stocks can grow at about 20-22%. But if you buy a mid-sized successful lender, I think it can grow at 25-30%. So that's the kind of opportunity. If you can do stocks you can grow your stock at 25% for 20 years, you're talking about 100 bagger. So that's the kind of possibilities there. We don't have to break our head to find some completely unknown, unearning kind of a situation. There are simple things available in the marketplace.
Sure. Ramdev, I have a quick final question to continue with Haslindar's theme on style of investing. You're a value investor. Are prices looking attractive enough for you right now to jump in, both hands, both feet, maybe even with some leverage? Or are you expecting that there could be more downside to these prices? The median constituent data from Bloomberg Intelligence finds is at about 35% cut, which is lower than previous falls. So I'm just curious, are you waiting for prices to fall further before you're all in, or is this a good time?
Menka, one of the things is that I'm always all in. So that's the thing. But right now, actually, when I'm meeting the companies, I meet about 4-5 companies every day on one count or other. I'm actually finding values. Yesterday, I came across a company which is actually growing at 25%, but available at 12p multiple TTM. So, the guy doesn't know whether he should pay dividend or not. That kind of company, and good size. So I'm seeing values emerging in the market, and that's a good sign for the markets to bottom out. I mean, who knows the bottom? I mean, only fools and liars know the bottom. So I would not bet too much on whether when the market is going to go to bottom. It has corrected very well. The economy is on the upswing. Earnings are on the upswing. Yes, we have a global challenge. Okay, we'll have 6 more months of patience. I mean, I buy at 100 and it goes to 90 or 80. That's fine. But I'm buying a deep value, and my deep value is valuation below growth rates. I mean, if the growth rates of the company demonstrated and likely is about 20%, 25%, if I can get it anywhere between 15 to 20, 25 P, I think I'm pretty happy.
Ramdev Agrawal, Chairman and co-founder of Motilal Oswal Financial Services, and of course our very own Maneka Doshi. Thank you for that. Still to come, Seoul gears up for a massive comeback concert by superstar boy band BTS. More than 250,000 fans are expected for Saturday's show, kicking off an 82-date world tour that could out-earn even Taylor Swift. More in a moment. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back. You're watching Insight. Shares of Korea's hype in focus today following the release of the comeback album for its superstar K-pop group BTS. The boy band then kicks off an 82-show world tour tomorrow evening with a free performance in Seoul, lucky them, that could draw more than 250,000 fans to the heart of the city. Errol is back for more on this. I mean, this is 4 years in the making. It is significant. It is huge.
I mean, not to mention how excited the reporters and producers in the newsroom are about this comeback, right? Huge, as you say. If you follow the group, you'll know they've been on this 4-year hiatus. They've been serving the military. So this is the first time they're back as a full group for the performance. And indeed, if you look towards tomorrow, where there's going to be a full free concert, that's really what's getting everybody excited. But at the top of this hour, they also dropped an album, Arirang, right? I haven't heard it yet, but I'm sure it's great. And I think what's significant also about this concert that's going to be held in the heart of Seoul tomorrow evening, on top of it kind of kicking off their 82-show world tour, it's also the significance of the location. This is going to be in the heart of Seoul, Gwanghwamun Square, near the palace, and this is an area where there's a lot of historical significance, an iconic landmark. I think it's BTS's way of kind of signaling not just, hey, we're back, but also how they're connecting their local roots with their global influence. And just to give you a sense of the scale of the potential turnout, I think some estimates put it at 260,000 people at least. And I think that area of Seoul hasn't seen a turnout of more than 200,000 in an outdoor crowd since the early 2000s at a couple of World Cup events. So it's massive.
You talk about Arirang, you got to wonder whether Arirang will do as well as Dynamite or Butter, for that matter, because those are really the top 5, among the top 5 songs of BTS. In terms of earnings, what can be expected? I mean, people make comparisons with Taylor Swift Eras tour.
Yeah, I think for Taylor Swift, if you recall, at the time, it was already record and groundbreaking, right? Her takings were like $2 billion. That was a marathon, 150 shows over, what, I think it was a year and a half. The comparisons being made this time around to BTS's takings, the windfall that could come in from HYBE, which is, of course, the company that manages them. I think Bloomberg estimates put it at about 800 million for ticket, merch, sales as well. But you also have some of these local brokerage firms, more generous estimates. They expect something like $2 billion. And partly because how ticket prices have climbed over the years. So this is going to be quite something.
I mean, you said it's going to be huge. The turnout is, what, 260,000 or so? I mean, authorities are not taking any chances, right?
No, I mean, there's also some sensitivities with regards to crowd control, right? Because of the Itaewon Halloween stampede in 2022, where more than 150 people were killed. So, as you say, authorities are really not taking any chances. They're tightening security. Special police units have been deployed. You're seeing restricted access in some of these areas near the event venue. And I guess if you don't want to be part of the crowd, just braving the crowd in Seoul, you can watch it online, actually. Netflix is going to be streaming this event. Some people have talked about it as potentially going to be the most watched live stream of all time.
Come back for BTS, Avril Hong. Thank you so much for that. Well, before we go, here's a look at one of our guests for next week. On Monday, we'll talk exclusively to EFG International CEO about the company, business outlook after the Swiss private bank recently saw Moody's change its outlook to negative from stable. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Oil prices retreating as the U.S. and Israel try to ease concerns over the war with Iran. Prime Minister Benjamin Netanyahu says Israel will avoid future attacks on Iranian energy facilities. Qatar Energy says the strikes on its Ras Laffan site will cost about $20 billion a year in lost revenue and take up to 5 years to repair. And high energy prices are reviving fears of a global inflation shock. Bond investors worldwide now rushing to price in higher interest rates, complicating the path ahead for central banks. Well, it has just gone 9 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. It is day 21 of the Iran war, but I'm going to put that aside for 1 second and just wish our viewers who are celebrating Eid Mubarak and hopefully more peaceful days to come in the coming days. But with that, let's take a look at how global markets are faring. The handover from Asia today, somewhat more positive. As you can see, S&P futures leaning towards the green. This is after pulling back more substantial losses yesterday in the session. At one point, we were down 1%, but we ended the day down 0.3%. Anyone who's micro-watching the moves in the S&P will note that we actually did break through that 200-day moving average to the downside. So it could be a key technical level to be watching over the course of the next couple of days. European markets also seen opening up in the green today, up 0.6%. This is contrary to yesterday's price action. We had deep declines on these European indices. The Stock 600 ending the day down 2% lower. Of course, paying close attention to that massive shock that we had in European gas futures on the open yesterday after the announced disruptions at Qatar Energy, huge supplier for the LNG market. And we had the ECB too, steadied the course there, but Bank of England surprising the market with a bit of hawkishness. I'll get to that in just a moment. So where is oil with all of the developments over the last couple of days? $107 is where we're tracking right now. So net still higher from where we were 24 hours ago. And of course, there have been several attempts from President Trump and even from Israeli Prime Minister to say that they will no longer be targeting Iranian key energy infrastructure. But at the same time, the market is still very focused on the fact that the Strait of Hormuz is still effectively shut, and the damage that has been sustained at some of these major energy facilities in the region, that is not something that's going to be fixed overnight. So we'll have longer term ramifications for the market. We'll talk about that. Gold this morning up 1.4%. But interestingly, as we started to talk about yesterday, what's been happening, precious metals, industrial metals have started to come off on back of some of the demand destruction that's being priced in. And then also some reporting suggesting that central banks, remember, Asian central banks have been big buyers of gold. Many of them now are looking to preserve some of that firepower because they have to support their currencies. So placing less of their money into gold reserves, into USD, and actually keeping some firepower in case the dollar continues to strengthen, which would weaken some of those EM currencies. So that's one development to think about. But I mentioned ECB, Bank of England. We had a slew of central banks in the last couple of days as well, Bank of Japan too, and the Fed and SNB. Let's switch over and take a look at how the reaction has been. And here, let me just show how much front-end yields have moved. This says UK yields, US yields, and German yields. And you can see the white one is the UK one. We've moved 80 basis points higher, 80 basis points higher over the course of this month. In Germany, the move is about 50 basis points. In the US front end, we've moved about 30 basis points, suggesting that the market really is accounting now for sustained higher inflation in the short term. And then switch over, not just that, but also a reaction function out of central banks that would imply more hawkishness. Take a look at this. Now, as things stand, the market is pricing in almost 3 hikes out of the Bank of England for this year. 3. Almost similar for the ECB as well, about 60 basis points of hikes priced in. But the Fed, the market's still holding on for a Fed that stays the course or somewhat maybe tilts towards a rate cut towards the end of the year. So ECB, Bank of England, at least as far as market expectations, now going to start a rate hiking cycle. This is just what market participants are saying. I thought that was interesting to flag. Okay, let's go back and talk about some of the price action in Asia, though. Min Min Lo is in Hong Kong for us. Min Min, walk us through the Friday trade.
Hey, Jumana, you mentioned the central bank commentary, and clearly the inflation risk is still weighing on markets. And you can see here in Asia, it's looking a little bit mixed, but still under pressure, even as we see the pullback in oil. That's giving a bit of relief to the Kospi, just marginally in the green today. But mostly here you can see the Hang Seng is also down. Japan, by the way, is closed for a holiday. Hang Seng is partly also because we have Alibaba reporting earnings today. Huge disappointment. We're talking about both the top line and bottom line missing estimates, a 67% decline in net income. And that is really driven by the huge promotional spending on the quick commerce segment as Alibaba enters into this battle with Meituan. And so that's the revenue picture for Alibaba, even though its cloud computing revenue actually is doing very well, but there's still concern around the path to monetization. So here you can see all the big tech names all declining today. So we have two of the biggest stocks on the Hang Seng, Tencent and Alibaba, reporting earnings this week, both disappointing to the downside, and that is putting a lot of pressure on the Hang Seng Tech.
Min, thank you so much, Min Lo in Hong Kong. Well, our top story today, the leaders of the US and Israel have sought to reassure investors rattled by damage to major Persian Gulf energy facilities. Israel says it will no longer target energy infrastructure after rebuke from President Trump. And Prime Minister Benjamin Netanyahu says Israeli forces will help the U.S. attempt to reopen the Strait of Hormuz.
The death cult in Iran is trying to blackmail the world by closing a key international maritime route, the Straits of Hormuz. It won't work. Israel is helping in its own way, and intel and other means, the American effort to open the Straits of Hormuz, rather.
For more, we're joined by Stuart Livingstone-Wallace, our executive editor for MENA in Russia. Stuart, about 24 hours ago, President Trump put up that post distancing the U.S. from the Israeli airstrikes on the South Gas Pars field. And of course, as we were discussing throughout the course of the day yesterday, the retaliation from Iran came very swiftly, targeting key infrastructure sites in the Middle East. But it seems as though overnight, both President Trump and the Israeli Prime Minister are trying to downplay the possibility of future attacks on key energy sites in Iran.
Yeah, exactly. I mean, they are trying to de-escalate that particular point. I would say that it's probably not working so far. I mean, as you saw coming across the wires a short time ago, you had Kuwait saying that it had one of its refineries attacked by a wave of drones, and that set off a fire. So if they are trying to de-escalate, there's no evidence yet that Iran is responding in kind. And that will continue to have this knock-on effect that you've already seen in the energy markets. I mean, it is really quite profound by every measure, both at the crude oil level, at the gas level, but then down into refined products. And that is spreading across the world. So if you look, for instance, at the US retail gasoline price, it has risen every single day since this war began.
And Stuart, we got a little bit more color from Qatar Energies as to the extent of the damage that was sustained. Talk us through it.
Yeah, I mean, it looks pretty bad. I mean, they're sort of giving a 3 to 5 year time frame to be able to get all of that back. So clearly, I mean, these are incredibly complex bits of kit. It's not as simple as sort of replacing a pipe. They're very, very complex bits of machinery. So it's understandable it's going to take some time, but I think that has ramifications again for the entire global economy because it is such a gigantic producer and supplier to countries all around the world, and it's very important. Not only that, but it was, in the middle of doing an expansion in terms of its capacity and therefore becoming a more important player in the world. So what does that mean? I mean, in effect, it leaves the remaining players, in a much stronger position in terms of being able to grab market share. But there's real questions there about whether there's enough other capacity in the world to make up for that lost supply. And as a consequence, again, you're going to see this domino effect. What exactly is Europe going to use to power itself in the coming years? Is it going to be nuclear? Is it going to be coal? It doesn't appear to be enough gas out there necessarily to be able to supply existing demand. So it's going to have some very profound implications for power generation, I think, across the world.
Stuart, thank you so much. Stuart Livingstone-Wallace, our executive editor for MENA in Russia. Well, let's continue the energy conversation. To discuss further, joining us is Christoph Ruhl. Crystal Energy Global Advisor. Christoph, it is interesting that, again, there's been an attempt to sort of de-escalate people's concerns or investors' concerns about the disruption in energy markets. But at the end of the day, I mean, the IEA even said it. This is the largest disruption that has ever happened to oil markets in the history of them tracking it. How do you see this moment, and how much are markets and oil markets adequately reflecting the moment that we're in right now with Brent at around $107?
Good morning, and Eid Mubarak to you. So, I think that what we are seeing here is really a problem of trying to stop the escalation in one way or another. The most interesting part of what is playing out now is not whether Israel did it alone or the US helped them, or the attempts of Netanyahu and Trump to sort of downplay future attacks on the infrastructure. To me, it is the clear recognition that Iran is able and capable and willing to not just shoot random salvos at its neighbors, but to target particular pre-selected energy products in a tit-for-tat. And that indicates to markets, I think, that this asymmetric warfare they have engaged in can be sustained for a long time. And together with its noises about rejecting a possible ceasefire a la Gaza, and together with this fact that it becomes every day more difficult for Netanyahu and Trump to retreat from the situation, this indicates more trouble on the horizon. And for oil, gas, and energy markets in general, it is the prospect of further disruptions which is the most important driving factor, not an actual shortage right now. There's no queues. There is no lasting damage to global gas supplies from this attack, not a big one if you do the numbers. And it's the fear that this spirals further out of control, which is the dangerous part here, also for the global economy.
Christoph, let's say there were a ceasefire announced. There was to be a ceasefire announced tomorrow, and the strait gets reopened. Not saying that this is realistic at this point, but if that does happen, how do you think the energy markets would react? Because as you say, it seems as though we've moved away from just short-term disruption to flows to perhaps investors now pricing in longer-term physical disruption and higher geopolitical premium in the region.
So far, every day has brought more negative surprises. If that turns, and if you take your scenario and peace breaks out tomorrow, I think we are still on the good side of the equation, in the sense the damage to international gas markets. Qatar said it's about 18% of its LNG capacity, production capacity, which in turn, Qatar's capacity is 20% of the global capacity. So that's a loss of about 4%. That can be dealt with. Oil markets have been in good shape before this attack happened. Strategic storage is high everywhere. Chinese storage is very high. Oil on the water from Russia and Iran is very high. The strait opening tomorrow, no lasting damage to oil production facilities as far as we can see. No Houthi attacks in the Red Sea and the East-Western pipeline, Saudi Arabia. All that would equate to the storm blowing over pretty quickly and oil markets returning to a situation of general oversupply, which is the situation they had before these attacks.
Yeah. And how easy is it going to be to find alternative supplies? And this is to what my colleague Stuart was saying earlier. There's going to be perhaps a scarcity of supplies available, especially when it comes to LNG. Does this mean that eventually we will have to end up in a demand destruction scenario for not just consumers, but for industries as well?
I think at the moment, in purely energy and economic categories, we are still before this Rubicon, so to speak. If it happens that tomorrow the supplies are being restored, I don't see lasting damage either in global gas markets, where it will take some time for prices to come all the way back to where they were, or in oil markets, where it will be very fast, this adjustment. Then, of course, it depends what happens to sanctions, what happens to future production. It is really the fear of the unprecedented. We never had a supply disruption like this, but for now, it would still be short. It's the fear of this being prolonged, the fear of supplies being meaningfully disrupted at production facilities by physical damaging them, which drives these oil spikes. And you can tell that actually compared to the winter of 22-23 when Russia attacked Ukraine, we are still by several degrees, orders of magnitude below the price spikes which we have seen a few years ago in that situation. And the reason is that A, energy markets were well supplied before it happened, and B, the physical damage is still limited, and C, a simple a choke point. If in your assumption it's open tomorrow, the problem will be, the immediate problem for prices will be gone, and what remains are political problems. And that's why I'm saying if you only look in economic and energy categories, we can manage it. If we add to this military political dimension, it gets horribly difficult.
Yeah. Christoph, let me ask you something else. I think many people were surprised to hear the Treasury Secretary, Scott Bessent, say that they could move to unsanction some of the Russian oil that's already floating on water yesterday. Seems quite paradoxical given the war is still going on. I just wonder, number one, how much of an impact that could have, and number two, are Russia ultimately the ones that are benefiting the most from this energy crisis?
Well, number one, the US has almost exhausted the arsenal of stopping prices from rising given this degree of uncertainty. If the strait isn't opened and this uncertainty of physical damage is not removed, they can unilaterally throw on the market some of their strategic stocks. They can promise to intervene in future markets, which will meet with a huge degree of skepticism by Wall Street. And they can make promises of desanctioning Russian oil, which they already have for all intents and purposes for the next 30 days by allowing it to return and to be imported into India. So there isn't much they can do. On the second part of the question, there's no doubt, absolutely no doubt, that the biggest winner of all of this is Russia. Russia has a lot of oil parked on the water after sanctions were tightened and they couldn't export it to India anymore. Before that, it went to China, India, and Turkey, basically. That oil is now being released, and so their supplies are increased from Russia. They find it easier to enter that in the global markets at a price which, since the attacks of Iran, has increased by 50%. Now, this hits Russia in a situation where they had just decided to sequester their budget and cut their expenditures by 10% because oil prices had come down nicely and because sanctions finally had tightened sufficiently for them to feel the pinch. And in that situation, this must have been a huge relief valve. And yes, it's true, Putin is losing friends at a rapid clip in Venezuela, leaders of Venezuela and Iran, but on the economic side, they are the single biggest beneficiary of this by far.
Christoph, always good to chat to you. Thank you so much for joining us. Christoph Ruhl, Crystal Energy Global Advisor. Well, coming up, plenty more ahead. Stay with us. This is Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Now, tensions between the U.S. and Japan over the Iran war remained evident as President Donald Trump hosted Prime Minister Sanae Takaichi, even as he praised Japan for answering his call for support in the effort. Bloomberg's Tyler Kendall recapped the event outside the White House.
As Japanese Prime Minister Takaichi visited the White House here today, President Trump said that Japan is, quote, stepping up to the plate unlike NATO allies, though it is clear that tensions remain. It's not immediately clear what steps Japan is taking when it comes to the conflict in Iran, though President Trump said the pair of leaders will discuss Japan's mine-sweeping capabilities in dialogue behind closed doors. The Japanese Prime Minister saying she had brought to the U.S. concrete proposals to help calm energy markets and condemned the closure of the Strait of Hormuz, which data shows 90% of Japan's crude oil imports flow through. Uncomfortable circumstances were on display, though, when a reporter asked President Trump why the U.S. hadn't informed allies about the war, and he answered, "Who knows better about surprise than Japan," in reference to Pearl Harbor. This White House visit is a chance for the two countries to strengthen economic ties, and a major topic of discussion will be the $550 billion pledged investment fund established as part of the U.S.-Japan trade truce. Bloomberg News now reporting that includes a new $40 billion planned investment in nuclear reactors in a bid to stabilize energy prices. China also looms large over this White House visit, considering that this trip was planned before the conflict in Iran started and was designed as a way for the two leaders to touch base before President Trump travels to Beijing. That planned meeting is now delayed, the president saying about a month or so from now. At the White House, Tyler Kendall, Bloomberg News.
Bloomberg's Tyler Kendall there. Well, coming up, Nigeria's Dangote refinery sees a surge in fuel demand amid the Iran war. More details next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Jay Staley's wife has filed for divorce from the former Barclays chief executive, who was banned from the UK financial industry over his relationship with Jeffrey Epstein. Deborah Staley's divorce filing comes after Jess Staley publicly testified about being unfaithful to her years earlier with one of Epstein's staffers. Wall Street lending giants could get relaxed capital requirements under proposals unveiled by the Federal Reserve. The changes could potentially unleash billions of dollars for lending, share buybacks, and dividends. The plans are subject to a 90-day public consultation, but if approved, would represent a major win for the industry. Sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jerome Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony that Powell gave to the Senate. Alibaba's U.S.-listed shares slumped after reported third-quarter sales that missed estimates. Sluggish growth in its core e-commerce business dragged on earnings, while intensified competition in food delivery also crimped profits. Alibaba's cloud and AI units saw the fastest growth. The company says it aims to quintuple revenue from those businesses in 5 years to $100 billion annually. And a quick look at equity futures. Things are pointing towards the green today. Some attempts at de-escalation, I would say, from leaders, but at the same time, the intensity of the attacks both ways continues over here in the region. We'll talk more about that. But coming up, Von Tobel joins us with their market outlook as the U.S. and Israel try to reassure investors rattled by the damage to major Persian Gulf energy facilities. That's next. This is Bloomberg.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food. I never had this ingredients never used in Japan. Kind of like a wow, you know, and cilantros, chili, garlic, and olive oils. It's a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi. But Peru use fresh fish, make the called ceviche, cooked with the lemon juice. You know, never use the soy sauce. First time I eat this, kind of the, wow. So then after this one, my open eye more, my cooking style that change. Combine to Japanese style and another country food, then make novel style.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslinda Amin in Davos, Switzerland, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Oil prices retreating as the U.S. and Israel try to ease concerns over the war with Iran. Prime Minister Benjamin Netanyahu says Israel will avoid future attacks on Iranian energy facilities. Qatar Energy says the strikes on its Ras Laffan site will cost about $20 billion a year in lost revenue and take up to 5 years to repair. And high energy prices are reviving fears of a global inflation shock. Bond investors worldwide now rushing to price in higher interest rates, complicating the path ahead for central banks. Well, it's just gone 9:30 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. Eid Mubarak to our viewers who are tuning in. But if you've got the day off, then hopefully you're enjoying it somewhere. Let's take a look at how global markets are faring as we head into the final trading day of the week. And we're seeing a bit more green on the board today. S&P yesterday ended the day in the red, but at one point we were down 1%, ending though the session down 0.3%. Attempts, I would say, out of President Trump to sort of de-escalate the situation over here in the region. But I will tell you, just even anecdotally, there are still ongoing attacks launched from both Israel into Iran and Iran retaliating against GCC states. So things on the ground different, perhaps, to some of the framing that's coming through elsewhere. But S&P futures up 0.1% this morning. European markets also seen opening up in the green, up 0.6%. This after a major pullback yesterday, down 2%. Again, lots of questions there about the ramifications of this energy squeeze, the gas squeeze, the fact that Qatar Energy have now actually said that about 17% of their capacity is going to be taken offline. That is going to have huge reverberations for Asian economies, also for Europe as well. So we saw that being priced in yesterday. Brent is slipping somewhat this morning, down 1%, but still trading up at $108 or just below that. One of the interesting announcements that came through yesterday from the U.S. Treasury Secretary Scott Bessent saying that they're looking to unsanction some of the Russian oil that's already available on Iranian oil, rather. They're looking to unsanction some of the Iranian oil that's already on waters. So another measure that's being put forward by the U.S. to help bring down prices. This as we continue to focus on energy infrastructure damage, alongside the fact that the strait continues to be effectively shut. And then gold this morning up 1.3%. But take a look at where we're at. We're down to 4,700. It has not been a pretty week or a pretty couple of days for precious metals or industrial metals. And then switching over, I did mention the knock-on effects that the energy crisis is going to have on other economies. The macro is interesting because right now what you're seeing is the front end of US, Europe, UK, all repricing quite significantly over the course of the last few weeks. Take a look at two-year gilts, up 80 basis points this month alone. The US up 30 basis points, Germany up around 50 basis points to account for what is expected to be a higher inflation profile in the coming months. And this is actually something that was explicitly referenced by the Bank of England yesterday. ECB sort of holding the course, saying steady, but ultimately investors now accounting in for that inflation shock. And switching over, just to point out that because of that, there are rate hikes now priced in, about 3 rate hikes priced in to the 2026 Bank of England curve. The ECB just a little below that, around 63 basis points. And then the Fed's essentially flat now. So all of the cuts that were priced into the Fed curve have now been unpriced. So the Fed curve is flat for 2026. Now, we spoke about Asia, Europe, but Bloomberg has learned that African nations are scrambling to secure fuel from Nigeria's Dangote refinery as war in the Middle East disrupts supply. The refinery is now seeing a massive surge in demand from countries like South Africa and Kenya to prevent local energy shortages. For more, our chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg, yet another perspective on how this global energy crisis is affecting specific refineries. And in this case, we're talking about the Dangote one. I guess the question is, does Dangote actually have the capacity to fill the gap that's needed for many of these African economies that need it?
Exactly, Jumana. Dangote's refinery has only been operational for just over 2 years, and they do have quite a bit of refining capacity. But if we think about the extent of what African nations need at this point in time, potentially it's not going to be able to fill the gap. So at this point in time, the refinery is able to produce about 650,000 barrels a day, and around 75% of those are reserved for Nigeria. So there is a limited amount that can actually be exported. We actually heard from Dangote, who spoke to The Economist, and said right now it's not about pricing, it's about availability, just underscoring how the situation continues to evolve. But Bloomberg reporting does suggest a number of nations are trying to reach out to Nigeria to see what is available, but not just Nigeria, also a number of stakeholders, just to fill the gap until we get some clarity about where things are headed at this point.
And are there signs that the war is already impacting the continent, Jen?
There's quite a few signs, Jumana. I mean, you've been talking extensively about the energy situation, which is perhaps most acute here on the continent and in East and Southern Africa, which really relied on the Middle East for imported fuel. A number of countries, which we've reported on, do have some emergency reserves, but they don't actually have this refined fuel. And so that is really the concern. And it's not just that, Jumana. There are also structural weaknesses that are being exposed as this war continues on. We do know South Africa has about 8 million barrels of strategic crude oil stocks. Virtually none of that is fuel reserves, excuse me. We've also been hearing from miners like Exxaro who are talking about potential knock-on effects. Potentially we see more demand for alternative fuels. They're actually predicting that potentially we see coal prices going higher as a result. And not just that, they're also concerned potentially about the shipping costs and the freight costs that come with higher fuel costs. And so this is really being spread across the board, across the energy supply chain. And African leaders and governments are trying to not cause any sort of overreaction, but we are already seeing some prices, like in Somalia, for gas and for fuel continuing to rise. So again, time will really tell where these alternative sources are going to be for a number of these countries for their refined products.
Jennifer, thank you so much. Jennifer Zabazaja, our Chief Africa correspondent. Now, emerging market assets are under pressure as hopes for a U.S. interest rate cut evaporate and as conflict in the Middle East weighs on sentiment. Joining us is Anne-Laure Guichel, founder and CEO of Global Sovereign Advisory. Anne-Laure, really good to have you with us. Maybe let's just start with a broad perspective of just how much of a shock the Iran war is going to constitute for emerging market economies, and if you have changed your growth outlook for many of them on the back of it.
Yeah, good morning. Look, first of all, it's very, very difficult to have a diagnosis right now because obviously we're still very early days. And we are seeing, and you spoke about it actually minutes ago, the volatilities that we are seeing in the prices of oil or other commodities, right? So for sure, I mean, those economies and the emerging market economies will have issues, and some of them have started to have issues if the oil price remains high. If the gas price remains high, I think gas, we may talk a lot about oil, but gas definitely is one to be looked at. And also there are other commodities that are being an issue, right? Because typically on the fertilizer front, which is extremely important because we are during the time of the year, right, where obviously fertilizer needs to be used. And a lot of the fertilizers goes and comes from the Gulf region. And the prices of those have already started to go higher, which of course is also going to create a shock and could also have repercussion around the food industry. So I guess what I would like to say is that still it's early, so it's difficult to know if it's going to be something very temporarily that is going, of course, to be a hit on those economies, but it could be managed because it will be short, or if those have going to have lasting effects, typically because oil or gas or other commodities are going to be higher on the long term.
Yeah.
To be honest with you, I think we're going to see those prices higher.
Okay, so you think that you think we're going to see prices higher in the long term? The closest parallel that we can draw is what happened back in 2022 and also around COVID as well. And back then, you saw governments step up with these massive spending packages to help bolster their economies. And in many sovereign countries around the world, these fiscal levels haven't quite recovered. So we saw a shooting up of debt, and they've really struggled to bring them back down again. Are we going to see wave 2 of this, do you think, this time around? Are we going to see governments forced to spend more to help deal with this energy crisis?
Yes, it already has an impact, right? Because a lot of those governments have subsidies with regards to energy, right? So those subsidies are already in place. So you're not already talking about new subsidies or new measures that they could take. You're already talking about the ones that are in place and then obviously are influenced when the price of energy goes higher, right? So indeed, it's already impacting the budgets. You're absolutely right to say that the budgets of those states are already, I would say, not fragile, but they are more constrained because of multi-shocks, because of the COVID, because of the war in Ukraine, so that have been one after the other, with increasing debt level that we've seen. And indeed, there hasn't really been time to recover or to reconstitute room to maneuver and fiscal room to maneuver. So this, for sure, is one cause of concern. And if you ask me, I don't think the market has priced this in any way, shape or form. Because if, for example, you look into the bonds in the emerging markets, for example, in Africa, bonds, I mean, you've seen a little bit of a hike, right? But nothing to the extent that would actually signal a true issue, right? So I think on this, the market is being, for the moment, I think, on the waiting line, but has not overreacted or has not really 100% priced something that would be a lasting effect.
Yeah, okay, interesting perspective there. Are there any countries, at least, on your radar and maybe looking specifically to the African continent too, that stand to benefit from this? So we're just talking about the huge incoming demand that the Dangote refinery is getting in Nigeria.
Yeah, well, look, I think some of the country, like indeed Nigeria, is one that could potentially benefit, but typically Egypt could also benefit, and Algeria could also benefit. So Egypt is a more complex case because there are pros and there are cons for Egypt in the sense of Egypt could also be under pressure. But if you think about what they could do, they could become, or they could at least increase their influence on the fertilizer front, right? Which obviously is going to be very needed, and they could substitute themselves to some other players that are, for example, in the Gulf region. It's a slow process, but still it could be something that could be good for them. Also, when you think about some exporters of commodities, typically I'm thinking of the likes of Zambia, it depends a lot of the copper price, of course, but this could end up being beneficial. So you're going to have the traditional ones that depends on oil and are oil importers that, of course, are going to have some issues. You're going to have the oil exporter that are going to benefit out of it. So this is the usual things that happen in such cases. But I think you're going to also see effects in other sectors, typically in the fertilizer sector, that is going to be one that is going to benefit some of those economies. But if I'm doing it super simplistic, the African countries that are on the eastern side, are going to have more issues because of stronger ties to the GCC. South Africa is also one to follow closely, right? They do have already signaled some issues with regards also to their energy reserves. They, of course, have capacity to rebuild, but this is something that they've basically said. And so far, countries from the WAMU region, for example, are a little bit more immune to those. But obviously, if the crisis was to continue much longer, they will also have issues on the line.
Anne-Laure Guichel, thank you so much for joining us, founder and CEO of Global Sovereign Advisory. Well, trading in equities is choppy heading into the weekend, while oil prices retreated as investors weighed efforts by the U.S. and Israel to ease concerns over the Iran war. Joining us now is Dan Scott, Vontobel CIO and multi-asset head. Dan, good to have you with us. The question that I've been asking myself all week is whether equity markets, and specifically U.S. equity markets, are simply being too complacent about how bad the situation is on the ground over here in the region, and the real amplification in terms of, the energy sites that were hit yesterday, the long-lasting damage that could have globally. Are U.S. stock markets being too complacent?
Hi, Jumana. Thanks very much for having me on. It's a very treacherous situation, I'd say, right now, because as an asset allocator, you need to decide whether you want to recalibrate your economic outlook, whether you want to have a base case scenario where you feel that energy prices are up and remain higher for a longer term, and then the economic outlook completely changes as to whether you think that this is just going to be a situation that resolves itself in the short to medium term. And I think right now what the markets are telling you, if you look at how relatively well behaved they are, that the hope is there that actually the Strait of Hormuz opens up. And really it is that energy bottleneck that is the most pertinent for markets, because it then has, as a function, of course, an impact on your inflation expectations. And as you were pointing out before, also a recalibration on where you expect rates to go. And so the U.S. is seen as being fairly shielded, at least because it can supply itself in terms of energy. But prices do go up, because energy prices are set globally. And so that really is going to be a question whether you manage to work through that inflation as being something to look through, or something that's actually going to feed its way through and have a longer-term impact on CPI, and whether that means that then you need to recalibrate your expectations for rates in the U.S. And I think the market has done some of that. Nonetheless, we're trading, not so far off all-time highs on U.S. markets. And the big hit clearly is not the U.S. The big hit has been in Europe, which has a lot more energy dependence.
Yeah, so let me talk to you about that. And yesterday we had two key central bank meetings. We had the ECB and the Bank of England. The market had different reactions. Well, also the tone that came out of those central banks differed a little bit. The Bank of England seemed to be more alert and indicated that a hike could be a possibility. ECB signaling that they're going to stay steady the course. What do you make of the differing attitudes that the Bank of England and the ECB had to this inflation shock yesterday?
Well, I think the two have very different underlying economies and situations that they need to deal with. In the UK, the inflation picture has been a bit stickier. So the UK does have this trickier situation where they have stickier inflation, but at the same time, they have an economy that's really going to struggle with rate hikes. So they need to move on the inflation front. For the Eurozone, doesn't really have an inflation problem. There's not really an issue with inflation in the Eurozone. There's no real need to hike unless, of course, you have an energy situation here that does move inflation higher. And the Eurozone economy is fine on hold here for the time being. So I think there it's really a question of, the cost of gas in particular, imports into the Eurozone, and whether that has then a knock-on effect onto inflation. So that's probably why you have a different view from those central bankers.
Yeah, I also wonder whether investors this time around are quick to price in a hiking cycle because of what happened around COVID, when central bankers were telling us that inflation was going to be transitory and, of course, embarked on a series of hikes much later than they should have. Do you think this is what's happening right now with market participants to account for that possibility?
Well, see, the difference between central banks going into hiking mode and central banks staying with relatively easy monetary policy, maybe even further cuts in the U.S., which is what we were pricing before, is that positioning is completely different. And I think the market does not want to turn its positioning upside down here and go into risk-off mode. You can see that there has been some liquidity taken off. There has been some change in or some profit taking rather in those sectors that have high valuations. But otherwise, it's really mainly wait and see, because the outlook still remains for a global economy that's doing quite well, for a U.S. economy that's growing, close to capacity, and a Eurozone economy that's also going to look to be growing at 1.5% approximate GDP. So the outlook is fairly risk on, or had been fairly risk on going into this event. And now if we turn things upside down and look into monetary tightening, that really does turn things upside down in terms of asset allocation as well. And so far, we haven't seen those moves. So far, it looks like people still want to maintain an element of risk and look to opportunistically, gain when markets snap back. But we do really need an opening of the strait again in order for that to be a possibility.
Yeah, it all boils down to the strait. Okay. Dan Scott, thank you so much. Always good to talk to you. Thanks for joining our show. Van Tabel, CIO and multi-asset head. Well, Dubai has long sold itself as a safe haven in the Middle East, but Iran's unprecedented strikes on U.S. partners across the region are now putting that reputation under pressure. Bloomberg Originals has been investigating how Dubai's model of stability is being challenged. Here's a preview.
These attacks were unprecedented. We could not have imagined this scenario actually playing out.
Most airports and airlines in the region are affected.
Drone has hit a residential tower overnight in Dubai. It sparked a fire and residents were forced to evacuate the building.
This conflict has come to the doorstep of a territory that many perceive to be one of the world's top safe haven territories.
That perception was by design and helped attract both money and talent. The strikes threaten more than lives and infrastructure. They're testing Dubai's model of stability and the image it wants to project.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead.
We've already won in many ways, but we haven't won enough.
Thousands of deaths across the region have been reported in the war begun by the US and Israel. Iran's wave of retaliatory strikes targeted US allies, prompting the UAE to prioritize safety above all else.
Iranian strikes have hit airports, military bases, even data centers.
The UAE has seemingly defied what many assumed would be an existential threat. It's navigated peril before, but with war on its doorstep, can it do it again?
And subscribers can watch that full documentary now on the terminal or our website at Bloomberg.com. You can also find more from Bloomberg Originals on their YouTube channel. Well, the war in Iran has once again presented Donald Trump with an intractable dilemma. The U.S. president needed to calm energy markets and turn to social media, posting that the U.S. had no advanced knowledge of Israel's plan to attack Iran's biggest natural gas field. However, in Israel, officials insisted Trump knew. For more, our news desk managing editor Jill Deses joins us. So, Jill, just talk us through the options that President Trump is facing in this war. And of course, he's faced now with what has expanded into a regional war. His Gulf allies are irate that they have been targeted in such a fashion. And of course, the economic costs continue to mount.
Yes, that's right. And hi, Jumana. Hope you're staying safe. Look, I think at this point, you've got kind of a fork in the road when it comes to the options that the Trump administration and Trump himself could ultimately pursue. You ultimately see an avenue where there is a continued escalation. That's one thing that, he can continue sort of pressing Iran in this war. We know that the Pentagon is apparently, attempting to secure loads more money and to sort of support that military firepower. Of course, though, as we've seen over the past couple of days, that kind of escalation does threaten to completely upend global energy supply. supply. Obviously, those attacks that from Iran in response to those Israeli strikes on energy supplies in Iran, the other attacks obviously led us to a situation where there were very, very enormous concerns about oil crunches. So that is one option, but obviously one that may lead to that further escalation, not just within that energy supply issue, but also military conflict. The other thing that Trump could do is potentially look for an off-ramp. He can say, look, we've achieved what we set out to do. We've taken out several high-profile Iranian, military leaders, intelligence leaders. So that's, one thing that he can ultimately point to there. There is that, that element of that's been upended in that way. He can say that, we've destabilized certain bits of, the Iranian nuclear program or what have you. Sort of like point to things that he might portray as a win in the situation if he's looking to ultimately back off of that conflict. The trouble with that exit ramp, though, Jomana, is that, one could argue that Tehran is actually in a fairly strong negotiating position at this point. So, I mean, obviously, if those retaliation strikes on things like that Qatari LNG field, UAE, those energy supplies are enough to really kind of rattle, Trump and Netanyahu, that does kind of suggest that that may be difficult as well. So it's some tough options here for Trump.
And there have been reports overnight suggesting that the Pentagon are seeking $200 billion in additional funds from Congress. How likely is it that that's actually going to get through, Jill?
Yeah, I mean, that's an enormous amount of money, Jomana. I think that that's one thing that, you'd have to look for, ultimate approval, a congressional approval to actually achieve. At this point, the other thing, too, that I think is really weighing on the minds of political leaders in America, at least, is they've got this really important midterm election in the fall here. So when you're talking about all of these international incidents that the United States is involved in, there's very much a domestic issue for them to pursue as well, which is that Americans don't want to see their prices go up at the fuel pump. They don't want to deal with rising inflation. This is something that Trump himself championed coming into office. It was a successful part of his campaign, was convincing voters that, he was there to not get involved in, a bunch of prolonged international conflicts and to also bring down their cost of groceries and gas and such. I mean, there can be an argument there that, other political leaders in the United States that may be responsible for approving those types of funding were saying, we don't want to be involved in a protracted conflict. So really difficult situation for the U.S. to kind of sort of navigate here, but that's ultimately, a lot of the strategies that are at play.
Bloomberg's News Desk Managing Editor Jill Deses, thank you so much. Okay, I'm going to do this super quickly. Let's just take a look back at the week and how some of these key assets have fared, because we did see equities trade more cautiously, but for the week, the S&P is actually down only just 0.4%. It's not that much given everything that's happened. The Stock 600 down a bit more, significantly down 2% on back of the gas knock-on effects. Asia Pacific actually up in the green. Switching over though, oil, that's the one that everyone's been watching this week. And for the week, we are higher to the tune of 3.3%. European gas futures up 23%. So that was your look back. Thank you for watching, and Eid Mubarak.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersecci in Davos, Switzerland, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Vonnie Quinn with your top stories. Oil easing after its highest close in more than 3.5 years as Israel says it won't attack Iranian energy facilities. And President Trump says he's, quote, not putting troops anywhere. Stocks fluctuate and bonds slide as traders weigh the potential economic impact of a protracted conflict in the Middle East. Plus, the European Union deadlocked over a €90 billion loan for Ukraine as the Hungarian Prime Minister refuses to budge. So let's take a look at these markets, specifically the oil market, because we did come off our highs, but we're still very close to 107 on Brent. Now, granted, WTI is right back down to 93 and change, but we're still very elevated from where we were. And we have to see if all these promises play out as they have been iterated, right? Clearly, central banks are worried. It's a very different regime today than it was just 24 hours ago after the BOE and the ECB and the BOJ, frankly, turned relatively hawkish. If you look at the dollar index, we're seeing that trade come back on ever so slightly, up about 0.2%. And let's take a look at some other asset classes, because obviously treasuries aren't trading. It's a holiday in Japan. We saw that massive move, particularly in front ends yesterday, and gilts in particular, a 40 basis point move. Right now we have stocks pointed to gains, but those NASDAQ 100 futures are coming right off their highs of the day. And the yen did strengthen after the BOJ comments yesterday and those hawkish comments, frankly, from the BOJ governor, but it's still very close to 159. Your risk events then for today. At 7 a.m. UK time, we get UK public sector finances. It's also triple witching, so expect a lot of volume, particularly in the last hour of the US session. And then we have the ECB's Joachim Nagel speaking, and that's at 5:30 p.m. UK time. Oil has pulled back from its highest close since July of 2022 after Israel said there would be no more attacks on Iranian energy facilities. Let's get an update on the market reaction from Winnie Su in Hong Kong. What are we seeing today, Winnie?
Yeah, morning, Vonnie. As you mentioned, there is a bit of a relief when it comes to the oil and gas space after those comments from the U.S. and Israel, and also Scott Bessent mentioning how the U.S. is looking to unsanction some of these Iranian oil. So you can see here Brent crude up down more than 1.6%. But remember, we are coming off as high as $120 per barrel just yesterday, and so far since the war began, we have actually traded up about 50% already. Now, also to watch is that gap between Brent and WTI remains very wide, and that comes as how the Strait of Hormuz remains shut, as well as investors expecting that any effort from the U.S. is likely going to help WTI more. That's why you are seeing, in fact, WTI pulling back more than Brent today. Flip the board and take a look at how that's impacting impacting the broader Asia market. Stocks here in Asia fluctuating a bit and now actually in the downside a little bit more as you take a look at how MXAP down about 0.2%. But when it comes to this week's performance, we are actually slightly still in the green, but that's coming after 2 weeks of declines already. And remember, since the war started, we have already fallen about 8% in Asia, underperforming what we see in the S&P 500, still that reliance on oil imports. So we will be very closely watching further developments over the weekend. Back to you, Vonnie.
Yeah, could be a volatile day. Winnie, thank you so much. Winnie Su in Hong Kong. Israel says it will no longer target Iranian energy infrastructure after sparking retaliatory strikes and a rebuke from President Trump. Prime Minister Netanyahu also pledged the help of Israeli forces to reopen the Strait of Hormuz.
The death cult in Iran is trying to blackmail the world by closing a key international maritime route, the Straits of Hormuz. It won't work. Israel is helping in its own way, and intel and other means, the American effort to open the Straits of Hormuz, rather.
Let's bring in Bloomberg Horizons anchor Jumana Bersetchi. So, Jumana, despite Israel's apparent promise, the IDF does seem to be stepping up strikes on other targets. Can you give us the latest?
Well, I think it's important to note here, Vonnie, that President Trump has been attempting to distance himself from those Israeli airstrikes conducted on the Iranian natural gas field. And yesterday, notable as well that during that press conference, the Israeli Prime Minister Benjamin Netanyahu did say that Israel acted alone, and then he said that they will no longer conduct attacks on energy infrastructure sites at the request of President Trump. The Iranian Foreign Minister Abbas Araghchi did put up a post saying that if they were to get attacked again, then they would show no restraint, zero restraint in their response, and that the response that we saw yesterday showcased limited firepower. So this is a warning that has come through from Iran. That being said, I should just say in the last 12 hours, we have continued to see strikes and counterstrikes. Over the course of the evening, the IDF announced that they had launched a massive wave of airstrikes over Tehran, targeting over more than 100 different sites and even infrastructure sites within Iran, as they continue to go quite heavily with these military operations. And in retaliation, Iran has not let up overnight either. We've heard about interceptions go through in Kuwait, in Saudi Arabia, once again. Also over here in Dubai, successful interceptions in the early hours of the morning. And once again, we are hearing about a fire in a Bahraini warehouse. So it's not as though the response intensity has actually diminished, but maybe at least now there is an understanding that energy infrastructure, at least upstream energy infrastructure, is a red line for all parties involved. Yet to be seen, though, how this is all going to play out, because some of the ramifications from yesterday's damage could have months, even years-long consequences, as we found out from Qatar Energy overnight.
Yeah, absolutely. And then also, Jumana, Netanyahu made some comments about the need for a ground component in Iran.
Yes, so in that same conference, the Israeli Prime Minister talked about them working on degrading Iran's missile capabilities, their naval capabilities, their defensive capabilities. But then he also said that airstrikes alone are not going to lead to leadership change, and that maybe, he said, some ground participation could be necessary, hinting that, at some point in the future has not ruled out the possibility of ground troop involvement, but that you would need to see the Iranian broader public participate in an uprising. Now, I should just say that this is contrasting with what President Trump said also. He was at a press conference yesterday alongside the Japanese Prime Minister, and he was asked about whether the U.S. would commit troops on the ground. He ruled out that possibility. He said that it is not on the table right now from the U.S.'s perspective, even though there have been many reports over the past week suggesting that they are mobilizing a group of thousands of Marines towards the strait to help with the reopening of the strait. And also just interesting, too, that some comments have come through from Tulsi Gabbard. She's the main U.S. spy chief, so to speak. And she actually said that there may be divergent objectives between what the US are trying to achieve and what Israel are trying to achieve. She said mainly US objectives are military in nature, whereas Israel have one further objective, and that is a change of leadership.
All right, we'll keep monitoring, obviously. Bloomberg's Jumana Bersachi in Dubai. Well, we've been seeing fresh volatility in bond markets as investors rush to bet on higher interest rates, with the surge in oil prices threatening to reignite inflation. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. So, Garfield, temperatures do seem to be coming down, at least in the political and geopolitical spheres. However, the Treasury market has been so much more sensitive to this than really any other market beyond oil. Should we expect, when we start trading again in about 50 minutes' time, that we'll see some calm reflected there too?
Well, there might well be some calm. In fact, there was already calm that spread across at least the long end of the Treasuries market towards the end of the US day yesterday, when we had the optimism that comments from Israel and the US were signaling that we were going to see some decrease in the intensity of fighting and even potentially moves towards some sort of a resolution. That brought down the temperature a bit when it came to the bond market, and concerns in particular that inflation expectations might really get going. The pain point for bonds is now at the short end. Short end yields are still up noticeably this week, whereas 10-year yields, both in the US and elsewhere, are actually little changed or even slightly lower this week. So what we're looking at is effectively a bear flattening move, which fits with an environment where you have central banks turning suddenly hawkish or suddenly more hawkish, as the case may be. So with the potential that supply shocks are still going to work their way through the economy, whatever might happen when it comes to the development of the war itself, central banks are going to go on being, at least for the short term, vigilant about inflation. That will keep a floor on short end yields or even send them higher. So any gains for longer end bonds, declines in long end yields, as optimism grows that oil prices are going to be coming down and the inflation angle will be improving, that's not going to stop that. You've got that chart up there. Thank you very much. We're looking at the biggest weekly flattening for the 2s10s in the US since February last year. And that trend has the potential to have plenty of legs.
Yeah, we're at 45 basis points now, Garfield. All right, we will continue to monitor the Treasury market and, of course, the oil market, on which it depends right now. Garfield Reynolds leads our Markets Live Asia coverage. European Union leaders have been unable to break a deadlock over a €90 billion loan to Ukraine. The Hungarian Prime Minister Viktor Orban is refusing to budge until he regains access to Russian oil, leaving European leaders frustrated.
Let me turn to the €90 billion support loan for Ukraine. A decision was taken by the European Council in December, and there was one condition. The condition that 3 countries would not participate in the loan. That condition has been fulfilled. So let us be clear about where we stand. The loan remains blocked because one leader is not honouring his word. But let me reiterate what I already said in Kyiv. We will deliver one way or the other.
Let's talk now to Bloomberg's chief Europe correspondent, Oliver Cook. So, Ollie, how long can Ukraine fight without any new funding?
It's really, Ivani, a matter of weeks here. We're talking about the end of April when the funding situation in Ukraine becomes very, very dire. Maybe that can stretch into the month of May, but it really puts urgency on the necessity of getting this €90 billion loan to the Ukrainians from the European perspective, which, of course, will fund the budget and the military efforts to 2/3, not just for this year, but for the year to come. And, of course, that has been made very, very difficult by Viktor Orban, the Prime Minister of Hungary, who says here from the meetings in Brussels, Brussels Situation Report, it was a tough debate, but but we stood our ground. We have the right to say no to the Ukrainian war loan. As long as Zelensky does not lift the blockade, the oil blockade, they will not receive any money from Brussels. No oil equals no money. And at issue here is a damaged pipeline that flows through Ukraine, brings Russian crude oil to the Hungarians. Remember, they are an exception to sort of the rules in the EU against Russian fossil fuels. And that is destroyed, of course, by the Russians. And the Ukrainians say they're trying to fix this pipeline. But this is at the heart of the debate here. Now, we should say that this was an issue, this 90 billion euro loan that was settled back in December. And as a consequence, with Viktor Orban pulling out of this, it has upset very greatly all the other European leaders, not just on the principle of not supporting Ukraine, but on the fact that it reduces the credibility of the European Union. Have a listen to the European Council President, Antonio Costa, who's generally a fairly sort of jovial and soft-spoken figure.
The leaders take the floor to clearly condemn the attitude from Viktor Orban, to remember that once a deal is a deal, and all the leaders need to honor their word. And nobody can blackmail the European Council. Nobody can blackmail the European Union institutions. And we need to deliver on this.
I think the word of the summit was blackmail. Viktor Orban used it there. You heard it from Antonio Costa. We heard from Chancellor Merz from Germany saying this is a gross violation of loyalty and it damages the reputation of the EU as a whole. I should say, though, Vani, this picture would not be whole without the political backdrop here. There is an election in Hungary on April the 12th. Viktor Orban is behind by double-digit percentage points. If he acts strong on Ukraine, he's also hoping that is going to help him domestically. And as for the other 26 members sitting around that table, many of them are hoping that that is the last time Viktor Orban will be sitting there, which is a distinct possibility.
All right, Oliver, thank you so much. That's Bloomberg's Oliver Crook, our chief Europe correspondent. Just want to bring you some lines now from the Latvian central bank governor, also governing council member on the ECB, Martin Kazaks. He's saying we know inflation will go up and the economy will slow. Energy shock, though, is not as big as what we saw back in 2022, and the ECB will take stock in April. So that is the current stance from Martin Kazaks, ECB Governing Council member, Latvia Central Bank Governor. The ECB will take stock in April. The energy shock is not as big as what we saw in 2022, though inflation will go up and the economy will slow. Coming up, an awkward moment in the Oval Office as Trump invokes Pearl Harbor in front of the Japanese Prime Minister. That's next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? You know, he's asking me, do you believe in surprise? I think much more so than us.
President Trump apparently joking about Pearl Harbor during his meeting with the Japanese Prime Minister at the White House. That awkward moment perhaps underscoring the tensions that are simmering over President Trump's push for Japanese assistance in reopening the Strait of Hormuz. Sidestepping pressure from President Trump, Takaichi said she reminded him about the legal restrictions on Japanese military deployment.
And speaking of the situation in Iran, Iran's development of nuclear weapons must never be allowed. And that is why we, Japan, have been urging them and also reaching out to other partners in the world. In addition, Japan condemns Iran's actions, such as attacking the neighboring region and also the de facto or effective closure of the Strait of Hormuz.
Let's bring in Bloomberg's North Asia Economy and Government Managing Editor, Jenny Marsh. Jenny, the visit was bound to be fraud, but what were your key takeaways?
I think the main takeaway is that Takaichi has enough sort of political capital with Trump to sort of ride this out. You know, going into the trip, she herself had said this is going to be an extremely difficult visit because of Trump's request that Japan send warships into the Strait of Hormuz. You know, and she managed to sort of glide through that and really have personal relationship with him here was sort of on show. You know, she came into power with very little foreign policy experience, and she's shown that actually she's a bit of a natural on the world stage. She was clearly visibly shocked by his comment on Pearl Harbor, and you saw her sort of recoil a bit, but, you know, she kept on smiling politely. She didn't respond to that, and she just sort of, you know, kept to her strategy, which was to think about the trade and the investment deals they could do, and to flatter Trump as well. You know, she's learned that the way to Trump's heart is sort of through his ego.
Yeah, as many leaders have. Now, the visit was also supposed to be an opportunity to strengthen economic ties, the two leaders announcing a nuclear power project. Tell us a little more.
That's right. So this is all part of the big sort of $550 billion investment fund established last year as part of their trade truce. So we saw there was the nuclear reactors. This came along with some natural gas generation facilities they've agreed on. And Japan also said that it would step up production of the interceptor missiles that it makes and supplies the US with, which are now obviously in very high demand due to the war in Iran. So Japan sort of showing there that it can help the US in sort of diversifying its energy supplies, but also as sort of, it can't send warships, but it can be helpful as a military partner in other ways, specifically sort of supplying some of this military hardware that the US needs right now.
Jenny, thank you so much for all the context. Much appreciated. That is Bloomberg's Jenny Marsh. Coming up, the U.S. Defense Secretary says it takes money to kill bad guys as the Pentagon seeks $200 billion for the war in Iran. More on that next. This is Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Daybreak Europe. Dubai has long sold itself as a safe haven in the Middle East, but Iran's unprecedented strikes on U.S. partners across the region are putting that reputation under pressure. Bloomberg Originals has been looking at how Dubai's model of stability is being challenged.
These attacks were unprecedented. We could not have imagined this scenario actually playing out.
Most airports and airlines in the region are affected.
Drone has hit a residential tower overnight in Dubai. It sparked a fire and residents were forced to evacuate the building.
This conflict has come to the doorstep of a territory that many perceived to be one of the world's top safe haven territories.
That perception was by design and helped attract both money and talent. The strikes threaten more than lives and infrastructure. They're testing Dubai's model of stability and the image it wants to project.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead. We've already won in many ways, but we haven't won enough.
Thousands of deaths across the region have been reported in the war begun by the US and Israel. Iran's wave of retaliatory strikes targeted US allies, prompting the UAE to prioritize safety above all else.
Iranian strikes have hit airports, military bases, even data centers.
The UAE has seemingly defied what many assumed would be an existential threat. It's navigated peril before, but with war on its doorstep, can it do it again?
Subscribers can watch that documentary in full on the terminal and at Bloomberg.com. You can also find more from Bloomberg Originals on their YouTube channel. Now to some other top stories we're following this morning. Bloomberg understands that the Pentagon has asked Congress for an extra $200 billion to fund the war in Iran. Sources say the request has been sent to the White House for review, and President Trump is yet to sign it off. When asked about the $200 billion figure, the U.S. Defense Secretary didn't deny it, but did say the number could move.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys. So we're going back to Congress and our folks there to ensure that we're properly funded for what's been done, for what we may have to do in the future.
Sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jerome Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony Powell gave to the Senate. Jess Staley's wife has filed for divorce from the former Barclays chief executive, who was banned from the UK financial industry over his relationship with Jeffrey Epstein. Deborah Staley's divorce filing comes after Jess Staley publicly testified about being unfaithful to her years earlier with one of Epstein's staffers. A lawyer who's recently represented Staley didn't respond to requests for comment. Coming up, the European Central Bank keeps rates on hold, but could they hike as soon as their next meeting? We'll discuss with Swiss Re chief economist Charlotte Muller next. This is Bloomberg.
you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Live from London, this is Bloomberg Daybreak Europe. I'm Bonnie Quinn with your top stories. Oil easing after its highest close in more than 3.5 years as Israel says it won't attack Iranian energy facilities. And President Trump says he's, quote, not putting troops anywhere. Stocks fluctuate and bonds slide as traders weigh the potential economic impact of a protracted conflict in the Middle East. Plus, the European Union deadlocked over a €90 billion loan for Ukraine as the Hungarian Prime Minister refuses to budge. So let's take a look at those commodities then, because we are seeing a little bit of easing in this market. Brent crude, though, still above $107 a barrel. It's most obvious in WTI, where we're at about $94 a barrel. Haven't come off hugely, but at the height yesterday, we were at around 116, 118 on Brent. So there is, a $10 coming out of that market there. But at that being said, there are still attacks going on, and we have to see how the situation develops. We are seeing a little bit into the US dollar. We saw some strengthening in the yen after some of these central banks turned quite hawkish. The ECB is now seeing an average inflation data figure of 6.5% in the worst case scenario for this year. So that'll tell you just how much central banks are keeping an eye on this situation. In terms of futures, we were seeing a potential for a higher open. That's come off the boil a little bit. Europe looks to be opening higher, the US not so much. Gold, as you can see, has turned around. It was on track for its worst week in 6 weeks, and it's now higher again. Copper higher again, and silver really coming off the boil, down about 0.8%. Time now for your front page news, all dominated by the Middle East. The Financial Times leads on Israeli Prime Minister Netanyahu claiming that US-Israel strikes have destroyed Iran's ability to enrich uranium. The Israeli Prime Minister is suggesting that war will end, quote, a lot faster than people think. The Wall Street Journal splashes on US warplanes and helicopters kicking off the battle to reopen the Strait of Hormuz. Efforts taking on a new urgency to reopen the key waterway as oil prices soar. And finally, Les Echos also leading on the Iran conflict, saying US President Trump is shifting the blame to Israel as the conflict escalates. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayBgo. All right, I want to give you some lines now from ECB Governing Council members which have been crossing the terminal. We've heard from at least 3 this morning, and the latest is Joachim Nagel. He's saying we would need an April hike if the price outlook sours. This is Joachim Nagel speaking in the last few minutes. He's saying the 2022 experiences will play an important role, and the development of the conflict will have a major price implication. We've heard this from several ECB Governing Council members just in the last hour. Martin Kazaks of Latvia also saying they're keeping a huge eye on the escalation and the supply shock. Once again, Joachim Nagel saying that there would need to be an April hike if the price outlook sours. All right, well, we heard something similar from Christine Lagarde, if maybe just a little bit more guarded at yesterday's news conference. Certainly all eyes on the oil price. Take a listen to what she had to say.
The risks to the inflation outlook are tilted to the upside, especially in the near term. A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices than currently expected, raising euro area inflation further.
We're joined now by Charlotte Muller, Chief Europe Economist at Swiss Re. How serious is the situation, Charlotte, now that we have, Joachim Nagel actually coming out and saying, look, we will see an April hike if this really does feed into inflation?
Good morning. So our baseline going into this year was that we weren't expecting any hikes from the ECB. However, now naturally this conflict does raise risks for ECB rate hikes. In terms of the sequencing, it all is very conditional, and it depends really on the severity and also duration of the energy shock. But I think what they're also looking for are several other signposts. It's also, number one, inflation expectations. So how quickly do you potentially also see the resetting of price expectations? Number two, it's also looking at labor markets. For example, the bargaining power of labor, could that lead to second round effects? It's also looking at margin pricing power, and also the fiscal policy response too is, I think, key, because that will also affect, maybe distort or keep inflation expectations not as high in the near term if you have fiscal intervention, but in the longer term it could add to inflation pressures. So for the ECB, I think the April meeting is live, but it's still too early to say if it's a definite case that they would be hiking. But if they wait until June, there is a risk they're a bit too late, and they don't want to repeat the mistakes potentially from 2022.
Yeah, although we did hear from Martin Kazaks today saying that it wasn't quite as bad as 2022. It's not the same type of situation, although lessons, have been learned. Curious, Charlotte, if the damage has already been done. So we are seeing what could be a de-escalation on both sides. We'll have to see if that actually plays out. But if we were to see oil prices come down now, would that take April off the table as a necessity?
So that could take off potentially April, but I don't think that will take away the pricing of potential rate hikes for later this year. So yes, on one hand, we are in a different situation to 2022 where we don't have the reopening dynamics post-COVID lockdowns that could amplify inflation risks, right? In 2022, we had much more tight labor markets, much more stimulus in the system. So that could potentially, that was amplifying inflation risks back in 2022. That said, there will be a geopolitical risk premium in energy prices. They will be trading higher. And regardless, even if you do have energy prices a bit lower, inflation is going to be printing much higher for March. We expect potentially 2.5%, and it will lift full-year inflation expectations.
Yeah, and the expectations are key. Charlotte, right now the ECB, in a worst-case scenario, sees inflation peaking in the first quarter of next year at 6.3%. I mean, the ECB can't let that happen, can it?
No, and that also speaks for them wanting to probably act early and not wait too late. So I think, therefore, definitely the expectations of rate hikes for the rest of this year, that will be staying in markets. I think if I look there at the severe cases that the ECB published yesterday, their inflation assumption looks reasonable. Where I would say actually maybe where I would disagree is on their growth assumption. So they had only 0.4% for GDP growth in their adverse scenario. And I think you could have actually growth much more severe because at higher also oil prices, you have increasing non-linear effects on economic activity, and then the economic hit could be much greater too. So then really a stagflation environment.
And they're penciling in, oil above $80, but not that far above $80 as an average for this year. So, oil would have to come down a lot to meet that average. So are you particularly worried about demand destruction then, more so even than inflation potentially?
I think you need to have oil prices even much more elevated for much more longer to really see that demand destruction. So as a result, I would say we're still seeing a much more asymmetric shock with a greater hit to inflation, at least initially, than to growth or demand, at least in the very near term. So at the moment, the main concern for the ECB is still inflation, and that's why we think rate hikes are going to stay still on the table for this year.
Charlotte, what economies could weather this best in Europe?
So it really depends on the energy mix. One example could be France, because they're also much more diversified in their energy mix, for example, with more nuclear. The issue at the moment is energy prices, they're global, right? So even if a lot of, say, also the LNG goes to Asia, Europe will be competing with Asia to get that LNG gas. So then it's about looking at potential other sources of energy, and there I think France is better mixed or better suited than, say, other countries that are more dependent on LNG or traditional fossil fuels.
Charlotte, thank you so much for joining us today. Really appreciate your time. That is Charlotte Muller, European Chief Economist at Swiss Re. The Swiss National Bank has restated its heightened readiness to sell the franc as officials held back again from the more drastic step of cutting borrowing costs into negative territory. Policymakers left their benchmark at 0 for the third consecutive meeting. President Martin Schlegel told us the SNB is using a range of indicators to judge whether the franc has strengthened too far.
This is something that we look at on a holistic approach. So we'll look at the Swiss franc, all the exchange rates, basically, and also then on monetary conditions, which consist of interest rate environment and the exchange rates. And based on this, we say if the monetary conditions are appropriate for Switzerland or not.
Coming up, the Bank of England holds rates but warns of possible hikes to come. We'll discuss the outlook next. This is Bloomberg.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
President Trump and the conflict in the Middle East are now determining monetary policy in the United Kingdom. That's effectively the assessment of the Bank of England, which warned that Britons will be paying the price. Governor Andrew Bailey said the bank's latest decision to hold interest rates at 3.75% was because of exceptional market conditions.
This is a very volatile situation. I think by the next time we meet, which will be, our next decision is at the end of April, a lot will have happened, and I can't predict what. I can't possibly, none of us can predict what it will be. But it is a very volatile situation. So I would caution, really, against getting ahead of that position, which is we held this time.
Let's bring in Tanika Fricke, head of UK equity research at W1M. Tanika, how surprised were you yesterday by just how hawkish the governor sounded and that 40 basis point move in the 2-year gilt?
Yes, no, clearly geopolitics had taken over the Bank of England decision-making, but expectations were still for maybe 7-2 kind of split, but it was all 9-0 for hold. But yes, inflation is a big risk, and whilst sort of UK households will be protected through a price cap on their electricity bills until July, clearly gas futures are pointing to a much higher price to be paid from July if things don't change. So very volatile and uncertain.
You actually point out that the contracts that feed into Ofgem's price cap for July to September are actually 35 to 40% higher. Could that come down, and could it come down speedily?
Yes. So volatility is the name of the game. So it's really about the European gas price that's so important. And what we saw yesterday when we had the bombing or the attacks on the Qatar energy facilities, that initially European gas price spiked up 25%. In the end, it closed down 10. So anything can happen, but it needs to happen sooner than later, because we will hear from Ofgem the end of May about what was going to happen in July.
How can monetary policy help if that's the situation, if it's energy prices? Will interest rate hikes, and potentially even 3 of them this year, will that not just cripple the economy?
They won't help, because clearly this is a global price issue where commodity prices just feed into the whole system, and what happens to interest rate can't slow that down. But still, monetary committees around the world have this inflation target, and they need to act on that. That's their mandate.
Tineke, is there a hope that just by putting it out there that will impact inflation expectations, and that might do the job for the Bank of England?
I don't think so. I think ultimately the hope is, what we all hope, that this conflict will be relatively short, and that the supply of oil and gas will not have as major a negative impact as we fear.
So a new forecast from Morgan Stanley seeing a 4% LNG supply shortfall in 2026 just on Qatar alone. Now, that doesn't sound too bad, 4%, right? I mean, yes, the marginal buyer will have big problems, but more buyers are turning to the US. Is there any possibility that even for Europe, the US could fill some of this shortfall?
Yes, I mean, we shouldn't forget that when we started the year, we thought that liquid natural gas would be in oversupply, that oil would be in oversupply. So we came in thinking there would be lower prices. So clearly some of the supply has been damaged, but it is manageable. There have been some releases of oil reserves in various parts of the world. It all depends what else gets damaged, and it does take a while. So this 3 to 4% might take 3 to 5 years to get back, because facilities need to be fixed.
Yeah, that's for sure. What is the number one question you're getting at W1M? What's the number one concern?
So ultimately, our clients, obviously no one knows. They wish to know what we are doing, how their money is invested. And generally, the way we invest money is that we invest in companies that have good pricing power. So clearly, when inflation is an issue, we want companies to be able to continue to thrive in that situation.
And, what's been a little bit surprising, I think, about this is that even, in the US here, benchmarks are not that far off where they were before this war. So you've seen massive moves in treasuries, massive moves in gilts, massive moves in global bond markets and oil markets. Would you stay invested in equities here?
I mean, I think that's a really good point, because I do think that what equity markets are telling us is that it's probably a manageable situation. The overall index masks big swings, right? Because certain companies have done okay and others have really plummeted. But overall, the equity market is not pricing in an Armageddon scenario.
No, and perhaps the worst of the danger has passed, or at least that's the hope this Friday. Tineke, thank you so much for joining us in studio. In particular, Tineke Fricke is head of UK equity research at W1M. Now to some corporate news. Bloomberg has learned Goldman Sachs and JP Morgan are among investment banks offering hedge fund clients ways to bet against the $1.8 trillion private credit market. We're told the firms have assembled baskets of listed companies with exposure to the space, which has been facing pressure from a wave of investor redemptions. Bloomberg understands that Unilever is in talks to sell its food business to McCormick, an American spices and seasonings maker. Sources say a deal could come together by the end of this month. It follows Bloomberg reporting earlier this week that Unilever was considering spinning off its food business. Alibaba shares slumping after it reported third-quarter sales that missed estimates. Sluggish growth in its core e-commerce business dragged on earnings, while intensified competition in food delivery also crimped profits. Alibaba's cloud and AI units saw the fastest growth. The company says it aims to quintuple revenue from those businesses in 5 years to $100 billion annually. The deadline for U.S. taxpayers to file their return is just weeks away, whether they live in New York, London or Paris. But accountants may find their work drying up this year as AI chatbots improve, close to the point of being able to navigate the U.S. tax system. Let's get more from Bloomberg's Charlie Wells. So, Charlie, that's quite the claim. The U.S. tax system is particularly complex, I would say. Are they really, these chatbots, able to work it all out?
People are starting to make inroads here. And what I would say is if you walk around Bank Station or Canary Wharf after market close today and say April 15th, a lot of these traders, a lot of these bankers who are U.S. people who have to file their taxes wherever they reside are going to look at you and tell you the only thing worse than paying my taxes is filing them. Because as you say, the system is really complex. There's a lot of different rules. And a lot of these really highly paid people pay accountants to help them prepare their taxes. Their accountants turn around and say, okay, here's all the stuff you need to get for me. And so these really busy people have to fill out their taxes, do a lot of this work. And so they're starting to use AI to help get a lot of these PDFs, get a lot of this information organized for their accountants. That's one of the use cases that I really came across in reporting this story.
And of course, we saw a huge sell-off in some of these names that prepare your taxes for you in recent weeks as that sell-off from AI started spreading. But surely it could be dangerous in this environment too.
So this is the question, right? So that SaaSpocalypse, this issue that maybe some of these big tax software companies, could be replaced by AI. And I think that some of these stories are use cases of using AI instead of, say, Intuit or H&R Block products. They control 80% of the U.S. tax software market. But as you say, there are risks here. And we spoke to over a dozen tax professionals, tax preparers, and they said that, look, just because you're using computer code, it doesn't mean that the tax code is going to overlay on that easily. A lot of these, AI LLMs, they hallucinate. They aren't up to date. So there have been major changes to the U.S. tax code over the past year, and some of these LLMs just aren't up to date yet.
Well, and the other thing is you don't want to raise red flags, right? So are you willing to have the AI do your work for you and chance that red flags might be raised and it wasn't even your intention? What are you hearing from people that have prepared their taxes this way?
This is another main concern, right? What is the recourse if one of these models gets something wrong, right? There's not a lot of history here. And as you say, the IRS is, razor focused on this issue because they know that this is out there right now and that people could be doing it. If you get audited, the last thing you want to say to a federal official is, oh, I just had AI do this, right? So accountants really are urging caution here. But again, I spoke with an accountant yesterday who said, oh, we use AI at my firm, and it's making my junior staffers more efficient. And so I think this is a nuanced story, right? It's something where this is helping professionals in the space. This is helping very busy professionals at bank or at Canary Wharf who don't want to spend their weekend downloading PDFs, downloading bank statements. So it can be helpful, but you have to know the limitations. I think that's the key that I picked up in talking to a lot of these people.
Charlie, have you filed your taxes?
No comment. No comment.
I am not going to ask you a second time. Bloomberg's Charlie Wells, and I would urge everyone to read the story. It is a fascinating and funny read. Plenty more coming up. This is Bloomberg.
a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
The risks to the growth outlook are tilted to the downside, especially in the near term. The war in the Middle East is a downside risk to the euro area economy, adding to the volatile global policy environment. A prolonged war could increase energy prices further and for longer than currently expected.
The ECB President Christine Lagarde, and that is a sentiment that's been reflected across the central banks, and you can see it in this picture because this is how markets reacted. Pricing in 2 to 3 hikes now for the Bank of England and the ECB after those comments. Just this year, mind you, pricing out any hikes from the Federal Reserve and obviously cuts as well. We'll see how this progresses. It all depends on duration. We've had a lot of ECB speak just this morning alone. One of the speakers, Thomas Nagel, saying that there actually might be a hike in April if things continue this way. Let's move on because we have also the idea that oil prices and these interest rate hikes might actually crimp growth, and that's being reflected in the swaps market. And then investor sentiment is also really troughing at this point, even though we haven't seen stocks come off a huge amount, but we're at levels last seen in May of 2025. So at least a year. All right, your risk events for today. At 7 a.m. we get UK public sector finances data. And then, of course, today is triple witching, so watch for that last hour of trading. It could be a lively one. At 5:30 p.m. we also get the ECB's Nagel speaking again, so we'll see what else he has to say after a day's trading. Coming up, an exclusive interview with the president of Cyprus. That's in about a half hour's time, so do stay tuned for that. The opening trade is up next. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Good morning. It's Friday, March 20th. Here is what is on the agenda. Oil prices drop on US and Israeli reassurance. Short-end government bonds in focus on inflation concerns. And European leaders are getting anxious.
So, another day and another focus on the oil markets, of course. But today, a slightly different reaction function. Down 0.4% on Brent at 108, having crossed about $113 per barrel yesterday. So a little bit more reprieve on oil, at least for now. Let's see how temporary or sustained that is as both Israel and the US come out and try and reassure around the oil markets after the infrastructure attacks we've seen this week. Gold currently up 0.5%, but interestingly still on track potentially for its worst week in about 6 years, the yellow metal, and precisely to Anna's points, as traders start to bet in higher interest rates, higher for longer, and of course that detracts from the yellow metal. European futures pointed to gains of 0.5% after losses of almost 2.5% yesterday. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's just gone 7 o'clock here in London. Friday, the 20th of March. Friday, Tom. It has been an incredible week when it comes to volatility in markets, in particular in energy markets. This time yesterday, we were watching as gas prices flew out the gates, more than 20% to the upside. Today looks different. Today we have energy prices in retreat, not by a huge amount compared to yesterday's close, but the downward trajectory is interesting. And it comes in the context of US and Israeli reassurances. That's been the attempt. President Trump talking about not putting troops on the ground, also talking about this being over soon. President Netanyahu saying he's going to refrain from any attacks on the Iranian energy facilities. And all of that adds up to a little bit of weakness, at least at the margin, for these energy markets.
It is at the margin. European gas prices right now down 2.2% after the pop of, 30% or so yesterday, 20 to 30% on European gas. So we're seeing a modest downside pressure in terms of gas today. And to your point, Brent and WTI also slightly softer. The time frame is really interesting because, to your point, the Israeli Prime Minister said this could be over quicker than many people expect. President Trump has outlined a window of between 4 to 6 weeks. But the costs are already mounting. Yeah. Qatar Energy says that their facilities, part of their facilities, could be out for up to 5 years at a cost of $20 billion per year. Would have supplied. So 17% of the LNG taken out as a result of that infrastructure hit. 5 years, potentially. You have the US, you have the Pentagon going to Congress and saying we need an additional $200 billion to continue to fund this war. Does that suggest that, in fact, they're gearing for a longer conflict? We don't know. But the costs are coming through, and certainly policymakers, whether it's the ECB or European leaders, are starting to react to this.
Yeah, absolutely. And it is interesting. You raised that point about the Pentagon and the Department of Defense in the States going to asking for more money from Congress. And, how do we square that with President Trump saying that this will be over soon? They seem to perhaps point in different directions, or maybe one's just a contingency. In the meantime, we are continuing to ask questions. We've been doing this for weeks around 2022 comparisons. And from a European perspective, that's really important because 2022 was so painful economically. Politically, it set off all kinds of big shifts, geopolitical tectonic plates were on the move as a result of this. So what's really interesting is that oil prices have started to look like 2022, and the surge has been more than 2022 now. But gas prices haven't, and that probably from a European perspective still matters. Some comfort at the margin.
And there are those who are pointing out, including Javier Blas of Bloomberg Opinion, that we need to be focusing less on Brent and more on refined goods like diesel and jet fuel. And Europe is particularly vulnerable on that front. So really interesting when we hear from the ECB, and certainly they'll be looking at that 2022 playbook, Christine Lagarde saying we are in a better place. Rates are at 2%. They kept it on hold. Joachim Nagel in the last 30 minutes or so, of course, on the whole end of the spectrum from the German central bank, the Bundesbank, saying that April could be in play in terms of a rate hike from the ECB if the conditions continue to sour. But this was a hawkish pivot from the ECB yesterday, and it was a hawkish pivot from the BOE as well.
Absolutely, and this had global ramifications. It didn't play out to the States over the Atlantic as much as it did in Europe, as you might expect, but it certainly had a big impact on European bond markets. Gilt markets, if we look at what was happening at the short end of the curve across Europe, but particularly on gilts, up by 30 basis points on the 2-year in yesterday's session. BTP's up by 16 basis points. This was a really sharp repricing, even though we'd already repriced to some degree around the UK story. We'd taken out the expectation that we were going to get cuts, and suddenly the market went crazy, pricing in hikes. The Bank of England is suggesting that maybe the market got over its skis a little bit, and actually a number of the notes I was reading this morning suggest maybe something similar. So Berenberg saying it doesn't mean we're going to get a hike next, just means we're on a pause right now. I mean, we're leaning towards a hike maybe in the market's eyes, but you know, let's steady on is what the message from Berenberg seems to be. BMO saying, look, that the BOE's actually less hawkish than the sum of its parts. So for the first time, actually, or for I think nearly the first time, we got all the detailed commentary from all the individual voices at the Bank of England, and that added up to a lot of very hawkish language. But BMO suggesting that actually at the top level they're not quite as hawkish as some of those lines suggest. So once again, we are focused on higher energy prices, higher inflation expectations, and what that does to the front end of European bond markets.
It seems to be that there's a split between the economists and the traders on this front. Traders pricing in more than 2 hikes from the Bank of England. Our own in-house economists think they stay on hold, which underscores your point. But just to reflect and take a step back, we've gone in the last 3 weeks from pricing in 2 cuts from the BOE to potentially three hikes. The ECB, interestingly, coming out with a forecast on inflation, 2.6%, but they suggest that if this is a prolonged conflict, you could get above 6% on inflation. Above 6% is what they're forecasting if this is prolonged.
That's in their sort of really stressed scenario, isn't it? And important to say, as you say, that's not their base case. It also assumes no policy response. So it assumes nobody does anything to try and bring down that inflation. But it certainly, you know, it got the headlines, it got the focus. If central banks in Europe yesterday had been trying to express seriousness and a focus on inflation, then they certainly did that, and the market was listening, and then some.
EU leaders as well. So you have the central bank governors. So what are the policy tools that the EU leaders could be reaching for? Because this was central to the discussion yesterday as well.
Yeah, absolutely. And this is the context in which those European leaders are meeting. They've got higher energy prices, higher yields, inflation concerns back on the agenda, and stockpiles are less than they would averagely be at this time of year for Europe. So that does have a focus to it. It does bring a focus of mind. I mean, it's not cold, so that's, you know, one good thing, but certainly there is anxiety amongst European leaders, and that's certainly what we saw being expressed. It's a reminder, you know, these are some of the same leaders who went through 2022 and had to steer their economies through that huge spike in gas prices, and even though we lack the parallels, it is something that they are increasingly focused on. What I thought was also interesting is in a side meeting to what was happening in Brussels, there was a report issued where the Brussels sort of economic community saying, well, we're worrying about prices, but we're actually also worrying about supply. And that goes back to the point you were talking about. We're worrying about jet fuel, we're worrying about diesel, and where that takes us.
And the fiscal space is that much more narrow because of that spike in bond yields. And so the tools they have at their disposal, potentially including tax cuts on things like electricity bills, but that, of course, would lead to a fiscal hit. There's also some discussion, so 10 EU nations, including Italy and Poland, putting some pressure on the EU to change the emissions trading system, which puts a cost on carbon. That's not unanimous, but it is 10 nations. So those are some of the tools they're looking at, but all of them seem to come with some cost. Here in the UK, you're getting voices on the right saying drill, baby, drill. Over in Spain, they're saying let's focus on renewables. This is a reminder we know that our own domestic supplies, and we should use wind and solar. And that was the line from the Spanish Prime Minister yesterday.
Yeah, we will talk to BNEF a little bit later on in the programme about just that, the energy mix, implications of all of this. Let's tell you about some of the great conversations we have coming up on the programme. Nikos Christodoulidis Kossidis is the president of Cyprus, will be talking to Oliver Crook this morning. Really interested in the context of all of the stresses and strains that Europe is under right now, but also with the added dimension of the role that Cyprus plays for the UK military story. So we'll get his perspective there. Karim Chadid will be joining us from BlackRock, EMEA Investment Strategy. We've had a lot to say about gold recently. What's his view? We've heard a lot about gold. What's his view? Robert Stager will be with us, World Trade Organization chief economist. They put out a forecast, really interesting, about how global trade performs in the context of what's happening in the Persian Gulf. And Harriet Rees will be with us from Starling, the chief information officer there, with something to say about AI in banking, but a broader conversation about the use of AI in the UK as well.
Here's what else you need to know this Friday morning. Sources have told Bloomberg that President Trump and top Justice Department officials support a new bid to investigate Fed Chair Jerome Powell. Last week, a judge rejected subpoenas issued to the central bank, which prompted U.S. Attorney Jeanine Pirro to say she would appeal the decision. The investigation is related to the Fed's $2.5 billion renovation of its headquarters and testimony that Powell gave to the Senate. Powell has denied the allegations, calling the investigation a pretext for pressuring the Fed to lower rates. President Trump joked about Pearl Harbor during his meeting with the Japanese Prime Minister at the White House. Trump offered the retort after he was asked by a reporter why the U.S. had not informed allies in advance of his strike on Iran.
When we go in, we went in very hard, and we didn't tell anybody about it because we wanted surprise. Who knows better about surprise than Japan? Okay? Why didn't you tell me about Pearl Harbor? Okay? Right? You know, he's asking me, do you believe in surprise? I think much more so than us.
Alibaba and Tencent lost about $66 billion of market value in roughly 24 hours after the market punished the Chinese tech leaders for failing to lay out clear visions for how to profit from AI. Investors who had piled into the sector's biggest names over the past week, betting the advent of open claw-style AI agents would galvanize the industry, reversed course after Alibaba posted disappointing results with no clear path to monetization in sight.
Let's tell you what's coming up on the programme then. The consumer goods giant Unilever has confirmed just this morning it is in talks with McCormick of the United States after receiving an offer for its food business. It also says it's confident that this business could do well within Unilever, so we will get to that and the detail there. Plus, with natural gas prices spiking and LNG, a potential shortage of LNG on the horizon, we look at the implications for European energy markets. Up next, we will speak to Ule Hansen, who's the head of commodity strategy at Saxo Bank. Oil in focus, the Straits of Hormuz certainly in focus, and gas and gold, all of that in the mix. If you want to get involved in any of these conversations, IB plus BBT Vigo is the function on the Bloomberg terminal. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersetchi in Davos, Switzerland, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Talked to Prime Minister Netanyahu about attacking the oil and gas fields.
Yeah, I did. I told him don't do that, and he won't do that. We didn't discuss. You know, we do. We're independent. We get along great. It's coordinated, but on occasion he'll do something, and if I don't like it, and so we're not doing that anymore.
President Trump talking there about the Middle East and the attacks on energy infrastructure, of course. Oil has declined after those comments from President Trump and also those from Benjamin Netanyahu of Israel, who also sought to ease concerns, at least from an energy perspective, vowing not to carry out any further strikes on Iranian energy facilities. Let's speak now to Bloomberg's Jumana Basechi, who's in Dubai. Jumana, President Trump and Netanyahu both then trying to de-escalate with that language around not hitting energy infrastructure. How is that being reflected on the ground?
Yeah, Anna, I'm going to rephrase part of that statement to trying to de-escalate part of the war. And specifically, you know, if we go back to the comments that were made by President Trump and Israeli Prime Minister overnight, President Trump still trying to distance himself from those airstrikes that Israel conducted on that Iranian gas field. And then yesterday in the press conference, Israeli Prime Minister did say that they acted alone and that on the U.S.'s request, they will no longer target energy infrastructure. So those are the statements that came through. I should also say that the Iranian Foreign Minister Abbas actually put up a post saying that if their infrastructure gets hit one more time, they will show zero restraint, and that the retaliation so far has showcased just a limited part of their firepower. So still warnings coming through from Iran. So yes, an attempt perhaps to de-intensify one part of the war, but at the same time, the strikes and the counterstrikes continue throughout the course of the evening. IDF reporting massive airstrikes throughout central Tehran. It is the first day of the Eid for most countries in the region. The first day of the new year also for Iran, so a holiday, something to bear in mind too, but that hasn't let up the intensity. Iran have also been retaliating. We're just hearing this morning of another refinery strike that was targeted in Kuwait. We've heard of more interceptions coming through from Saudi Arabia in the eastern part of the country, in the northern part of the country. Over here in Dubai, once again, we had missile alert texts coming to us on our phones, the residents this morning, more interceptions overnight. And I think, you know, from the perspective of everything that has happened over the last 24 hours, there probably has been a little bit too much emphasis on the flow of strikes as opposed to the stock, the full stock of what has happened. Qatar Energy putting up that communique in the middle of the night suggesting that 17% of their capacity is now going to be taken off the market. It's going to take them years to recover from some of the damage that was sustained. You have two major gas fields in the UAE that were also taken offline. Continual hits at these refineries or targets at these refineries, which means that many of them have halted production. That accounts to about 2.5 million barrels a day. So in aggregate, there have been multiple strikes still at key energy infrastructure spots in the Middle East. And this is something that the region and the world are going to have to grapple with, not just for days, for as long as the conflict goes on, but even should the conflict or the war end tomorrow, possibly months and even years after that.
Jumana, thank you with that important update. Again, live, of course, from Dubai. Jumana Pasechi with that context and with that detail. Let's bring in Ole Hansen now, Head of Commodity Strategy at Saxo Bank. And Ole, good morning. I'll start with the picture that Jumana was outlining for us, which is a picture not just of supply constraint in the energy markets, but supply actually being taken off the table. Is crude pricing in that reality?
Good morning, Tom. I've struggled to see that we actually are, because this basically just all points to higher for longer. Even if there was a ceasefire tomorrow and the strait was reopened, we're hearing about these damages to infrastructure. We're also seeing shut-ins from wells that cannot just like turning on a tap in your kitchen. It will take time to get that supply back. So higher for longer seems to be the risk right now. And the question is, as you say, does a Brent crude price here just above $100 really reflect that properly? It may do, because obviously we at the same time seen this massive divergence in between refined products and Brent. So obviously the refineries are trying to get as much crude they can, but they're also obviously reaping very high rewards because the product market is as tight as it is, and that's really where we should continue to focus to get any sense of what the economic impact will be of this.
Where can the world turn to get those refined products now that much of that is shut out of the Middle East?
Well, that is a big question. Probably not really anywhere. I would say maybe apart from Russia, but that will make some. That will trigger some additional changes. Because right now, we all know that the barrels that comes out of the ground in the Middle East is perfect for the middle distillates. That's really what we're missing right now. We cannot get that from the U.S., which is mostly gasoline. So we are incredibly dependent on the Middle East for this source of supply. Not only for the raw, for the crude oil, but clearly also for the refined products, which with the Middle East having become increasingly a refinery hub in the last decade.
Uli, you mentioned Russia. The US has obviously changed its sanction stance on Russia, at least in the short term, and in a very specific way related to the energy or the product that is on the water. We're now seeing a wider drawdown of some of that product that has been floating around on the water for quite a while. Are you factoring in a change in European stance with regards to Russia, or is that just a step too far, do you think?
I think that would be a step too far right now, but even the removal, potentially, well, temporary removal of sanctions, is really just putting a small band-aid on a massive wound. It's not really going to heal anything. It may just ease a little bit of the tightness, but luckily we can say we came into this conflict with a massive amount of crude oil stored at sea, which can be shipped around, and we're seeing those inventories starting to come down. We're just waiting for the next weekly update, which you guys will put out sometime this morning from Vortexa, but that has helped alleviate some of the initial pressure. But as those barrels start to come onshore and be refined, then the question is really where are we going to find the next barrel from if this $10 million barrel a day disruption continues.
Yeah, we'll look for that then, Ole, that data on drawdown on the water. Can I ask about Brent versus WTI? Just in the last few days, we seem to have seen more of a divergence. It was certainly a story of yesterday. Then the White House said that they have no plans to stop exports of oil and gas. They said that would damage their producers. Are you factoring in a big divergence between these benchmarks?
Well, I would not have thought that we were at some point yesterday. We almost saw a $20 discrepancy between the two, really reflecting a market or a WTI market that had become dislocated to a certain extent. But at the same time, when we look at the refined products in the US, they did not indicate this big divergence. So obviously, once a crude oil barrel has been refined, it's just like gas. It's seeking the highest bidder, and that basically means that refined products will exit the US, and I think rightfully so. An export ban would equally hurt the US. So that seems to be off the table, and that is the reason why we're back down to around the $10 spread. But it's still elevated. But that's also to a certain extent reflecting the time it takes to transport, and also the quality of the US crude compared to the one in the North Sea, but especially in the Middle East.
Ole, when do you think crude does start reflecting the energy that's been taken off the table at this point? And are we getting closer to a point of demand destruction on prices?
We're probably not there yet, at least in the Western world. We are seeing destruction already starting to emerge in Asia, and that clearly is the hotspot for this crisis for now, because that's Asia has been the main buyer of Middle Eastern crude. But if the crude, as we start to see these inventory levels being brought down and the tightness starts to emerge in the crude prices, then clearly it will have to be reflected in the price to go higher, and we are ultimately, if this war drags on and the barrels doesn't come back to the market, normally we're sitting here discussing disruption to the tune of a few 100,000 barrels impacting price. We are looking at a daily loss of 10 million barrels, so it will have an impact. And obviously we don't want to get to a 2022 situation like we had in Europe, where gas prices surged to the level that we simply had to kill demand in order to balance the book. That is not where we are right now, but that is clearly the risk if this continues and drags on for too long.
Okay, yeah, let me ask you about those 2022 comparisons then, Ule. Is it safe to say that from an oil perspective, this is worse than 2022 already, but from a gas perspective, it is not? I mean, maybe I'm speaking there from a European standpoint, but would that be your assessment?
The 22 one was a European shock, simply because we were dependent on pipeline gas from Russia. Suddenly that disappeared, and we had to look elsewhere. Since then, obviously, the LNG import facilities has been ramped up. But the problem with that is now that we are now in a global competitive situation. So if we basically have to compete with Asia for gas, and we can say luckily it's happening at a time of year where demand is slowing down. But at the same time, we need to consider how to rebuild storage ahead of the next winter. And right now, the spot price is higher than the winter price, really reducing the incentive to store. But asking back to your question, and this is I'm sure by far the much bigger crisis than the one we had because the one in 22 was an isolated Europe event. This is a global one.
Ole, do you like gold at these levels?
I do, Tom. But I'm also not immune to the fact that we are seeing a very, very popular investment that is now being a little bit put to the sideline. There's a lot of speculation as to what's driving it. No doubt that maybe some of the initial trigger has been the reduced rate cut expectations in the U.S. down from 3 to less than 1 now this year. But also the dollar, which has gained some strength. The yield curve is steepening a bit. That is weighing, but I think ultimately it has been a very popular investment. If you want to go a bit to the sideline, realize some cash, maybe not for margin calls, but just simply you're a bit nervous, you get out of some of your popular and most profitable positions. So the technical break below 5,000 was really the signal. We will stabilize sooner or later. The world has not become a better place.
Yeah, OK. Ule, thank you very much. Yes, liquidity plays into that, doesn't it? Ule Hansen, Commodity Strategy Head at Saxo Bank. Thank you very much for your time. Coming up, as the conflict in the Middle East divides the region further, we will speak to the president of Cyprus about Europe's response and the threat of Iranian strikes on his country. That interview is next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The problem we've got as an industry is when the government's overtaxed, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back. This is the opening trade, 7:30 in London. So 30 minutes until cash equities open. And the futures picture certainly reflecting a very different oil picture this morning, also reflecting what we saw yesterday. I mean, Tom, we had European markets down by more than 2% by the close. All of the major markets in Europe reflected that kind of negativity. And so this futures picture, whilst it looks positive, doesn't really scratch the sides in terms of making up for the losses of yesterday. But it does reflect that we have a slightly more subdued oil picture, if you can call 108 handle on Brent.
And we're seeing that reflected on the bond markets as well, with some stability right now after the rout that we saw yesterday, with yields spiking higher across, of course, the Eurozone, the UK as well. So we'll check in on gilts at 8 a.m. But currently you're seeing, again, a bit of stability across the benchmarks in Europe after that sell-off yesterday. So the German 10-year yielding 2.95, largely unchanged. OET's over in France at 3.62, and BTPs, where you saw yields spiking again yesterday, currently stable, yields down 2 basis points on the benchmark at 3.76.
OK, the European Union is bracing for a protracted energy price shock after Iran crippled a vital Qatari gas plant, raising the prospect of a potentially years-long supply crunch. Following talks in Brussels, EU leaders expressed anxiety at the darkening economic situation. Our chief Europe correspondent, Oliver Cook, is in Brussels for us with an important voice. Ollie.
That's right, and I'm here with the president of Cyprus, Nikos Christodoulidis, who was there last night into the late hours of the evening. So thank you so much for joining us bright and early this morning, discussing all the major issues that are facing the European Union and Cyprus, and chiefly among them the Iran crisis, all the trickle-down effects. But Cyprus is in a unique position. It was directly affected, the only EU member state to have suffered a drone attack as a consequence of this war. How is that adapting your idea both of Cypriot sort of defense strategy as well as European policy?
First of all, we are part of the region. We are not involved in the war, in this crisis, in no way. You know, my country remains a stable, safe and operational, fully operational hub for business, investment and tourism. We know the region because of our geography, because of our diplomatic relations with all countries of the region. We don't know the region from textbooks, and this is very important. And we're bringing to the European Union that perspective of the region. What is important out of this crisis? We saw, for the first time, solidarity in action from the European Union. Greece, France, Italy, Netherlands, Spain immediately reacted to my request, and without triggering Article 42.7, we tested it and we tested it successfully. So that was very important. It was something that we discussed last night, and we need to see, and probably we'll do it during the informal European Council Summit in Cyprus, how to give substance on Article 42.7. What we are going to do in case a member state triggers Article 42.7.
And I'd like to get your personal perspective, in addition, the perspective from the discussions in the room yesterday at the European Council meeting about what the EU and Europe's role is in the Straits of Hormuz, in this conflict with Iran. You said that you disagree with some comments suggesting that this is not a matter for the EU. There are some initiatives that are taking place and that the EU should have a role in those initiatives. What role should the EU have in the Straits of Hormuz in this conflict in Iran?
Before coming to Brussels, I was on the phone with all leaders from the countries of the region, the Gulf, the Middle East. The countries of the region, they are expecting the European Union. This is the neighborhood of the European Union. They're expecting an initiative from the European Union, or at least from those member states of the European Union that they have a special interest for the region. And I think we're discussing about the repercussions, the consequences of this unfortunate situation. We need to concentrate on how we de-escalate. And right now is a time for leadership and unity. And it's another opportunity also for the transatlantic relations. We need to work together, the European Union, the United States, the countries of the region, in order to present an initiative for the de-escalation of the situation.
And for you, those initiatives, is it a primarily diplomatic role that the Europeans would play, or are we also talking about potentially, as Emmanuel Macron has talked about, potentially providing safe passages through the Straits after things have calmed down a little bit?
First of all, we need a diplomatic initiative to achieve ceasefire. All of us, all member states, the countries of the region, the United States, other countries other third countries, we have an incentive to achieve de-escalation. So we need to work together. We need to present something tangible on the table in order to achieve ceasefire, and then discuss all the other issues like the one you raised.
And I want to talk also about NATO membership and defense strategy for Cyprus. Of course, there is a blocking vote in NATO by Turkey. Does this sort of event put urgency on potentially finding some kind of political solution with Turkey? And in the absence of that, do you think that the Article 42.7 provides a strong enough framework in order to provide those kind of defense guarantees for Cyprus?
Let me say that if it was possible for Cyprus to join NATO tomorrow, no question about it, we are ready to apply. It is not possible, and we don't want to apply just to get the veto from Turkey. But I don't agree with my very good friend Mark Rutte with regard to the autonomy, the security and defense autonomy of the European Union. It is possible, and it was tested in Cyprus with the reaction that we had from the countries I mentioned before, that European defense and security, it is possible. And by having a strong European defense and security aspect, it's also helpful for NATO. It's also helpful for the United States. It's not something against NATO or against the United States.
I noticed that in the list of countries that you listed, which I believe was Greece, France, Spain, Italy, the Netherlands, what you failed to mention was the United Kingdom, whose bases were the primary source of the attack. Have you been satisfied with the UK's response? Do you think that the UK is paying their keep on Cyprus? You said going into the meeting yesterday, when the situation is over in the Middle East, we're going to have an open and frank discussion with the British government. What will that discussion include?
We have excellent relations with the UK government. Just to give you, an example to see how excellent our relations is, the Prime Minister visited Cyprus. It was the first ever visit after 53 years. We have a strategic dialogue with the UK. We're working very closely together, but the issue of the British bases need to discuss. I mean, all of us, we understand that the bases in Cyprus is a consequence of the colonial period in Cyprus. We have more than 10,000 Cypriot citizens in the British bases. We have responsibility for those people, for their safety, for their well-being. And when this situation is over, we need to have a frank, open discussion with the British government with regard to the future of bases.
In an approach to that discussion, how do you think about those bases in terms of possibility of making Cyprus a target versus their asset as a sort of deterrence for Cyprus? Give us a little bit of sort of the flesh of the debate about that, because we've been protests, obviously, in Cyprus to kick these bases off.
As you know, in Cyprus, we had a single incident targeted the British bases. Cyprus wasn't targeted. Cyprus is not part of this crisis. And of course, we don't like our country to be a target. So I had already a discussion with the Prime Minister with certain developments that we saw and we didn't like with the handling of this crisis. And when it's over, we need to put everything on the table and discuss and decide together for the future of the bases.
So just to labor on this point for just a moment, in 10 years from now, how do you imagine that relationship having changed? Would you like those bases to be there still?
You know, it's not diplomatically correct to negotiate, from the studio. As I told you, I already mentioned some of my concerns to the Prime Minister, and when the situation is over, we'll discuss everything.
And I'd like to get your sort of appraisal of the economic impact of what we've been seeing in Iran. Obviously, we've heard from the ECB yesterday. We're talking about inflation potentially upwards of 6%. We're talking about potentially, huge consequences for growth. Do you have your arms around what the impact is going to be for Cyprus? Is it, what are the sort of risk of a, for example, recession in Europe?
All countries will be negatively influenced if the situation continues. And that is why I'm insisting on the need for de-escalation. If we don't de-escalate, we don't know how the situation will develop. And for sure, the repercussions are going to be serious in all aspects: economy, tourism, trade, energy, etc. So that is why we need to turn this crisis to an opportunity, work together, have a coalition, if I may say, of the willing in order to present a plan and achieve de-escalation.
And another sort of consequence of the war in Iran is obviously a great concern with what the path forward is for Ukraine. Obviously, it funds the Russian war chest in addition to a great conflict that was yesterday on the 90 billion euro loan. I'd like to get from you just kind of an appraisal of the atmosphere in the room, particularly vis-a-vis Viktor Orban, and what you see as the path forward for that 90 billion euro loan.
Let me be clear that I don't agree with my very good friend Viktor and his stand on the 19 billion. We had a decision for the 19 billion on December European Council. And you can understand that the message that we are sending, if we have a decision at the level of the leaders, at the level of the European Council, and we don't deliver, it influences negatively our credibility as a European Union. I really believe that there are no deadlocks to diplomacy. We will find a way to implement what we have decided.
And also, over the weekend, we got an interview from Bart de Wever, the Prime Minister of Belgium, who is saying that it's time to basically normalize relations with Russia, to regain access to oil and gas, while also not being naive about Putin, sort of a paradox within that. He sort of walked that back a little bit, but there's a more serious debate that underlies this, which is what the path forward is with the negotiations with Russia. Obviously, we're at a total standstill with the U.S.'s negotiating role while this war is going on in Iran. What do you see as the path forward? Because what de Wever would say is there is no new ideas, there's no political will to get the old ideas in place. What is the...
I discussed the issue yesterday with the Belgian Prime Minister. Look, all of us, we have specific thoughts on the way of approaching, how to approach Russia. What we need to do, we need to discuss this issue at the level of the 27, have a common approach and send a common message to Russia on the way forward. Because if we are publicly position, all 27 publicly position ourselves with regard to the issue of how we approach Russia, then this is negative for the European Union. So we need to have a discussion at the level of the European Council, have a common approach and follow this approach.
And a final question on the impact specifically on energy prices into Europe, but also for Cyprus. Cyprus, I believe, is 85% or thereabouts dependent on fossil fuels for energy generation. What specific measures is Cyprus considering to dull the impact that we've seen over the last couple of weeks? And at the European level, what needs to be done? Is it just tinkering around the ETS? Because some would say that that's sort of naive in terms of trying to tackle the scope of the impact here.
It's not only the ETS. We discussed yesterday a number of measures that we can take. Those measures should be tailor-made, targeted, and temporary in order to face the situation as it is right now. And that is why last night we decided that we will come back on the issue of energy during the European Council in June in order to evaluate the situation and see what we should do as a European Union. For sure, it should not be just the ETS.
Do you have an idea? Are we talking about potentially gas price caps? That's something that we talked about.
It is an option.
Yeah.
It is an option, but we need to take under consideration that each country it has a different energy mixture. So their approach to face the challenge, it will be difficult. It will not be unified for all 27.
Well, Nikos Christodoulidis, thank you so much for your time this morning after that European Council in Brussels here in Brussels. That is the president of Cyprus on all the different issues that were discussed and principally what the EU's role is in resolution of this conflict in Iran and going forward.
Great conversation. Oliver Crook, Bloomberg's chief Europe correspondent in Brussels. Ollie, thank you. Meanwhile, the top central bankers in Europe and the UK have warned about the impact the Iran war could have on inflation and the rate path ahead.
The risks to the inflation outlook are tilted to the upside, especially in the near term. A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices than currently expected, raising euro area inflation further.
This is a very volatile situation. I think by the next time we meet, which will be, our next decision is at the end of April, a lot will have happened, and I can't predict what. I can't possibly, none of us can predict what it will be, but it is a very volatile situation. So I would caution really against getting ahead of that position, which is we held this time.
BOE Governor, of course, Andrew Bailey, and ECB President Christine Lagarde speaking yesterday after both central banks held rates steady. We're going to discuss the rate outlook for central banks later in the show, so stay tuned for that analysis. This is Bloomberg.
A cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back, everybody. Now, this week has been a wild one for investors as headlines from the conflict in Iran whipsawed energy markets. The conversation around 2022 comparisons for energy markets is still evolving as gas prices remain volatile. Also evolving, the outlook for the Strait of Hormuz and Europe's energy policy response. This is what our guests on the show this week had to say about the moves.
The parity trade in 2022 was really a balance of payment shock. And that was related to obviously huge rises in gas prices, massive rises in oil prices for a very prolonged period. We're not in that situation now. The longer this goes on, yeah, we could be. But it wouldn't be my base case.
Now, the magnitude of the crisis is less. But that doesn't mean it could be completely ignored. The focus will be on activity to see if that holds up in the face of higher energy prices or not, because you do have stimulus.
In 2025, wind and solar generated more electricity in Europe than all fossil sources together. So both the marginal pricing and the EU ETS is really supporting the long-term trend for renewable.
There is a role for the public and private sector to work together. I think making sure that we're complementing each other, so we're both working towards the same solution. When it comes to insurance, what's critical is that we keep the market open, we keep talking so that these solutions can be in place, so that insurance is not an inhibitor.
The winning strategy right now is take a little bit of profits on up days because the next day is down, add on those dips the next day, and unfortunately it's not like the taco trade of April on trade war. This is a real war, and you can't pivot from that as quickly because you need Iran to play ball. It's not just Trump's decision.
Joining us now with more on the markets, Bloomberg's Moena Coniam from our Bloomberg Markets Today blog, editor of that blog. Moena, good morning to you. So it's all about energy. Everything comes back to energy. Inflation expectations, bond market moves, volatility in all kinds of asset classes. It all comes back to energy. What are you watching?
Well, I think that today, I'm obviously watching, we've got Brent coming down again, which is encouraging, but I'm not very convinced that it's going to be sustained. I think we've still got all of the underlying causes of volatility, and I think volatility is really the word. We've seen so much shifting in directions this week, but overall the trajectory has been up, closing at sort of highest since 2022 yesterday. It's a really dramatic increase, and that is having a ripple effect across global markets, inflation expectations in particular, and that is now really being seen in pricing for central banks, which is having a big impact on other assets. But I think in terms of the energy prices themselves, I think there's not really clarity in terms of any sort of stability, which would see a really sustained recovery. So I'm not optimistic that's going to sustain into the weekend.
Yeah.
Bring us some optimism on the UK. Is there anything to say about the UK? I mean, UK gilts sold off aggressively, and more aggressively than their European counterparts yesterday. Yields shooting higher.
Yeah.
What is the picture for the UK right now?
I mean, it's not a good day. It's been a terrible week, in fact. But I mean, the 2-year yield rising about 40 basis points yesterday, really quite phenomenal increase. As traders are now pricing in 3 interest rate hikes from the Bank of England this year. A few weeks ago, we were expecting 2 cuts. So we've seen gilt yields rising a lot at the shorter end, but public deficit data this morning that was worse than expected for February. So before all this started, really could start to see that.
Worse, wasn't it?
Exactly, yeah, quite a big a difference to what was expected, and basically that's because they spent more. And that really isn't what we need to be seeing. I think we could start to see some of that gilt anxiety coming into the longer end of the curve as well, because you start to get the sense of political risk. And what is the government going to do about the sort of energy shock that when we come out of the price cap in July, they are going to have to take some action, and the gilt market historically has not liked that at all.
From other European leaders, we heard from Christine Lagarde, we just heard from the Cypriot president, that any response has to be targeted, but we'll see what the UK context brings. On gold, I guess you're watching that just like everybody else. We've had a lot of conversations about whether this is still a haven on this programme.
Yeah, well, it's not behaving like a haven at all anymore, and that's mainly because as central banks globally are expected to become more hawkish. We've had, even rate cuts priced out from the Fed. That takes away quite a lot of its appeal, and we're also seeing metals more broadly hit by the destruction of demand, and that's a real concern for commodities. And I think gold is following suit at the moment. There's losing its haven appeal.
Moena, thank you very much indeed with that update. Moena Coniam, Bloomberg Markets Today editor. Let's get your stocks to watch with Charlie Wells. Charlie.
Good morning, Tom. So the first question that I have is, are these airlines, these European carriers, going to get any relief? Because we've been hearing so much about that oil price from the Middle East. You see so much red here for EasyJet, for TUI, for Ryanair, for Lufthansa. And their executives have been talking about how they have little wiggle room here, how they might have to start passing on a lot of these costs to consumers. So you can see the CEO of Lufthansa talking about how their average profit, the average profit for their company, is about 10 euros per passenger. So not a lot of wiggle room there. Do we see a floor there, though? Let's turn to luxury now, because they've also really been struggling. They've been struggling on the uncertainty from the Middle East. But also, if you look at the share price over the course of the past few, just really yesterday, you see a big decline here. And that is, in a way, some sort of a rate story, sort of a wealth effect story, as a lot of these asset-sensitive luxury consumers start to feel less rich. And then let's end with Unilever. Watching that, because we have that news about McCormick, their Unilever confirming McCormick making an inbound offer for their food unit. Investors haven't liked this so far. Does that inbound offer turn things around? I want to see very soon.
Charlie, thank you very much. Bloomberg's Charlie Wells with some of the stocks in focus. Certainly another day of watching Unilever then, Tom. We got some response to the reporting around that story from our colleagues in yesterday's session, but we'll see if we get some more today. Today's session is just going to be a kind of reaction to yesterday, isn't it? We are expecting overall markets to bounce a little bit, but not to make up for the losses of yesterday.
It doesn't seem that this can be sustained in the long term. We'll see. It's very modest in terms of the downward pressure on gas prices, downward pressure on oil prices. But speaking to Ola Hansen, his view is there has to be more priced in when it comes to crude. So that could be more volatility in the pipeline. But given the sell-off that we saw yesterday, particularly in the bond markets and the equity markets of Europe, down 2.4%, we'll see how the changes reflect, of course, European futures pointing higher right now as we look to the session, pointing higher by about 1%. The opening trade is up next. This is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back to the opening trade. It's Friday, everybody. A few minutes to go until we get the start of cash equities trading. So this is the picture on US stocks from yesterday. You can see that European markets closed up, which is that yellow line, around session lows for US stocks. So we do have a little bit of upside to price in from that US session. Through the latter part of the session, we started to get more of that messaging from the Trump administration, from Benjamin Netanyahu. Both of those over the past 24 hours have been talking in slightly more reassuring terms, at least about the extent to which they intend or not to target energy infrastructure, and that has relieved some of the pressure when it comes to energy prices. We see oil prices slightly in retreat, gas prices slightly in retreat, and as a result of that we saw a little bit more risk appetite for stocks. So we look, Tom, to see that at the start of trade. The futures picture does look positive then. We could be up by 0.9% on the DAX, so that's encouraging, but we of course lost more than 2% on most of these markets in yesterday's session.
In terms of individual names and sectors that we are focused on today, there was one sector that was in positive territory yesterday. That was the energy space. We'll see how that changes and adapts on the back of softer Brent and WTI prices, at least for now. Gas prices also falling a couple of percent in the session, so not significant, but we'll see if that reflects across the energy stock space that again did outperform yesterday. Unilever in focus on an update in terms of its potential sale of its food assets, so we keep an eye on Unilever. This is a story we've been reporting around. And postal stocks on an upgrade in terms of the view from FedEx and whether or not there's a read across there. That stock jumped almost double digits in the US session. We'll see if the likes of DHL move on the back of that story, Anna.
Yeah, it's interesting. In the middle of this week, we started to ask questions about whether markets could decouple from the headline risk around energy assets in the Middle East. Well, the answer later in the week was certainly no. And yesterday we got that message firmly. Energy stocks were the only sector in Europe in positive territory. Everything else was down, and we were down by more than 2% on these major bourses across Europe. So today looks like just a bounce from some of that negativity. How positive will we be today? What extent will we see that bounce coming through is really the only question. The FTSE 100 is up by 0.4%, waiting to see if we get some better gains from some of the markets that maybe have lost a bit more ground. The DAX, the CAC, for example, the IBEX over in Spain as well. So those markets a little slow to open this morning, but we are seeing a bit of positivity being reflected on that FTSE 100. And yes, we've got the CAC open and up by 0.8%. The IBEX up by more than 1%. So in some of these markets where we've seen more heavy selling, we are seeing some of those gains coming in. The energy sector was the only positive sector yesterday, as I mentioned, Tom. Basic resources was the only was the worst performing sector. And so it was interesting to see those two polarize. And today we see a lot of moving parts when it comes to energy prices and underlying commodities. So I wonder what the sector picture looks like today.
Top of the list is basic resources right now, up 1.6%, given the upside we've seen in prices around iron ore, around copper, around gold in today's session, of course. So reversing, at least to some extent, the losses that we saw across basic resources yesterday. So basic resources at the top of the list across your sectors. In fact, now it's travel and leisure. 1.5% for travel and leisure is the gain. Construction is up 1.5%, and basic resources also around 1.5%. So they're all tussling for the top spot right now. On the downside, just one sector in negative territory. Not surprising to see that it's energy down 0.8%, given that we're seeing a little bit of pressure again on Brent and WTI today. So energy is currently down 0.8% after being the best performing sector, the only sector in positive territory yesterday. And again, basic resources, travel and construction in positive territory, gains of around 1.5%, Anna.
It's like someone's put a mirror up against yesterday's session and worked out the opposite, and that's what we seem to have today. So as you point out, yeah, basic resources doing well, energy stocks doing less so. We still don't have the DAX open, but we do see broad positivity across these stocks, but not making up for yesterday. Stock 600 up by 0.7%. Individual movers then, and Tom, you were talking about those postal stocks. Deutsche Post is one of those. It's up by 2.5%. We had numbers out of FedEx, of course. Prosus is up by 1.8%. That's often moving around on what's happening with its Tencent stake, and there's been a lot of news on Chinese tech of late. Some of it hasn't necessarily cut through into the show as much as it should have done because we've been too busy talking about the Persian Gulf, but we will certainly return to those tech themes In our next conversation, we are joined now by Karim Shadid, who is head of EMEA Investment Strategy at BlackRock, with us this morning. Karim, nice to have you with us, joining us from Paris, I think, today. I wonder, as we bring, well, I was going to say bring to a close, but there's still a whole day of trading left, isn't there? But we're in the last day of trading of what has been an incredibly volatile week. Do client conversations that you're having, Karim, as you travel around Europe, do they look like, are they all about defensive moves? Are they all about trying to find havens, trying to find safety? Is that where investors are, where their thoughts are going at this time?
Actually, yes, thank you. Really happy to join you from Paris today at the end of a roadshow, speaking to a lot of our clients across the continent. And actually, to your point, there's a spread in the conversations. On the one hand, when we look at the polls that we've been running on of our clients, of about 1,200 to 300 clients per week in these polls in this time series of data, we are seeing that the bull minus bear, so kind of the net bullishness, is at the weakest in terms of sentiment since February 2025, based on our measures. So there has been a deterioration in sentiment around markets. But then when we look at the flows, we don't see that sort of capitulation in risk. There's been some de-risking this week, but it's by no means matching this sort of big risk-off moves in asset allocation. In fact, what's interesting is we're seeing a lot of interest come back into tech, into AI. A lot of the conversations this week have been about the AI theme, how to invest in AI, with AI, and why, as the market attention shifts away from these types of concerns around circular financing last month and late last year, to back to the fundamentals. Why bringing attention back to the fundamentals and the really strong earnings picture and the breadth of the earnings picture really brings back focus on this opportunity.
It's interesting, Karim, you mentioned that, because you can draw a line between what's happening in the Middle East and threats to AI. And I'm thinking here about the cost of energy. Energy is a big component of what AI businesses are trying to do. They need a lot of energy to do it. And also, Tom was making this point yesterday, that there could be threats to the amount of investment dollars available to invest in some of these AI projects if some wealthy nations in the Middle East aren't making quite as much as they used to. Are investors saying it's too early to join those dots, or they just don't expect the link to be that great? What's your thinking?
There's definitely a link on the energy front, and I think one of the key themes investors and clients are talking to us about is this idea of energy resilience and the energy continuum, right? As the build-out of AI happens, and the big power demand theme that you're alluding to is super important here, this idea that you need all parts of energy. You know, I come back to a theme that I've spoken about with you before in previous interviews around sustainable energy, and why the performance had come back to that space in May last year, and has and very much linked to this power demand theme. But then also traditional energy is very much in focus. You were talking about some of the near-term volatility in the sector. Yesterday, a very strong day. Today, seeming a bit weaker. But if we zoom out, you know, there is an opportunity across the energy continuum. The refiners, for example, are really, really important in this space. Margins are looking better across the whole energy continuum here.
Karim, Europe is often flagged as a place where you can find some of the players that feed into the energy piece when it comes to supplying and supporting data center build-out. What are you seeing in terms of US demand for European equities at this point? You're not seeing capitulation across these markets, but are the US starting to capitulate on Europe?
So you were talking about mirror images earlier, and one other mirror image you'd see is, you know, in Jan and Feb, Europe and EM stocks have been significantly outperforming the US. And then you look at March, and it's exact mirror. A lot of the momentum plays in Jan and Feb have reversed in March. And that's in equities, that's across asset classes. You'll see that partly why gold has also underperformed in March. Anything that did super well earlier in the year is unwinding a bit in March. And here it's important to distinguish the fundamentals from what's just a momentum unwind. And to your point, bringing it back to Europe, we are still seeing demand and flows. They have not dropped off completely. Domestic demand for European equities remains very, very strong. It's definitely still there in March, despite some of that performance unwind. Understandable why the performance picture looked the way it does. You know, Europe is potentially could see some inflation shock if the shock in the Middle East sustains, depending where the oil price rests. Of course, the forecasts here are very much a moving target because all it depends on is the duration of the supply disruption and where the oil price ultimately rests. If the oil price drops back down, you could see a bounce back pretty quickly. But all this to say, we are still seeing domestic demand for European equities. International demand waned a bit, but it hasn't turned into selling.
Where do you think the earnings vulnerability is going to be most acute for European stocks in the face of higher rates and higher energy prices?
So here we still look at the selectivity message in Europe. We really think that sector selectivity and single stock selectivity, the active approach in European equities, makes a ton of sense. You know, a value approach in Europe probably still pays off if the cycle continues. This is assuming that the cycle is not disrupted by the supply disruption. You might see some revision down in growth, some revision up in inflation. We're looking at about 0.5% magnitude here if the oil price sustains. But then you can still see these types of value approaches make sense in European equities. The sectors that we've been focusing on, whether it's in the industrial space, whether it's in the financial space, remain the favored areas to access Europe, whereas the consumer, to your point about vulnerability, consumer-facing sectors could be a bit more vulnerable.
Karim, it's interesting that you say in your conversations with investors that some of the themes that go back to before the Iran war started are cutting through around AI, for example. Investors were also worried back then and continue to be so about private credit. I saw one story yesterday that suggested that private credit investors or credit investors broadly are more concerned about trying to find cockroaches, areas of vulnerability and you know, business models to be nervous about than they are about the spillover effects from the Iran war. Maybe it's just a question of time, but what are credit investors thinking about, do you think?
I would say that we have seen some caution, but not panic. And there's a big distinction here. You know, there is this sort of cautious hat that investors are wearing, whether in equities or in credit, looking for potential risks on the dashboard. But we are not seeing any sign of panic. We're not seeing any, you know, flight to safety by any stretch of the imagination. In credit, you know, the big theme for us going into this year that still stands is this idea of carry. This idea of, yes, you might see some spread widening here and there during weeks of risk off. And we saw that, you know, in parts of high yield and credit more broadly in the past couple of weeks. And we have seen some clients, you know, we talk to bring down the risk, you know, from high yield exposures a bit, you know, bring it down to neutral or maybe just below neutral. But we are generally seeing this mindset of continuing to carry credit with the idea that all-in yields can compensate you for mild spread widening.
I wonder what the linkages are between credit and gold. You still like gold, Karim, as a hedge, as a geopolitical hedge, really?
Yeah, so that's a call that obviously hasn't looked great in March. I stand by that, but when we look at gold, we really need to zoom out and think of the bigger picture. Some of the structural drivers of gold, such as purchases from central banks in emerging markets, which can be a bit price sensitive. So we saw a bit of a pullback in that data in February. We expect, you know, we're starting to see signs of that come back in March because it is a bit price sensitive. So on dips, those types of purchases provide a bit of a floor on the gold price. When we zoom out, gold is still looking quite lowly correlated versus stocks and bonds on a 10-year basis, sub 0.1. Clients we speak with are very much still asking for gold and about gold. In the polls that we run, gold has constantly come through in the top 3 net add exposures when asking about asset allocation shifts.
OK, on the case for gold. Karim Jadid, head of EMEA Investment Strategy at BlackRock. Always appreciate your insights across these markets, Karim. Thank you. Let's get you a touch and a picture on the Core 6 right now. 11, 12 minutes into the Friday session, and you're seeing broadly across the Core 6 gains, apart from Novo, which is essentially flat. The strongest upside currently coming through for ASML in the tech space, of course, up 1.6%. Similar gains for Schneider Electric. Talking of those European companies that play into the data center story and the energy story. In the defense space, Rheinmetall popping 1.2%, so a decent gain there for a stock, of course, that's rallied in the last 2 years substantially. LVMH, which has seen some pressure given the luxury story in the Middle East, 1.4% is the gain, actually, for LVMH. So that is the picture across the core 6. Let's get some details on some of the other individual stocks on the move this Friday, bringing Charlie Wells. Charlie.
Good morning, Tom. So let's kick off with airlines because they are in the green this morning, flipping from being in the red yesterday. So up well into the 2s for EasyJet, TUI, and IAG. Now, this could be some dip buying. This could be traders saying basically that they buy the narrative that the White House wants to try to take some pressure off of the oil situation right now. So again, seeing positivity here, even despite some pessimistic comments coming from a lot of executives yesterday about having to push prices on to consumers. Let's flip and let's talk about Infineon. This is the German chip company. What we're seeing here is also a lot of positivity, well over 5%. And this has been another theme of the week, right? That AI narrative coming back, giving a boost to a lot of these chip companies, particularly here in Europe. So Infineon up right now, well over 5%. Different story when you take a look at Smiths. Let's bring up Smiths, that British engineering company, onto the screen, down over 4%. So they had an earnings report out today. Clearly, that disappointed the market. They were talking about returning over 1.5 billion pounds or 1.5 billion pounds to shareholders, but the market not liking this. This could be uncertainty right now. This could be a little bit of that rate issue, a little bit of the hawkishness spilling in to some of these engineering companies. So we're going to want to watch that for the rest of the day. I am watching with great interest this next one. It is JD Wetherspoons, down over 8%, almost 9% here, because I love a pub. I think we all do, particularly on a Friday, and particularly after a week like this. They also had an earnings report out that was disappointing, clearly talking about that consumer that's under pressure. Now, JD Wetherspoons, of course, they talk about offering pints at reasonable or sensible, if I believe. I've spent enough time in those pubs, sensible prices. But when you have those thin margins, when you get this uncertainty, when you get a lot of this pressure on the consumer, you get pressure on the likes of JD Wetherspoons as well.
We all love a pub. I'm just checking out to see whether the Jon Snow in Soho is a Wetherspoons. I thought it was. Anyway, we all love a pub on a Friday, particularly, as you say, Charlie, after a week like the week that we've just had. Charlie Wells with the stocks on the move this Friday. Thank you. Coming in and coming up, we're going to check back in on energy prices. You're seeing European gas a little weaker, just by around 1% right now on Dutch gas futures. Brent is trading down 1.4% at 107 after, of course, breaking through about $113 per barrel yesterday. WTI at $93 a barrel. So that spread continues, of course, between the two markers on oil. Currently down 2% on WTI. We'll see how sustained this is as Trump and Netanyahu try to reassure around energy infrastructure. We'll get more details and more conversation, of course, around that. We'll get an update live from Dubai. We'll have plenty more on that evolving story. Stay with us. This is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We are 18 minutes into today's session. Broadly, you can see, of course, gains across the benchmarks. The index over in Germany, the DAX is actually outperforming, up 1.4% across your sectors. Construction at the top of the list. Energy seeing a bit of pressure as a sector, currently down 0.4%, Anna.
European gas prices are lower and oil has dropped from its highest close since July 2022 as leaders from the US and Israel sought to reassure energy investors rattled by damage to major Persian Gulf energy facilities. Bloomberg's Jumana Basecci is in Dubai and joins us now. Jumana, bring us up to date with the actual damage then that we've seen to Qatar's LNG plant. I know there have been strikes on facilities in Kuwait as well.
Yeah, absolutely, Anna. So a big strike took place at the Ras Laffan facility yesterday, as we spoke about. And over the course of the evening, Qatar Energy put out a statement defining how much damage they had been sustained. And what they did tell the market is that 2 out of their 14 LNG trains had been damaged. That represents about 17% of Qatar's LNG exports. And that the damage itself will take 3 to 5 years to repair. It's equivalent to about $20 billion in foregone annual revenue, and will likely to force them into a long-term force majeure with many of those customers. And you will remember that at the beginning of this war, they also announced a force majeure with some of their customers on some of those shorter-term contracts amounting to around $17 billion. But this just takes it to a whole new level because it suggests that this is going to take not months, but years to fully get back to the capacity that was targeted in yesterday's strikes, and not just affecting LNG, it affects condensates, LPG, helium, all of those other gases that are related as well. I should also say that in the UAE, this is getting less attention, but still very significant. 2 main gas facilities also targeted yesterday. Now, there were successful interceptions, but they've also halted production. That amounts to about 75% of the gas processing that's coming out of the UAE. So we continue to see these supply constrictions coming through from this part of the world. And then, to your point, Anna, overnight, more attacks on refineries. At second day in the row that a refinery in Kuwait has been targeted. They've announced that they've halted production too. And so if you list all of the refineries that have been targeted since the beginning of the war till now, you're looking at about 2.5 million worth of refining capacity. Now, most of these refineries have not sustained extensive damage like the LNG facility has in Qatar, but they have halted production, which just adds another dimension to the supply disruptions that we're seeing.
Yeah, and to some, of course, casting our eye back one or 2 days, Jumana, Israel kind of crossed that Rubicon in terms of its attack on the Iranian gas facilities. We've been hearing from the Israeli Prime Minister, Netanyahu, there's been an attempt at de-escalation from both Trump and Netanyahu, particularly when it comes to energy infrastructure. What have we been hearing from the Israeli leader?
Yeah, I would say specifically de-escalating one specific part of the war, which was the Israeli attacks on that South gas part field in Iran, deemed to have crossed the line. President Trump very clearly was trying to distance himself from it, even though there were various reports suggesting that the U.S. would have been privy to the information beforehand. And then yesterday, we did see official commentary from the Israeli prime minister. He gave a press conference and said that Israel had acted alone. They were not acting in conjunction with the U.S. And at President Trump's request, they have said that they will no longer be targeting Iranian energy infrastructure. But that is not to say that the intensity of the strikes have diminished, because the ongoing operations, the joint military operations, have continued overnight. Reports of very heavy airstrikes over central Tehran. And as I was just saying to you, Iran continues to lash back at Gulf states with these volley of attacks coming through on multiple countries and not just exclusively directed at Israel.
Jumana, thank you. Jumana Pasechi in Dubai. Meanwhile, the commodity market's view on the financial impact of the Iran war is more bearishly than that of the equity and rates markets. That's according to Simon White, macro strategist for Bloomberg Markets Live and author of the Macroscope column. He joins us now. Simon, we're seeing a modest reprieve in Brent and European gas today. Is that telling the full story? Is a protracted energy crunch being accurately reflected across other asset classes?
The short answer is I don't think so. I think that when you get energy shocks, it's not only how long they last for in real time, it's how long they last for over a longer period. So the longer they last for, the longer they take to remedy. So when, for instance, refineries are powered down, or when gas plants, liquefaction plants are powered down, they take a long time to power back up again. So you have these kind of what economists call hysteresis effects. That means that you just can't suddenly switch things back on again. So I think that the financial asset markets are not pricing in that longer-term impact that commodity traders already see. If you look at, for instance, break-even rates, inflation break-even rates, or CPI fixing swap rates, certainly in the US, they're still pricing a temporary inflation shock. So I think there's a mismatch there between the markets.
OK, so if you think there's a mismatch in the different asset classes then, Simon, and you think maybe commodity markets are taking this more seriously, other assets a bit more complacent, do you think it was sensible then that short-end yields globally, but in particular in the UK, jumped as much as they did yesterday, or did you think that was overdone?
I mean, that was quite a dramatic move. If you're ever going to see a dramatic move, it'll be in the short sterling and the UK rates. Look, I think there was a realization there that the Bank of England, obviously the Bank of England and the ECB are more inflation-targeting banks, and they are not expected to have an incoming, chair like Kevin Warsh in the US, who's perhaps going to be more beholden to the government. So there's a lot more kind of freedom to move there. I think the dramatic move, like the size of the move, the extremeness of the move in the UK was kind of probably a stop out as much as anything else. But I think underlying it, there's a real understanding that the Bank of England acknowledged the fact that second round effects, inflation effects, are likely to come through. And then, of course, central banks, they say they won't act against what they see as a supply shock, but they will act against what they see as inflation becoming embedded. So that was kind of the penny dropping. So although the move was quite perhaps kind of over the top on a short-term basis, the underlying kind of sentiment behind it, I think was correct. So, that this is something that's going to be an issue for central banks. It's complicated in the US, of course, just as I say, because the incoming Fed governor is maybe not necessarily expected going to be an inflation fighter.
Thank you so much, Simon. Thanks for bringing us your perspective. Simon White, macro strategist for Bloomberg Markets Live and author of the Macroscope column. And it's interesting, he, like many others, saying, maybe that was an overdone move on short-end gilts yesterday. But we're not seeing it unwind hugely today. We're seeing those gilt yields. They were up 30 basis points yesterday, 2-year, down 3 now. So there's a bit of move back, but not much.
And possibly there is less to unwind given what we've seen with the deficit as well. So the latest deficit figures coming in higher than many had expected. So that's another constraint for the UK.
Let's talk about trade. Robert Steger will be joining us shortly, chief economist at the World Trade Organization. He tells us about the state of global trade with everything that's happening in the Middle East in mind, of course. That interview next. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question. I mean,
I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade Friday morning, 30 minutes into Friday's cash equity session here in Europe. And European equity markets look like they're reversing some of the trends of yesterday. We were down by more than 2% on some of the major markets in yesterday's session. Ongoing concerns about elevated, higher energy prices, energy supply as well. But today we've put those to one side. We're slightly reassured, at least from an energy perspective, by some of the commentary coming out of the US and Israeli administration. Energy prices are a little bit weaker, and so we see stocks go higher. We're up by 1% on some of these markets, the Xetra DAX in particular getting some decent gains. So, Tom, we changed course, reverse path on some of the moves of yesterday, but we're still very much focused on everything energy.
And it's quite broad-based in terms of the gains that we're seeing yesterday. But again, to your point, in the context of a drop of more than 2% by the close for European stocks yesterday. But again, quite broad-based in terms of the modest lift. We'll see how sustained that is in the days ahead for European stocks. Right now, you have about 500 individual names across the stock 600 in positive territory, and as you can see, about 88, close to 90, just in negative territory. Volumes are relatively light versus the 20-day average, or on par with the 20-day average. Not a huge amount to talk about there. When it comes to the leaders and laggards, let's break it down for you then. On the leaders side, Interestingly, tech is getting a lift today. That's one of the best performing sectors. Infineon upgraded by JP Morgan. That's had a ripple effect across the tech space. So that is up 5.4%. ASML also getting a lift as well, of course. The Dutch maker of those lithography machines, up 1.2% so far for ASML. A big weighting across the Stoxx 600. And Santander, the banking space, is also gaining as well. A bit of a sell-off, bit of a pronounced sell-off across banks yesterday. So maybe making up for some of those losses. Santander currently up 2.3%. On the downside, energy names. Again, a bit of a mirror image, a reversal in terms of what we saw yesterday in the session, where energy was the only sector in positive territory. Today, it is on the downside, of course, on weaker oil prices, at least for now. Brent, BP then, under a little bit of pressure, down 2.4%. But again, in the context of the gains that have come through for these energy majors, Shell is down 1.4%, and Smiths Group falling 5.3%. That is a different story, unrelated, of course, to what's happening in the energy space. But this is where your attention should still be, is on what's happening around energy and how that's rippling across, of course, these various asset classes, Anna.
Tom, so that's the markets. Let's get up to date on some of the other stories that we are focused on this morning. The Financial Times is reporting that JP Morgan has started a monitoring program to guard against overwork by its junior investment bankers. The program will track bankers' weekly digital footprint, including video calls, desktop keystrokes, and scheduled meetings. Bloomberg has learned that Blackstone's flagship private credit fund is planning to sell bonds backed by its over $82 billion of assets. BCred, the world's largest business development company, is looking to finalize the collateralized loan obligation deal, or CLO, early next week. The Blackstone fund earlier this month took the unusual step of asking some of its senior lenders to pitch in $150 million to help fund elevated redemption requests rather than cap investor withdrawals like some of its private credit peers. And the European Central Bank will need to consider hiking interest rates as soon as next month, that's April, if price pressures build further due to the Iran war. This is according to the Governing Council member Joachim Nagel. The ECB's new projections show consumer prices will advance in the euro area this year, and in an extreme scenario, inflation could peak in the first quarter of 2027. So April, perhaps, from an ECB perspective, Tom, is a live meeting.
Yeah, 2.6% is the renewed target, or at least forecast, not target. The target's 2%. The forecast is now 2.6% for inflation. But, of course, in worst-case scenarios, they're looking at potentially 6%, the ECB. Again, that's in the worst-case scenario. Now, global merchandise trade will decelerate less sharply this year than the World Trade Organization predicted 6 months ago. But if the war in the Middle East continues, keeping energy prices high, then a deeper slowdown could take hold. For more, we are very pleased to say we're joined by Robert Steger, Chief Economist at the World Trade Organization. Robert, good morning. What an important time to get your take on the health of this global economy and, of course, that focus on trade. What assumptions are you making right now about the impacts that the war in Iran is having on global trade?
Good morning, and happy to be here. As you mentioned, even before the outbreak of the Middle East conflict, we were predicting that merchandise trade at a global level would growth would fall from its 4.6% rate in 2025 down to a 1.9% rate in 2026, and we are expecting that because of the Middle East conflict, if it leads to elevated energy prices throughout the year, that could shave another 0.5% of growth off of merchandise trade. So the growth rate would be 1.4% that we're predicting in 2026.
Are you assuming that there's going to be, how do you factor in a scenario where this becomes more prolonged, where it's much more difficult to get these energy assets back into play? We're looking at the Qataris, for example, with an outage maybe of 3 to 5 years for part of their gas infrastructure. Do we need to start to think about what a longer-term disruption means, even if hostilities end?
Our baseline forecast scenario that predicted a 1.9% growth in merchandise trade in 2026 reflected a tug of war of several factors that were important in boosting trade in 2025 and led to a diminished trade growth in 2026 due to the fact that these factors are no longer likely to be quite such a boost to trade. Beyond that, the question about the duration of the elevated prices from the war we have assumed in our conflict scenario that prices of oil and prices of natural gas stay at their March 10 level. That's $90 per barrel for oil and $16 per million BTU for natural gas, and stay elevated through 2026 and then return to their historic levels. So that's the pricing scenario that we have built into our conflict scenario that we are suggesting would shave off a 0.5% of growth in trade over 2026. Now, that could be understating or overstating, of course, the price effects of the conflict. Part of it depends on the duration of the conflict. Part of it also depends on whether oil and natural gas infrastructure are damaged. Even if the conflict ends relatively quickly, those infrastructure damages could have a lasting effect.
Yeah, the duration of this disruption, a key unknown right now. Good morning to you, Robert. We focus a lot when we talk about trade, we have done in recent years, on goods trade, but clearly services are traded as well. What assumptions are you making there with regards to Iran? Because I'm thinking about the role that the region plays, increasing role that the region plays in global tourism, for example.
That's exactly right. And services trade tends to be less variable over the years. It grew very quickly in 2025, and we're projecting that it will also grow slightly less quickly in 2026 in our scenario that does not incorporate the effects of the conflict. The effects of the conflict would shave, according to our predictions, about 0.7% of growth off of service trade, in part because, as you point out, the Middle East is a transportation hub and a tourism hub, and those services are very important in the global economy and could be directly impacted, of course, through the geography of the conflict.
Robert, stepping back from the Iran conflict, I wanted to ask you about the broader context for what we're seeing around global trade. We spoke yesterday to a Nobel Prize-winning economist from 2025, Philippe Aghion, who was talking to us about the role that trade plays, the evolving role that trade plays. Globalization was being driven by a search for lower-cost product initially, and now it's being driven by something else. Let's just have a listen to what he told us.
Cost minimization was the driving force of value chains. And nowadays, resilience is becoming much more a driving force of value chain. You want to make sure that you deal with countries that will not turn their back on you.
I wonder what you make of that kind of commentary, Robert, the fact that the nature of trade has changed a lot. It's not about necessarily just sourcing cheaper product, but it's about a resilient product and supply chain.
Yes, I think that is very true. And in our report, we do look at fragmentation across countries in trade, and we have seen in the past some rising in fragmentation. Countries, groups of countries trading more within their groups than between groups. Based on political beliefs, and that fragmentation plateaued for a bit, and now seems to be increasing again. And it is more related now to U.S.-China geopolitics. So there is, for sure, an element of geopolitics that is impacting the shape of global trade. And one that makes the rules-based system that the WTO helps to administer all the more important to provide stability and predictability in this era.
And I know you've been looking at the AI, the role of AI in kind of driving the economy in 2025. What role does that play, do you think, in 2026, whether it's on the capex side or the productivity gains, and to what extent is it vulnerable to the energy shock that we're now seeing?
Very interesting question. Of course, as I mentioned, 2025 merchandise trade growth was unusually high relative to GDP growth, and a large part of the reason was because of the AI boom, AI investment boom that happened in North America, in Asia, and partly in Europe. And the reason that the AI boom had such an impact on imports and trade is that while investment generally is more intensive in imports, investment in AI is extremely dependent on imports. So, for example, if you are looking at construction investment and you spend an extra dollar, usually 2 or 3 cents of that dollar will go to imported products. If you're looking at investment in AI enabling goods and products, when you put a dollar of that investment in, usually 70 to 80 to 90 cents of that go into imported products. So AI investment is very, very important for trade and imports, and it therefore, things that affect AI investment are going to affect trade. Well, you've mentioned the energy, elevated energy prices from the conflict, and that is certainly one thing that could affect AI, because AI investment is very energy intensive, and the price of energy is an important input to the cost of AI investment. So that could either crimp the ongoing boom in AI investment globally, but it could also change the geography of where firms decide to invest in their data centers and other things, to look for countries and economies where energy costs are relatively low, either because they're using alternative energy sources, or because of local market conditions for natural gas, for example.
Robert, thank you very much. A nice link into our next conversation. Robert Steger, Chief Economist at the World Trade Organization. Now, with oil and European natural gas futures surging since the start of the war in Iran, several analysts note that while the conflict is bad for the global economy, it hasn't sparked necessarily the same style crisis as in 2022. Depends on which assets you're looking at, depends on which geography. But let's talk about this now in a little bit more detail. Joining me now is Kesavartini Savarimuthu, who joins us from Bloomberg NEF. Talks about the European power markets there. Really good to have you with us. Thank you so much for joining us, Kesavartini. So let's think about the parallels with 2022 and where they exist and where they break down. How do you approach that question?
Yeah, so today Europe is a little bit more resilient than it was 5 years ago. And it boils down to two main factors, right? Today we have a lot more renewables in the system and lesser power demand. So that reduces our reliance on natural gas to produce electricity. When we look at renewables alone, compared to 5 years ago, we've been tracking renewable capacity addition in Europe, and we have more than doubled renewables capacity today. We're at around 650 gigawatts in Europe, and that is more than double where we were compared to levels in 2022. So lots more renewables in the power system means we rely lesser on gas to produce electricity. The other part of the story here, and one a big driver, is also power demand reduction. So we've seen structural demand reduction since 2022, and this could be attributed to factors like installing more rooftop solar, and also a lot of energy-intensive industries have relocated, and adoption of energy efficiency measures. So all of these have contributed to lower power demand. So we have a combination where we have more cheaper sources of solar and wind in the power system, coupled with lower power demand, which reduces the need for gas. So from that perspective, we are slightly more resilient today than where we were.
That's really interesting. It sounds like so more resilience and progress has been made. What are the remaining vulnerabilities for Europe?
So we are more resilient, but we are not independent, right? So we have managed to diversify our gas supply source. We used to be dependent on Russian pipeline gas for about 40% of our European gas supply. Now that has dropped to around 6%. However, that portion is now supplied by LNG. And that doesn't lead to us consuming gas overall in a lesser manner. It just means that we have diversified our supply source. And when it comes to LNG, if the price is right, Europe will attract the cargoes. So from that perspective, we do have markets that are more reliant on gas. For example, Italy is a prime example. It relies on gas for power generation more than other markets. And we still need gas power generation when we have dark winter days and we have low wind speeds. Gas power generators still are needed to ramp up to produce supply.
OK, thank you so much. Thanks for bringing us the analysis. Kesavartini Savarimuthu joining us there, European Power Markets team at Bloomberg NEF. Tom.
OK, coming up, we're going to talk to Harriet Rees, Chief Information Officer at Starling, as the bank launches the first ever AI personal bank, as someone who also sits at the heart of conversations at the BOE and the UK government as well in terms of how to integrate AI solutions across the financial services space. So an interesting conversation coming up. Stay with us. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back. Now, UK Chancellor Rachel Reeves says she wants the UK to be the G7's fastest AI adopter. While the US has led the world in developing AI, surveys suggest the UK lags only France in terms of adopting it, with 39% of the working-age population using generative AI tools, according to the latest data. And it appears Starling Bank got the memo. They've just launched Starling Assistant, which they say is the first ever AI personal banker. Harriet Reeves, Chief Information Officer at Starling Bank and co-chair of the Bank of England's AI task force, joins us now. Harriet, and we want to get your views on how the BOE is thinking about this, how the UK government is thinking about AI adoption. But let's start with this AI agentic assistant then. What exactly is it? What does it actually do?
Yeah, it's a really exciting time for us at Starling. So up until now, generative AI has been used primarily to serve information or guidance to consumers in the financial services space. But with the Starling Assistant, we're moving beyond that. And this tool can actually take actions on behalf of the customer. So you might want to set up a new payee, you might want to move money around your account, you might want to cancel your card. And all you need to do now is tell the agent that by a voice or in natural language text, and that action will be carried out for you.
You can do this via voice. Do you think, so presumably you think customers are going to embrace this. Do you think it leads to further customer acquisition for Starling? And how do you address concerns about security and fraud?
Yeah, so at Starling, we've always been about using the latest technology to pioneer what banking experiences can look like for consumers. And using agentic AI is no different. We really see this as the beginning of a new era for experiences, and we'd like to show customers that AI can help them to manage their money by being more proactive about the actions that they take. When it comes to the security and the fraud aspect, of course there are risks here, and that's why we've been in pilot and testing with staff and customers for about 9 months. That's got us to the point where we're really comfortable that we can put these technologies into the hands of customers, and we're really excited to see how customers get on with them.
Yeah, Harriet, it sounds like you're very excited. The whole sector, no doubt, is moving in this direction. But, you know, speaking for a friend, if I'm a person who hasn't even used an agent to book a table at a restaurant yet, do I really want to rely on it to do banking? I mean, what's the appetite for this kind of product amongst customers?
Curiously, from our consumer testing, we found something really unexpected. We thought that it was going to be all the young tech-native people that were going to love this tool, and that we might struggle to convince some of the people that were less tech-savvy to use it. But it was actually the opposite. Customers found the ease of being able to simply ask an agent to carry out an action and then be able to see within their banking app that that's being carried out as they requested, to be something that they found very heartening and very empowering.
Yeah, I mean, you're a relatively new business, and I mean, a lot of bigger banks have loads of legacy systems that sort of talk to each other with different degrees of success. How easy has it been to introduce something into Starling? How would you say the sector is going to be able to introduce this kind of AI tech?
For sure. So at Starling, this tool is the culmination of about 8 years of machine learning and AI development and research. So it's been a long time coming, but of course there have been many incremental and iterative steps on the way. I think for the industry, for sure, siloed data stacks and legacy technology are going to play a part. But I'm starting to see lots of movement in the industry, and in my AI champion role, I'm really excited to see firms embracing what AI can bring, both in the back office and starting to see in the front office too.
What would you ask the government to do? If there's one thing the government could do right now to accelerate this kind of innovation and adoption, what would it be?
So at the moment, the government has appointed financial service champions, as myself, simply to get in there and understand what the barriers are for consumer banks. What we're understanding is that there's some inconsistency around the comprehension of regulation in UK financial services. So there's obviously more we can do to make sure that firms comprehensively and consistently understand that. And then we need to think about the longer term of how we use UK infrastructure to support the AI development in the financial services sector and the wider sector and industry here in the UK.
There were a number of themes coming into play here, aren't there? Because there's, yes, the UK government's push into AI, the banking sector to some degree embracing that, and we're talking about that this morning. The government's also wrestling with technological sovereignty, though, and questions around that. And I wonder where we are on that in that conversation, because the UK relies on a lot of compute from abroad, a lot of cloud storage from abroad, not to mention the actual AI technology. What's the progress being made on that front?
Yeah, so I think absolutely everyone can see that our move into AI right now, whilst we are accelerated, particularly in the financial services sector, is reliant on US technology. And so we as a country do need to think about what our strategy is moving forward to remove that complete reliance on the US and perhaps to mitigate it with other relationships on the global stage or with our own sovereign strategy. Of course, the UK AI strategy tackles that, but I think there's more we can do, and I'm excited to be part of that.
There was a story, our own team reported out the story around HSBC and potentially massive cuts to the workforce that they're thinking about in the years ahead as they adopt AI. That is the risk, isn't it? We adopt AI, jobs in the banking space go.
Of course. I think there's an obvious productivity and efficiency gain when it comes to AI technology, and it's good to see banks embracing the spirit of what AI can bring in the back office. But I think it's a real shame if that's all we talk about when it comes to the power of this technology. There is so much more that AI can bring. Just like 10 years ago, none of us did our banking on a banking app. In a few years' time, not now from now, we might be asking, how did I do my banking without AI?
Harriet, thank you very much. Thanks for joining us. Harriet Rees, Chief Information Officer at Starling Bank. 8:55 here in London, Tom, and typically at this time of a Friday, our thoughts turn to, well, sport, it seems, for this weekend. It's nothing but sport,
finally,
is that right?
After this week. Well, there's a little bit more than sport, but let's see what else is on the docket then for this weekend to keep you entertained. So, you've got the NCAA March Madness begins. You've got the EFL, of course, Cup final. Arsenal, Manchester City. Good luck, Arsenal. Real Madrid, Atletico Madrid. That's going to be epic, isn't it? The two historic rivals, of course. The Miami Open begins, tennis. And this is Anna Edwards' favourites. It's the comeback of BTS. Anna's going to be tuning in. This is
well, it takes place, my understanding, it takes place in Seoul, but there's going to be some sort of global live streaming event.
Don't pretend that you haven't already bookmarked this.
Yeah, I've not really done a deep dive into this subject this morning. I got rather distracted. In fact, they've given an interview to Bloomberg Business Week, so I got rather distracted by the content of that. But anyway, interesting to see them back. They were such a force in terms of Korean pop culture, and taking it global became something of an obsession.
So Anna Edwards is going to be at least half of the 82-date world tour, so they got set up. A free concert in Seoul, so 82 dates, 250,000 in-person fans on Saturday, streamed on Netflix to more than 190 countries. They could be generating just $1 billion in revenue, just $1 billion when it wraps up in 2027. OK,
and if that's not enough for your weekend, of course, you can catch Bloomberg Weekend. The TV channel over the weekend is now it's now live and available to you. There's also a newsletter. We bring you a collection of interviews, ideas, stories that explore the fascinating places where finance, life and culture meet that might or might not feature BTS and all things to do with Korean culture. That is it for the opening trade. The Pulse is up next, 8:56 here in London. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Gurray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Iran is pressing ahead with attacks across the Persian Gulf, even after Israel signaled it would stop hitting energy targets in the Islamic Republic. Analysts warned the energy crisis may deepen, with Brent gaining almost 50% this month. Plus, the ECB's Joachim Nagel says the bank might need to consider hiking rates as soon as next month. We discuss the outlook with the governor of the Central Bank of Ireland a little bit later. Now, this is the market's overall look. Of course, the focus is what's happening on the energy markets and everything that we've seen over the last 3 weeks. Again, oil set for the weekly surge. If you look overall at U.S. stocks, they seem to be wavering. Again, U.S. stocks swinging between small gains and losses. Oil prices seem to be a little bit more steady and cautious trading. Sentiment definitely very sensitive to the escalation in the war in the Middle East. I'm also looking at a couple of what traders that we're calling say, and they're parsing every geopolitical headline because they worry about supply chains, they worry about the surging price of gasoline and jet fuel, and you can see euro dollar 115.56 for the moment. If you look at European markets, they're a little bit higher. I guess they're about 0.6% higher. We did have a sell-off yesterday. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Iran is pressing ahead with attacks across the Gulf, despite diplomatic efforts to ease growing tensions from the Iran war. Now, Israel says it will no longer target Iranian energy sites after sparking retaliatory strikes and a rebuke from President Trump. Now, the Prime Minister Netanyahu also pledged the help of Israeli forces to reopen the Strait of Hormuz. The threat of rising prices as a result of attacks on Middle Eastern energy sites have forced central banks around the world into holding rates, with some warning that hikes may be on the way. Now, the Fed, the ECB and the Bank of England, also the BOJ, all making difficult policy decisions this week. With us, Yari Sten, Chief European Economist for Goldman Sachs. Yari, thanks so much for joining us. Good morning. I mean, first of all, how difficult is it to predict the price of oil? Because everything depends on how long this lasts. It doesn't look like there's any kind of real escalation. So could we see 150 to 100, or does it stay at these levels but for much longer?
Yeah, as you say, it's very difficult to predict. So we really have to think in terms of scenarios, I think, here. So we've laid out different scenarios for how long the flows through the Strait of Hormuz might be disrupted. Our baseline is 21 days, in which case we see oil at 110 around current levels. But we have a 30-day disruption and a 60-day disruption case, in which case the price of oil might go to 130 or 150 in that very adverse scenario. So that's the way to think about it at the moment. And then as we learn more about how the energy situation evolves, we have to sort of update our probabilities on these different scenarios.
So what does this mean for the European economy? On inflation and growth?
Right. It's, I think, easy on headline inflation. We're clearly going to get a big boost here to headline in coming months. It's also relatively straightforward for growth. We're going to get a hit, possibly quite a sizable one. And to give you a sense, we have downgraded our GDP forecast by about 0.5% so far, which is quite significant. We've upgraded our headline inflation forecast to rise towards 3%. That's the relatively easy part. I think the really hard part for central banks is to judge to what extent you could get persistent effects into inflation, second-round effects, which, of course, yesterday in the ECB's press conference was a key topic. And here, I think the lesson really has been, if the shocks are moderate to energy prices, you can probably look through them. But if they become big and persistent, you get second-round effects and you have to respond.
But how do you know if they're big and persistent, given it's a supply shock?
It's very hard. So, I mean, passage of time, obviously, is one element. Do energy prices kind of stay this high for a long time, or do they come down? We can see that. What is happening to the forward curve for energy? I would still say that is saying that we should see some relief in coming weeks and months. But we can also look, of course, at any damage to the energy infrastructure, because the more we see, the harder it will be for flows to resume. Those are, I think, the things we have to focus on immediately. The next stage is then to look at early signs of second-round effects, inflation expectations, firms' pricing behavior, wage demands, and so on. And, the message is we're watching all of this, and over the next 6 weeks, by April, we might have news on this, as Joachim Nagel, of course, said this morning.
But, I mean, if we have a hike from the ECB, I mean, first of all, let's just talk about market expectations, because they're expecting the ECB to react in a completely different way to the Fed.
Yes.
I mean, is that right? Does it feel fair, or is it because it's a different type of, investor that's looking at these?
I think it's fair to look for somewhat different responses here, right? So, first of all, the US is more insulated from this as a net energy exporter. The Fed also has a dual mandate, has a weakening labor market coming into this, which the ECB does not have. So I think that's an important difference. And then also, I think there's a bigger scar in Europe from the 2022 energy crisis. And of course, the ECB in the past has been much more responsive to these type of headline pressures, sometimes rightly, sometimes wrongly. But so I do think some difference there is appropriate, but the difference probably is a little bit too pronounced in current market pricing. But that gets back to the point of uncertainty that investors obviously are not just looking at what is most likely, but they're also trying to price the range of outcomes. And I think there are risks that if the energy shock continues to build, that you could get a lot of hikes in that scenario. And I think that's within the pricing as well.
But is there a danger that a rate hike from the ECB in April could look like a policy mistake?
It's possible, and that's what they need to balance. I think Philip Lane said we have two scars, one from 22, where we wish we had responded earlier, but we also have one from 2008 and 2011. So we have to balance that. And so, ultimately, if they do hike, we have a scenario, if energy price pressures continue to build, we have a scenario where they hike 3 times, June, July, September. But then we think they would probably unwind those hikes next year already, because the economy would weaken, global growth would weaken in that adverse scenario. And so I think that's also important to think about how sustainable would those hikes be. But I think the view within the ECB is, if these pressures continue to build, if you get second-round effects, the ECB has to send a signal to wage setters, to price setters, and say, we're protecting the mandate.
What does it mean for the Bank of England? I mean, they're looking at it very differently.
They are looking at it differently, and I think that was the much bigger surprise yesterday in terms of the communication. In our mind, the situation is somewhat different because rates are still restrictive in the UK. The labour market is weaker than it is in the euro area, and so we were surprised by the hawkish message in the committee communication that said, if this continues to build, we might have to act in 6 weeks. That was a very strong message. Governor Bailey balanced that a little bit later in the day, but I think we are left with a significant chance that the Bank of England also responds to this. And to me, that's a bit of a surprise because I think the weakening that we're seeing in the labour market in the UK, the restrictive level of rates, to me does suggest that there's a bit more time that the Bank of England has, whereas the ECB starts from a neutral level and a pretty solid labour market, and so I can see the urgency a bit more there.
Yeah, I mean, is there any doubt in your mind that, again, if we have a protracted, months of these kind of oil levels, that we go into recession?
I think it's quite possible. It's not what we are showing even in our very adverse scenario. Yeah. The reason being that the pre-war baseline and outlook was actually a pretty good one, right? And so, this morning we got new fiscal data out of Germany. The fiscal expansion is underway. We actually saw in the fourth quarter some increase in consumption. We actually had a pretty constructive view, and so did the ECB prior to all of this. Now, this is changing, but I would say that the hurdle to be pushed into an outright recession is a little bit higher than it was in 2022, just because the starting point looks a bit better. But it's entirely possible and a function of what we're seeing in terms of energy prices.
Yeah, is it possible that we're doing just much ado about nothing? Because we have a lot of stockpiles that are being released, and let's say there is a kind of diplomatic resolution over the next 2 weeks that we can actually look through all of this.
That's also possible.
But is it a 10% possibility? Or, how difficult is it to, you talk about scenarios, which is probably, it's also the way that central banks, we understand, are looking at it. How do you attach probabilities to that?
It's hard. I think you there really have to take a view on two things. You probably have to take a view on the conflict itself, but you also have to take a view on, even once the conflict stops, how quickly can those flows normalize. And that, I think, is still a little bit unclear, because it does depend on how quickly the gas production can come back. Do we find any more damages to the infrastructure? And I think that's really the focus now over the next weeks, to see how persistent those energy prices will end up being, because that's ultimately what matters for the economy. It's not so much the peak, it's really the persistence of this.
And also, it could have a big impact even on the U.S. consumer, right? If people read this and worry about inflation of their jobs.
Yes, absolutely. And I think what's different this time around is that it's a more global shock than in 2022. 2022 was primarily about European gas prices, whereas the rest of the world, if you looked at the US in 2022, there was still fiscal stimulus. The rest of the world was growing quite nicely, and Europe got hit with a shock, which meant that the response in 2022 had to be quite aggressive. This time around, you have to balance that, because it's as much about oil as it is about gas, and that will also affect the US. We've downgraded our forecast also in the US, less than in Europe, because the US is a net exporter. But through inflation, through the effect on affordability and consumers, there's also going to be some effect there.
Yeah, when you look at, I guess, all of the data points, and we have hundreds of them all across Europe and the world, are there a couple that you're really looking for to give us an idea of sentiment, or something taking a turn for the worse?
Yeah, we're very focused on the early surveys that we're getting, and we had a couple of very early surveys, for example, the ZEW survey or the Centix survey. These are surveys more amongst investors, but they can send helpful messages around turning points. And if you take the ZEW, for example, that fell very sharply earlier this week. So I think that's important to monitor. It's not always a perfect indicator, but it does help to give you a sense of the risk around the turning point. So I think the flash PMIs next week are going to be very important. And of course, they are part of the list that President Lagarde provided yesterday of key indicators that she's watching. And I actually thought that was important. She didn't just list inflation expectations in energy prices, but she also listed the PMIs and surveys. So there's some balance there also.
Okay, Jari, thank you so much, as always, for joining us. Jari Sten, Chief European Economist for Goldman Sachs. Now, coming up, the Iran war pressures, emerging markets. We'll be speaking to Jakov Arnopolen on why he thinks the sector is still surprisingly resilient. He's coming up next, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Well, energy prices have stabilized from yesterday's dramatic moves after Israel said it will no longer target energy infrastructure. Their attack on an Iranian gas field sparked retaliatory strikes against energy assets across the Middle East. Will Kennedy, Bloomberg's news director for Europe, Middle East and Asia, is here. So, Will, good morning. Do you think, or do you have a read on how much physical and political damage has actually been done by these energy attacks?
We know quite a lot about what happened in Qatar the night before last. The Qataris have put out a statement saying that 2 of the LNG trains in that massive plant have been hit, and that will cut capacity by 17% for up to 5 years. So that really gives you an illustration of how severe that attack was. Elsewhere, we're not entirely clear. We've seen attacks on many of the region's oil refineries, and those are shut down partly because of those attacks, but partly also because they're not getting the crude they need to be able to run, and they can't export what they're making because the Gulf of Hormuz is closed. So we won't really get a clear idea of the wider long-term impact until the strait is open again and people can restart and the flow of crude and oil products out of the region can resume to somewhere close to its pre-war levels.
Well, major central banks, of course, are this week's warning of future likely rate hikes due to spiking energy prices. What are the long-term implications for global economies and energy?
Yes, I mean, I think your previous guest outlined it really well, but the gas change will be significant. Not only will we lost that 17% of Qatari gas, which is probably somewhere in the region of about 4% of global, 3 to 4% of global production, but that plant is completely closed. It will take a long time to start up. They're going to have to be very confident about the safety of the Strait of Hormuz before they put any gas through that that straight. So we had been expecting a big glut in global LNG markets over the next few years. It was probably something that central bankers were looking at and seeing this could be a source of relief for global price pressures, especially in Europe, which had been so damaged by the energy costs of the Ukraine war. And now that has totally changed. The outlook for the gas market has totally changed because of this war, and it's probably changed for a number of years. In crude oil, it's a little harder to say. The crude oil market can probably revert back to normal more quickly. But as everyone says, the longer the straits close, the bigger and wider the disruption, and the longer it will take for oil prices to get back to where they would have been. I think at the very least, we can say that the forecast for prices this year are now completely changed, and we will see them higher for longer as the disruptions build up and it takes longer to unwind if and when the Straits of Hormuz do reopen again.
Well, thank you so much, Bloomberg's news director for Europe, Middle East and Asia, Will Kennedy. Now, the war in Iran has dealt a blow to one of Wall Street's favorite trades, buying yen. My next guest believes the emerging market sector with emerging markets is remaining surprisingly resilient in spite of geopolitical stress. Well, let's speak to Jakov Arnopolen, EM Portfolio Manager at PIMCO. Jakov, so good to speak to you. So first of all, I mean, the focus on emerging markets, given the price of oil, has been quite significant. Does it change your view on any of them?
Yeah, I'd say in general, given the prevalence of commodity producers among emerging markets, I mean, the sector has been quite resilient. And obviously, there's been some repricing in FX, I'd say largely in line with G10 currencies, and quite a repricing in the rate side. A lot of that to us is a question of some of the heavy positioning getting unwound, pricing in the inflationary shock we're living, obviously, the shock to headline inflation specifically. But what is probably not reflected yet is the likely hit to growth and potential demand destruction. So with that in mind, we're just starting to see value in the long ends of curves in Brazil, in South Africa, in the Czech Republic.
So, I mean, I know you had a certain, a way of looking at emerging market local bonds in January. Do you continue to favor emerging market local bonds over hard currency, debt amid this recent volatility?
Look, I would say there are spots of value across the spectrum in EM right now. Inevitably, the market, the knee-jerk reaction is sell the importers, buy the exporters. Right. That's like the first line of defense, so to speak. Having said that, when you actually look under the surface and see how much mispricing there now is in the market, I would say even some of the commodity importers that have large reserve buffers and credible policy, they've actually withstood the shock pretty well. I mean, Turkey comes to mind. They've accumulated 200 billion reserves. And we shouldn't forget that beyond the current oil and gas spike, gold is up 2x, over 200%. It's doubled in the past 2 years. So a country like Turkey that has half of its reserves in gold, right, the buffers have grown so much. So they're very much able to withstand the shock. And actually, anecdotally, as much as bond managers, we always think about the downside and worried about the worst case scenario. But if we do project some sort of benign denouement to this, which is not impossible, Turkey, a country, it's a $1.5 trillion economy. The trade with Iran, its neighbors, all of $3 billion. It's a drop.
Right.
So again, to the extent there is something good comes of this, and there's still hope, the trade could skyrocket. They could import energy from Iran. Turkey is a huge manufacturing hub that Iran could benefit from. So there are right tail scenarios that I think we should consider as well, for the region.
Well, yeah. So where do you seek shelter? Again, is it the oil exporters, or you go to like a Latin America currency?
Well, LATAM stands to benefit because, one, you have obviously the geopolitical angle, which has been quite favorable thanks to the Donroe Doctrine, and quite a few countries in the region are commodity exporters. So there is a reason that Venezuela has performed so well. There's a reason that Argentina has performed so well. In fact, I will also argue in Argentina, the market is pricing in the fiscal prudence, but probably not pricing in the potential growth in Vaca Muerta, which is the oil-producing region, where production could grow significantly more even than the projections. But yes, Brazil looks very attractive in the current context.
So you would go to currencies in Latin America over even oil exporters?
Realistically, that's where you probably have the clearest, the dotted line, you have the clearest beneficiary is Brazil, and certainly the currency looks very good right now, given how much oil they export.
In terms of, again, emerging market, what's the biggest risk? Is it inflation or growth because of the oil shock?
That's the toughest thing to trade in an environment where you have this uncertainty and we don't know how long the situation will last. The toughest thing to trade is a handover from the inflationary shock to demand destruction. The curves have bear flattened, right? We've priced in more hikes. Now, in our view, probably more hikes than are likely to take place or are justified. Because specifically we should then see demand destruction. And we're seeing some of that happening in Asia as well because of regulating energy. And that's why also Asia to us remains quite vulnerable. There is this also notion of EM equities very heavily exposed to Asia. EM debt probably, there are better benchmarks. They're more diversified, less Asia exposure. And Asia naturally a huge importer of LNG, of oil from the Middle East. So when we look at our portfolio right now, we're quite cautious, for example, on currencies in India, big oil importer, and that's also a good offset, like good relative value to have versus Brazil.
How are you hedging your portfolios?
Well, the reality is we're quite cautious around some of the frontier markets, again, in Asia. Pakistan comes to mind, Sri Lanka come to mind. I would just have to be nuanced again. It's a far cry from 5 years ago, where we really were concerned about defaults in both of those places, and Sri Lanka naturally defaulted. Pakistan, although small economy, frontier economy, reliant on oil from the Middle East, they have a bond coming due in a couple of weeks. I think they'll have no issues repaying that bond. It's a question of there's broader vulnerabilities and more risk premium that should be priced into the longer part of that curve, and the same goes for Sri Lanka.
Longer term, and again, this is all dependent on how long the war lasts, what it means for oil prices, and how long they still elevate or whether they spike up from here. So do you revisit this every day, every 2 weeks, every minute? So you're really...
Look, I think we're blessed to have a team that follows this around the clock in every possible time zone. And, the situation is constantly changing. So, we're there trying to, walk between the raindrops. Again, to me, it's back to a lot of interesting opportunities being created. And with that, to the thesis, I think the EM thesis is still intact, other than this kind of blip, more than a blip. But nonetheless, the thesis of a lot of our investors looking to diversify away from developed markets. Investors largely correctly perceiving emerging markets as being a commodity play, which it is, whether we're talking about gold, as we discussed with Turkey. The same goes for Uzbekistan, Kazakhstan, or oil and gas. So net, the sector should actually weather the storm quite well relative to the shocks of 22, 20, and prior to that.
But Jakov, let's say there's an off-ramp, diplomatic or otherwise. Does everything go back to normal?
It'll be difficult to put that genie back in the bottle, simply because the shocks will take a long time to play out. There's damage to infrastructure, so naturally we don't want to be dismissive of the situation. But even looking at the Middle East, for example, which is the epicenter of all of this, when we think about the Gulf states and we think about Gulf credit, the starting point is very strong. We're talking about AA balance sheets, single A balance sheets. So as much as there has been a disruption, there's a lot of damage to the infrastructure, because they're starting with large reserves. Qatar comes to mind, over 70 billion reserves, over 500 billion in the sovereign wealth fund. They should certainly be able to weather the storm and handle this deterioration. Although, again, I don't want to dismiss that this is an overnight situation. Certainly is not.
Jakov, thanks so much for joining us. Jakov Arnopolin, their EM portfolio manager at PIMCO. Now, this is a picture for markets. We look at the markets every 15 minutes. The focus firmly on what's happening in the Middle East. We're looking at European markets, and they're still a little bit on the way up. Oil set for a weekly surge, again, as the Middle East war heads towards its fourth week. A couple of other things we need to watch out for. Joachim Nagel saying the ECB would need an April hike if the price outlook continues to sour. And then, look, investor sentiment has clearly shifted into a more bearish positioning. Traders, I guess, parsing every geopolitical headline after the conflict upended energy supply chains, but also that meant it was led to a surge in prices for gasoline and jet fuel. Coming up, insurance costs for vessels crossing the Strait of Hormuz soar. We'll discuss the challenges facing the reinsurance industry next with the SCOR chief executive. That's coming up next, and this is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Iran is pressing ahead with attacks across the Persian Gulf, even after Israel signaled it would stop hitting energy targets in the Islamic Republic. Analysts warn that the energy crisis may deepen, with Brent gaining almost 50% this month. Plus, the ECB's Joachim Nagel says the bank might need to consider hiking rates as soon as next month. We discuss the outlook with the governor of the Central Bank of Ireland. Now, the cost of insuring ships to sail through the Strait of Hormuz has soared, unsurprisingly. You might be more surprised to learn that it's still possible to get coverage. Well, sources within the industry have told Bloomberg that premiums have jumped fivefold. So an oil tanker worth $100 million would now cost $5 million to insure. With us now to discuss the outlook for the broader industry is Thierry Léger, the chief executive of the French reinsurer SCOR. So thank you so much for joining us, Mr. Léger. Talk to me, if you look at risk and actually shipping and everything, how does it change your industry fundamentally?
So the shipping industry is obviously very old, and the industry of insuring those vessels is more than 400 years old. So it's an industry that has transformed through times and has seen many wars, and I think it's a very grown-up industry that can deal with disruption.
Yeah, I mean, does this one feel different because we don't really know where it ends, or is this just the nature of any war?
Every war is different. This one is again different. I think the special piece here is that all these vessels now blocked in the Strait of Hormuz, they cannot back out of the war zone, right? Typically, when there is a war, you back out, and that's what the vessels do. Here, the problem of the owners and of the insurance companies is actually they cannot back out. They're blocked there, and that creates, again, a new situation that people have to deal with.
Yeah, I mean, yesterday we had this incredible Bloomberg story. That means that there were 40,000 crews actually in some of those ships. Talk to me about what it means for insurance and insurance premiums going forward. Again, could this be short-lived, or does it actually change the level of shipping premiums longer term?
Yeah, clearly, most of the insurance industry will not be impacted by this because generally we exclude war. So war is a very specific cover designed for typically airplanes, vessels, special buildings. So for the vessels, again, war covers, specific war covers exist for very long. It's very clear with this event that the prices will go up. You said it in your introduction, prices have gone up already. You have to imagine, right, this is a burning house, and you insure a vessel that is actually in a war zone and will remain in the war zone. Yeah. So the courage it takes to keep the insurance is considerable, and it needs considerable experience to do so.
Mr. Leger, how has the nature of insurance and therefore reinsurance changed with, climate change concerns, with some of the big weather events, but also now with the advent of AI?
Yeah. So there are two things that really have happened this year. One is a few things that happened. So one is the polarization of the world. Everything gets more extreme. You're either for or against it. The other one is climate change is going on and continues to put pressure on the claims on the insurance industry. We have to adapt our models and so on. So it's very demanding. And the third element is the digitization. You have to imagine that in the insurance industry so far we were used to insure something we can touch, something tangible. When you leave your house, you can see if the door is open or not. Now we have to insure intangible digital world that is rapidly evolving, including AI. So it's a challenge, but it's also a great opportunity.
I mean, the other, I guess, you're very exposed to the possible rise in interest rates, which at the moment we really don't know what happens given all the uncertainty on whether this hits inflation or growth. And of course, there are different scenarios if you're the Fed, the ECB, or the Bank of England. But how sensitive are you to interest rates? Yeah, so we, as an insurance company, reinsurer, we obviously have to match both sides of our balance sheet. We have to make sure that assets and liabilities are matched, whether the interest rates go up or down, right? So that's part of the core business of what we do. So the only answer I can give you is we are economically matched, and therefore whether the interest rates go up or down, we should not be immediately impacted by that. In the longer term, we do actually profit from interest rates going up because it allows us to put our premium into assets that have a higher reward. I mean, given all of this, what's your priority for the next 12 months for SCOR? Yeah, the absolute priority now is to watch the markets. We have to make sure that we are being very nimble. You mentioned interest rates. I would also mention inflation. So the inflation outlook is again higher than it was before. Inflation is something we have to deal with as a company, of course. And then we have to watch the war itself. Yeah. The longer it goes, the more, obviously, it is a risk to the industry. What does, being nimble for a reinsurance company look like? Is it a more streamlined process? Is it organizational? What are you thinking? Yeah. So the most important nimbleness is about how you take decisions. I mean, fast decision-making, but it has to be informed, right? This is, by the way, where AI helps a lot. That it informs us faster to make a decision fast. That's important. But then you need the capital nimbleness. You need to be able to shift capital to the areas that have the highest opportunities and take it away where it's not the case. And the third element where you have to be nimble is in terms of the organization. We have to make sure we have little layers, which is, by the way, something we have adjusted 2 years ago, and is allowing us now to be much closer to markets and actually adapt the company to what's coming. Okay, thank you so much for joining us. Thierry Léger there, the chief executive of the French reinsurer SCOR, with a good conversation on shipping, inflation, and of course, what's happening in the Middle East. Coming up, the ECB keeps rates on hold, but could they hike as soon as their next meeting? We discuss all of this with Gabriel Makhlouf, the Irish Central Bank governor. That's coming up next, and this is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Now, Dubai has long sold itself as a safe haven in the Middle East, but Iran's unprecedented strikes on U.S. partners across the region are putting that reputation under pressure. Well, Bloomberg Originals has been looking at how Dubai's model of stability is being challenged.
These attacks were unprecedented. We could not have imagined this scenario actually playing out.
Most airports and airlines in the region are affected.
Drone has hit a residential tower overnight in Dubai. It sparked a fire and residents were forced to evacuate the building.
This conflict has come to the doorstep of a territory that many perceived to be one of the world's top safe haven territories.
That perception was by design and helped attract both money and talent. The strikes threaten more than lives and infrastructure. They're testing Dubai's model of stability and the image it wants to project.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead. We've already won in many ways, but we haven't won enough.
Thousands of deaths across the region have been reported in the war begun by the US and Israel. Iran's wave of retaliatory strikes targeted US allies, prompting the UAE to prioritize safety above all else.
Iranian strikes have hit airports, military bases, even data centers.
The UAE has seemingly defied what many assumed would be an existential threat. It's navigated peril before, but with war on its doorstep, can it do it again?
Well, subscribers can watch that documentary in full on the Bloomberg terminal and on Bloomberg.com. Now, Bloomberg understands the Pentagon has asked Congress for an extra $200 billion to fund the war in Iran. Now, sources say the request has been sent to the White House for review, and President Trump is yet to sign it off. When asked about the $200 billion figure, the U.S. Defense Secretary did not deny it, but said the number could move.
As far as $200 billion, I think that number could move, obviously.
it takes money to kill bad guys. So we're going back to Congress and our folks there to ensure that we're properly funded for what's been done, for what we may have to do in the future.
Let's bring in Laurel Rapp, U.S. and North America Program Director at Chatham House. Laura, thank you so much for joining us. I mean, first of all, we're in like the third week now of the conflict in the Middle East. Does the U.S. want out? Does it look like they're looking for an off-ramp?
It's really not clear at this stage. The U.S. says it is continuing airstrikes. It is continuing to hit military targets. It wants to take out that ballistic missile system. There may be emerging splits with the Israelis here, right? We saw Israel hit one of Iran's largest natural gas fields, South Pars, over the last couple of days, with huge Iranian responses in Qatar's LNG ports. And so the economic costs here are rising. We know these are things the Trump administration cares deeply about because they hit Americans' wallets. This is a big voter issue. But we have not seen a clear path to de-escalation at this stage or a plan forward.
So what does Iran want? Do they just want to inflict maximum pain in terms of energy prices for President Trump?
That's right. They know they have a couple of trump cards to play here. They know they can have huge economic dislocating effects here in the global energy market, but they also know it isn't just confined to energy. They can target and threaten the Strait of Hormuz, and so very little traffic is passing through Hormuz at this point, disrupting global commerce, raising prices across the board for every country that trades. That's everyone.
But to what end, Laurel? So is it trying to get Europe to engage more, to engage in the conflict? Is it to try and get China involved because everybody has to lose with the higher price of oil, or is it just to get the U.S. to back off?
If we know anything about this Iranian regime, we know that it is focused on survival, right? This is an existential battle for the Iranian regime and the senior leadership and the Revolutionary Guards Force. And so they are going to try to inflict maximum damage for as long as they can, for as long as the U.S. and Israel is hitting them militarily.
I mean, would Israel back down? I mean, can the U.S. convince Israel to back down?
This is a question. We've seen Israel conduct unilateral strikes against Iranian targets over the past years. We've seen joint strikes between the U.S. and Israel. And so the U.S. could say, we're done, we're going home now, and Israel may want to continue. Look, the Iranians also have a huge vote in this, too, and they can choose to retaliate in any number of ways. And we know this has been a huge risk as the U.S. has looked at past contingencies on Iran to say, what are the tools Iran has in its toolbox? It has proxy forces across the region that can hit U.S. troops and allied partners, and it has this huge commercial leverage of controlling Hormuz.
Was this a gross U.S. miscalculation?
The U.S. didn't really seem to have a plan here. They went in with a whole range of shifting and conflicting goals and objectives here. I used to be a policy planner at the State Department, a U.S. diplomat, and you start a plan with a set of goals. You say, what is your goal? And then you build a plan to achieve that goal. And you apply U.S. tools in service of those goals and those ends. And as far as we've been able to see publicly in the early days, there was a really shifting set of goals here. And so that makes a plan really difficult to execute. It also makes it a bit easier to decide when to stop. Because if you can shift your goals, if you can be more flexible, President Trump can say, all right, today we're done. Maybe the costs have become too high for the American people. And so we're gonna pack up and we're gonna go home. But that's sort of the fundamental issue here is Iran has been a threat to the U.S. for many years and to partners and allies. But this standard of was it an imminent threat? This is the threat that is sort of in international legal circles that we haven't seen real evidence to suggest.
So, I mean, I guess two questions: where's Congress in this, and what does this actually mean for the midterms?
Congress has not been a major player in this. Congress has the prerogative, the authorities to authorize the use of force in military conflicts abroad. The U.S., the White House has notified Congress that it is using military force, but it has not sought authorization for it. And efforts to constrain, Democrat-led efforts to constrain, and some Republican efforts to constrain the president here in the White House have been voted down by Congress. Look, this isn't surprising. We've seen this Congress give this White House enormous latitude to conduct military operations abroad. We've also seen Congress use similar restraint in trying to shape the White House's military actions when President Obama was going into Libya, when President Bush was going into Iraq. And so there is often, in the Congress-White House relationship, a lot of latitude given to the president. We're seeing that here, too.
Okay, Laurel, thanks so much. Laurel Rapp, their U.S. and North America Program Director at Chatham House. We'll have to come back because there's a lot to talk about, given the midterms are about 6 months away. Now, the ECB will need to consider hiking rates as soon as next month if the Iran war exacerbates price pressures. This comes from the Governing Council member, Joachim Nagel, who told Bloomberg that a rise in inflation might force a more restrictive stance on monetary policy. Well, joining us now is Gabrielle Makhlouf, the Governor of the Central Bank of Ireland. Governor, thanks so much for joining us, as always. So, look, the ECB baseline forecast has basically built assumptions of more than 40 basis points of rate hikes this year. There's also still an inflation overshoot in the medium term. So when should we expect a hike?
Well, at the moment, we are, like everyone, trying to manage extreme uncertainty and trying to understand what the facts are as we make decisions. What we included in our baseline reflects a number of things, but in particular, it reflects our determination that we're going to achieve our price stability target of 2% in the medium term. The market expects, and it's in the baseline, 2 hikes, and I can well understand why they've assumed that. I mean, for one thing, they understand our determination to meet our target. But we have no predetermined path. And I think what we said yesterday and what I'm saying today is we need to keep a very close eye on the data, on the facts, on what's happening. When we come together again in April, we'll look at all those and we'll make a decision.
Do you agree with Governor Nagel that the ECB may need to consider hiking as soon as next month?
Well, if the facts, I mean, I agree with him, and I don't. I mean, what I've just said is that the facts, if the facts point to us having to take action, we're going to absolutely take action. But in the end, it depends on the evidence, and quite clearly, we are 6 weeks away from having to make another decision. And 6 weeks is, in the life of this particular shock, of course, is a very long time. So let's see where we are in April. In the end, the most important thing is our determination to achieve our 2% price stability target in the medium term.
Governor, financial conditions have tightened really quite a bit since the war started. How is that helping manage inflation pressures? And does that potentially actually buy you just a little bit more time before you need to consider hiking?
Well, it certainly plays a factor, but I think what we're going to have to keep a very close eye on is what happens to commodity prices in general, what's happening to demand, what's happening to the labour market. I mean, all the sort of second round effects that we worry about in particular are the sorts of things we're going to have to pay attention to. Financing conditions will obviously play a role, but in the end, and I'm sorry to keep repeating this, but I think it is important that we are determined to achieve our 2% target in the medium term. And the baseline projections that were published yesterday although we've got a spike in inflation this year, they do go back to the levels that I would be comfortable with in the medium term.
But so, I mean, again, is every meeting now a live meeting, potentially?
Well, absolutely. But I think every meeting in the past has been a live meeting because we have, for some time, adopted a data-dependent meeting-by-meeting approach. So I think it would be wrong to come to any conclusion that there are the opposite of live meetings, dead meetings. I mean, meetings are moments when the Governing Council comes together, looks at the evidence, looks at the projections that our staff put together, and we come to a judgment. So,
okay, guys, Indian market is going to close. क्रूड ऑयल थोड़ा सा और एक्सपेक्ट था, नीचे आया ही नहीं अभी तक। देखते हैं क्या करता है, गिरता है या फिर कंसोलिडेशन में फंसा रहता है। लोअर एंड पे कल बताया था लेवल 8000, 450, 400 will be a next support zone. कल अच्छी सेलिंग आई थी, वापस रेजिस्टेंस जोन से बाइंग में तो मार्केट पूरा एक बार बाइंग आई, उसके बाद से साइडवेज ही हो गया था। सेलिंग में मोमेंटम जरूर अच्छा आया, नीचे तक पहुंच गया था, मॉर्निंग पे हल्का सा गैप डाउन भी हुआ, उसके बाद रिकवर कर गया वापस। ब्रांड क्रूड ऑयल को देखोगे, कल ब्रांड क्रूड काफ़ी अच्छा गिरा था, रिकवरी थोड़ी बहुत आई है, रेंज के अंदर है ब्रांड क्रूड भी, बट यूएस क्रूड ऑयल इज इन अ रेंज राइट नाउ। थोड़ा सा मैं एक्सपेक्ट कर रहा हूँ कि नीचे गिरे तो बढ़िया ही है, देखते हैं गिरता है नहीं गिरता है, वापस कल के रेजिस्टेंस पे जाता है। देखोगे रेजिस्टेंस एरिया से मार्केट ऑलमोस्ट 500 पॉइंट फॉल किया था, ओवरऑल टारगेट दैट इज अराउंड 1000 पॉइंट, तो 500 पॉइंट ही गिरा। फिबोनाची के अकॉर्डिंग भी देखें तो अभी भी मार्केट के पास स्पेस तो है, देखते हैं। फिलहाल कंटिन्यूसली बुलिश मॉर्निंग से, गैप डाउन के बाद रिकवरी अच्छी आ चुकी है। गोल्ड और सिल्वर भी रिकवरी जरूर करने की कोशिश कर रहे थे, गैप अप हुआ जरूर था, वापस सेलिंग में ही चला गया मार्केट। आगे अभी आज और कोई डेटा है नहीं, 5:30 देखते हैं न्यूयॉर्क सेशन की ओपनिंग, लास्ट ट्रेडिंग सेशन है, ज़्यादा रिस्क मत लेना। ये नेचुरल गैस में भी यहाँ पर बुक करेंगे, थोड़ा सा ऊपर और आता है तो कैंडल वैसे देखो करंट ओपन इक्वल टू लो है, 300 के आसपास जाने की पॉसिबिलिटी है इसमें भी। बाकी नेचुरल गैस भी पैटर्न ऐसे बना रहा है ना, बिल्कुल एक कॉम्पैक्ट रेंज में अपर लेवल पे साइडवेज होके बैठा हुआ है, कुछ ऐसा पैटर्न मान लो। ये थोड़ा सा टाइम फ्रेम को प्रॉपरली देखोगे तो कुछ इस तरह से पैटर्न क्रिएट कर रहा है। ऊपर रेजिस्टेंस डाउन साइड की ओर शिफ्ट हो रहे हैं, सपोर्ट अप साइड की ओर शिफ्ट हो रहे हैं, मतलब रेंज बहुत ज़्यादा नैरो होते जा रही है। किसी ना किसी साइड बड़ा ब्रेकआउट या फिर ब्रेकडाउन होने के चांसेस इसमें भी हैं। इंट्राडे में देखोगे तो 10 पॉइंट की रेंज लग रही है, 290 से 300। बाकी रेंज के बाहर भी निकला तो बहुत बड़ा मोमेंटम शायद ही होगा, बिकॉज अपर लेवल पे वापस फिर 5 पॉइंट की अपर रेंज है, 300 से 305, और अगर लोअर साइड पे निकलता है तो फिर 290 से 285। सो ओवरऑल 20 पॉइंट, 10 पॉइंट की स्मॉलर रेंज, 5 पॉइंट की एक्सटेंडेड रेंज राइट नाउ इन नेचुरल गैस। लगता है कोई न्यूज आ गई क्रूड ऑयल में स्पेसिफिकली कंटिन्यूअसली ओपन इक्वल टू लो कैंडल है करंट कैंडल भी ओपन इक्वल टू लो बनी हुई है नेचुरल गैस में भी सेलिंग प्लान है थोड़ा सा ऊपर और आता है तो एक अच्छा लेवल दिख रहा है क्रूड ऑयल भी लग रहा है आज का लो काफ़ी स्ट्रॉन्ग बना है, सपोर्ट 8790 780। JD Vance not decided on a 2028 run, sitting a fourth child due to this summer.
우리가 특별하는 전술 연습이 끝난 후 김성은 동지께서 신용 규격 탱크의 전투적 성능을 다시금 묘의하시면서 다음과 같은 견해를 피력하셨습니다. 탱크 공업의 현대화에서 우리는 당당히 자부할 수 있는 성과와 진보를 획득하였다. 규격 탱크에는 우리식의 우리가 특별한 힘을 기울 신용 규격 탱크의 전술 연습이 끝난 후
Administration weighing plans to seize or blockade Iran Kurg Island to pressure Tehran into reopening the Strait of Hormuz. Major news. ठीक है, देखना पड़ेगा कितना सच है ये, बट अगर ऐसा होता है तो there is a very high chances there is a escalation in the matter. वैसे एक्सोस ने ऐसी कोई रिपोर्ट दी तो नहीं है।
Why is the Pentagon going to ask Congress for an additional $200 billion?
Well, we're asking for a lot of reasons beyond even what we're talking about in Iran. This is a very volatile world, and the military equipment, the power of some of this weaponry is unthinkable. You don't even want to know about it. Oh, you could end this thing in 2 seconds if you wanted to, but we are being very judicious. We want to be sure, and it's a small price to pay to make sure that we stay tippy top.
Do you intend to potentially put U.S. troops or more troops in the region?
No, I'm not putting troops anywhere. If I were, I certainly wouldn't tell you, but I'm not putting troops.
The House Speaker, and in the House side, obviously, and the Senate Majority Leader, John Thune, both were very non-committal on the question of whether they could get the votes for what the president is clearly going to ask for, which is a big chunk of change, perhaps as much as $200 billion to go for funding more of this war. And I'll just tell you what John Thune said specifically to our colleague Ted Barrett. I think they're going to have to show us how they want to use it. I mean, that makes clear a couple things. One, it seemed to be a number that the Washington Post first reported that was also news to the Speaker and the Senate Majority Leader. So clearly the work had not been done to pave the way for this. But it is going to make one thing clear. Yes, there has not been a congressional vote to authorize this war, but paying for the funding effectively will be that. There is going to be a war debate over the funding. So Senate Majority Leader John Thune, he said that they're going to have to show it, but also they're going to specifically have to go through why the war was necessary now, what the objectives are going forward. So this is really going to be the true test of MAGA and President Trump's ability to persuade people, because several House members, Lauren Boebert and others, are telling our colleagues on Capitol Hill that they are not going to vote to authorize any more money. So that means that Democrats will have to join some skeptical Republicans in this. So anytime this happens, we've covered war funding debates for many years. It is always a bipartisan effort, and it is a contentious one, and there is going to be effectively a war authorization vote through this spending bill. Yeah, and it's going to be interesting to see how much Democrats want to play ball on this, right, as opposed to in years past, in conflicts past. Let's just play a little bit of Pete Hegseth, the defense secretary, this morning when asked about the $200 billion that was reported.
$200 billion. I think that number could move, obviously. It takes money to kill bad guys. So we're going back to Congress and our folks there to ensure that we're properly funded for what's been done, for what we may have to do in the future.
So it takes money to kill the bad guys. And Liz, I want to bring you in 1 second, but I do quickly want to play what Senator Lisa Murkowski from Alaska said this morning about this.
The people in Alaska are asking me, how long is this going on? Are there going to be boots on the ground? How much is this going to cost? To what extent is the Congress engaged in this? And the answer on most of this is, I don't know. The administration is going to have to walk us through whether it's $200 billion or some other iteration of what the supplemental will be.
Liz Goodwin, and by the way, welcome to Inside Politics.
Thank you.
What's your reporting on this debate?
Yeah, so Republicans have been pretty wary about the rise in gas prices that we've already seen as the conflict keeps.
The bond market, this is where things got really interesting yesterday. Flatter curves. This morning, flatter again, led by a sell-off at the front end of the curve. That's what they call a bear flattener. The two-year yield this morning up by 9 basis points, 388. For a moment yesterday, a really interesting moment where we really started to reprice the inflation story, the rate story at the front end of the curve. Two-year yields much higher, and really started to reprice growth lower at the longer end of the curve. Yields down at the long end of the curve. So up at the front, down at the long end. That competing story, toxic for risk assets, and lots of that is happening off the back of this. Turn to crude. WTI and Brent. WTI is actually down on the week, believe it or not. WTI crude this morning up by about 1/3 of 1%. It's the breakout.
Yeah, much had been made by some about a fatwa against the development. Yeah, much had been made by some about a fatwa against the development of nuclear weapons. Notwithstanding the fatwa, what we know, and the intelligence community is in agreement on this, is that Iran possesses at least 440 kilograms of uranium enriched to weapons grade 60%, which doesn't have a civilian use. The only use for that would be the development of nuclear weapons. Yeah, much had been made by some about a fatwa.
110.20.
They no longer want to be energy facilities as a target. The problem is the Iranians are saying, for us, these are still a target.
It's crude, it's energy product, it's gas prices as well, igniting a big move at the front end of the yield curve. So 2-year yields stateside up by about 50 basis points since this war started. That's just 3 weeks, 15 days of trading, 50 basis points higher. In the UK, that number is twice that. That number is almost 100 basis points higher at the front end of the curve as they respond, not by taking out easing. You've got a market responding in the UK, pricing in rate hikes, and Europe doing the same thing, 3 of them fully priced at the ECB for the year ahead. Some major moves out there in the bond market so far this week. Let's get you some single names, some morning movers. 3 hours away from the opening bell, Yahira has more. Hey, Yahira.
Hi, John. We start with earnings out of FedEx. Shares are rising nearly 9% in the pre-market after the company raised its full-year profit outlook in a sign that its network overhaul is starting to gain traction. Management saying that demand is holding steady into March, even with the war. And as that conflict pushes oil higher, we are getting some insight into how FedEx is navigating it. FedEx is passing on some of those costs via higher fuel surcharges, helping to cushion its margins. And as the war continues and we continue to see that theme of higher defense spending playing out, we are seeing shares of Planet Labs soaring nearly 15% in the pre-market. The company reporting results that showed strong demand for its satellite imaging products as governments ramp up their spending on intelligence and surveillance. And we end on a big mover to the downside, and that is Super Microcomputer. Shares are falling 22% in the pre-market on a stunning indictment. U.S. prosecutors charging a co-founder of the company in what they're calling the largest AI chip smuggling case to date, accusing that person of smuggling NVIDIA-powered servers to China. Prosecutors say $2.5 billion in shipments were involved, much of that being rushed out ahead of tighter export controls. John?
Yahara, thank you. Wild story coming out of that company. These are individuals with significant amounts of wealth, and yet they're still engaged in that kind of activity.
And what's interesting is the U.S. government has been trying to figure out how has China been able to get access to some of these high advanced semiconductor chips? Well, here it is.
Those allegations, crazy. Some of the pictures involved in those allegations, pretty crazy as well. On our radar this morning, the US and Israel pledging to avoid targeting key energy sites in Iran after strikes on the country's largest field upend global markets. Israel saying it will aid US efforts to reopen the Strait of Hormuz, helping drive crude prices lower. Elsewhere, Iran striking an oil refinery in Kuwait for the second consecutive day. Drone attacks on the plant forcing the shutdown of several units. Kuwaiti oil production cut in half since the start of the war nearly 4 weeks ago. The ECB weighing a potential rate hike as soon as next month if price pressures from the Iran war continue to build. The Governing Council member Joachim Nagel telling us here at Bloomberg the future policy decisions will depend on how the conflict plays out.
Seriously, there's some current concern right now in the ECB, even though you did see Christine Lagarde talk about the fact that they think they're starting from a better base, probably reflecting on what happened to Europe with Russia's invasion of Ukraine and the energy spike. It does seem like they are much more concerned about what this prolonged conflict could mean. But the issue that happened over the past 48 hours is we realize that it's not just that we cannot move the product, it's that the product is actually now getting hit.
Let's get to those updates on the energy market. The White House taking an oil and gas export ban off the table as a way to bring down energy prices after the Vice President J.D. Vance met with oil executives. Stephen Schork of the Schork Group writing the Brent WTI spread will not narrow until one of two things happens. Hormuz fully reopens or WTI stops pricing in diplomatic optionality that never materializes. Neither is imminent. Stephen joins us now for more. Stephen, welcome to the program. I want to get to your line in your research. The Brent WTI spread says everything diplomacy won't. Stephen, just build on that.
Yeah, absolutely. Thank you. So the Brent market is now the benchmark for the seaborne trade in oil. And this is the market that is pricing the conflict, is pricing the war, is pricing the shortages that we are seeing. The WTI market prices optionality, prices optimism. It's a landlocked contract. It's a futures contract. And like every futures contract, it derives its value from a physical asset. The physical asset in WTI is landlocked in Oklahoma. It's a different type of crude oil. Brent is a similar crude oil, but priced in Atlantic Basin barrels, and it's the benchmark for the seaborne trade. So every time we see a dovish headline, the war might be ending, or there's an off-ramp, that optimism gets priced into the WTI contract, and that is the hope contract. The Brent market is the real market. That is pricing the real events going on, and that blowout in the spread that we've seen over the past week and a half tells you that this war is far from over, because we are seeing a tremendous bid in Brent over that WTI contract.
Stephen, I want to pick up on your point about what the WTI is pricing in about policy the U.S. government could do. So yesterday, Secretary Wright tweeted that there is going to be no export ban. But then I had a bunch of calls from people saying no export ban for now. Do you think this is something the U.S. will keep in their back pocket in case prices continue to rise?
Absolutely. Now, let's be clear, an export ban would be catastrophic for U.S. oil production, because all it would do is pent up more supply here in the United States of oil we don't necessarily use, so we don't have a use for it, so we're not going to burn it. So inventories would just build. And as those inventories build, there's no place for new production to go. So ultimately, it's a catastrophic move for production. And I think it appears that the White House got that message. But you never know. It does make a nice headline, so we could potentially see it. It's a political tool. It's not an economic tool. So certainly there is that potential. And clearly, with the way the Brent market has gone, we've gone from a $5 premium Brent over WTI at the start of this week to now it's upwards of $13 to $14. So we've tripled that premium. So clearly the market is skeptical that an export ban is not off of the table.
Stephen, do you even think Brent right now is pricing in really what is going on in the region? When you look at Oman futures, yes. I think yesterday they blew past $170 a barrel. That's more tied to the physical barrels right now that are moving in the Gulf. So is Brent even accurate?
It's an excellent question. And, I'm reticent to say it's not, because then I've been saying, oh, the market is wrong. But to your point, we have a bifurcated market. So the Brent market is still an Atlantic Basin market. That's where it's derived from. To your point that Oman and the Dubai futures contracts, which are linked more towards the Asian markets, that is really reflective of the shortage. So what the Brent Dubai or the Brent Oman, Brent steep discount to those markets is telling you is that we're looking at an Atlantic Basin that is well supplied with oil. The problem is in Asia, where all that oil is still blockaded up in the Strait of Hormuz, so your refineries from India over through Japan up through South Korea are bidding for that oil, and hence why we're getting such a huge disconnect between the two markets. So to answer your question, Brent is certainly disconnected. It's more connected, as we've said, relative to WTI, but actually where the shortages, where the physical shortages represented in the Oman and Dubai markets, clearly, again, that is another telltale that this war is far from being resolved in any sort of positive manner.
Stephen, that's the reality for Asian importers, buyers of that crude, of that
exactly.
physical asset. Do you think this market's taking too much comfort from the futures curve?
It's really interesting, and where we're really seeing the blowout, and to answer your question, I think the market is rather relaxed, is if we look at the Brent Dubai market, for instance, if we believe in market theory or in that curve, then we're looking at Brent trading at a $30, $40 discount to Dubai, $60, $70 discount to Oman. So the question is, when does the market catch up? So that we'll take the Dubai market right now. We're trading at about a $35 discount, Brent below Dubai. That's not supposed to happen. Dubai is an inferior quality oil. It trades at a discount to Brent, but that's not the case, but we know why. But we go 2 months out, the Brent premium, and we said Brent normally trades at a premium to Dubai, is now trading at a life of contract high of nearly $8 a barrel. So what the market, at least what the curve is telling us, is that, there's a real problem. Those are stranded barrels in the Strait of Hormuz. They're not going out. Therefore, Dubai trades at a massive premium to Brent. But going out 2 months, that premium reverses now to a significant discount. So the market, if you believe in term structure or in the forward curve of pricing theory, is telling us, yeah, we've got a real problem in the spot market. By the time we roll into summer, there's going to be some sort of exit in this war. Remains to be seen. We're not seeing it in the product markets, for instance. So another question now is the diesel market, the crack spread, or the margin between diesel prices and oil prices in the Gulf Coast is almost $70 a barrel. So one of two things are going to happen. Oil, WTI, is going to have to catch up to where product prices are, or product prices are going to crash because of demand destruction. And now we're talking about significant economic contraction. So, but the here and the now is that the spread is telling us significant shortage in the spot market prompt month. But going 2 months out, we should start to see some sort of resolution. At least that's how the market, or that's what the forward curve is suggesting to the globe.
Stephen, it's good to see you. Let's get your perspective. Thank you, sir. Stephen Schork there of the Schork Group on energy, on the price of crude and crude product. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. The Trump administration is considering plans to occupy or blockade Iran's Karg Island. Axios reporting the operation would be used to pressure Iran to reopen the Strait of Hormuz. It would only be launched after the U.S. military further degrades Tehran's military. The Pentagon is considering sending more troops to the region, with 3 Marine units already on their way. President Donald Trump and top Justice Department officials supporting a new bid to investigate Fed Chair Jay Powell. Sources telling us here at Bloomberg the president had been open to the idea of dropping the probe until last Friday, when a judge rejected subpoenas. The investigation is related to the Fed's $2.5 billion renovation of its headquarters. And the ECB may need to raise rates as soon as next month. Governing Council member Joaquim Nagel telling Bloomberg the central bank's future decisions will depend on the developments of the war in Iran and its impact on medium-term inflation, saying more restrictive monetary policy would probably be necessary if inflation expectations rise. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, the Iran war feeding inflation risk.
There's so much uncertainty associated with what's going on in the Middle East. I'm worried about the fact that we haven't fully integrated what happens to demand.
Kelsey Barrow of JP Morgan Asset Management joins us next, live from New York City. This is Bloomberg.
Crises, 2 essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Heading into the weekend with stocks lower, down by 0.5 on the S&P, on the Nasdaq down by 0.7. That's the stock story. Here's the bond market picture. Two-year yields at the front end of the curve once again. Pricing out easing, and pricing in maybe, which seems unthinkable. The prospect of rate hikes, I mean, come on. We'll get into that in just a moment. We're up 8 basis points at the front end of the US curve, 387. In Europe, that's where the rate hike story feels much more real. In Europe right now, the ECB is pricing in 3 hikes, or rather traders are pricing in 3 hikes from the ECB. In the UK, another double-digit move at the front end of the curve, a 100 basis point repricing on 2-year yields in the UK, which is just wild. 452 right now on UK yields. Let's turn to the crude market. Energy shaping up as follows. Brent and WTI. Brent crude around 110, WTI 95. That's the front end of the futures curve. That's what we're looking at here. It's important to recognize that, because what we're seeing in the physical market is $50 higher in some cases.
So much higher when it comes to the futures, what's trading in terms of Oman and Dubai, those actual physical barrels. But as we just heard from Stephen Schork, all those barrels are going to Asia. That's where really the front line of the energy shock is right now. But the differential is just astonishing. And then you take in what the U.S. has as a net exporter. WTI still remains under $100 a barrel. That is a key threshold for this White House.
Brent crude this morning around 110, WTI around 96. Under surveillance this morning. The Iran war feeding inflation risk.
A prolonged war in the Middle East could lead to a larger and longer-lasting upward shift in energy prices.
Higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
By the next time we meet, a lot will have happened, and I can't predict what. I can't possibly, none of us can predict what it will be, but it is a very volatile situation.
So here's the latest this morning. Global central banks seeing greater inflationary risk as the war in Iran drags on. Kelsey Barrow of JP Morgan Asset Management writing, technical factors may pose short-term headwinds for bond investors due to the deleveraging of popular macro trades. But if last year is any guide, the next move is still more likely to be a cut. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
We'll get into some of the jargon. This market was really positioning for steepness, and now all of a sudden the curve's flattened. A lot of those trades had to come off. So let's go through the individual components of the curve and start with the very front end. The 2 years really interesting to me, because now it's trading above the upper end of the range for the Federal Reserve. That's odd when the market isn't really anticipating rate hikes anytime soon. What do you make of what we're seeing at the moment?
Yeah, so when I look at the market, the bond market more broadly, what I'm doing is I'm essentially categorizing where are the areas where there's been value created as a result of the energy shock, and where has there been a lack of value created and there's still maybe more repricing that needs to happen. And I would say the areas where a tremendous amount of value has been created in the bond market is in the front end of developed market curves, particularly the US, the UK, and Europe. Also some EM rates markets. I think it's very more country specific, but even there you've seen this pattern of rate cuts that were priced in that are now being recalculated to rate hikes. And I do think it is a nuanced story for the Fed, where I did write that we still think the next move is a cut, versus the BOE and the ECB, where there is more of a credible risk that they hike. But second order impacts are important. Hiking into a supply shock also increases the probability that those hikes are not sustainable. If that inflation is only supply-led and is not demand-led, that they need to reverse those hikes in subsequent time periods, because it's not all about energy and the higher inflation impact, but there's also a negative growth impact associated with higher energy prices. And what the market has been focused on, particularly the front end of the rates market, is really exclusively that higher inflation impact.
Super volatile. So we've priced out easing of the Fed. We've priced in hikes at the Bank of England, 3 hikes over at the ECB. The value creation story, the relative picture right now, is there an opportunity already at the front end of the UK curve, despite the volatility, an opportunity already at the front end of the European curve?
I think that you're getting to the point where there is an opportunity, because if you look at what's priced in, it's now even in excess of what I think could be a reasonable baseline in terms of rate hikes if oil stays above 100 for a period of time. So what the BOE and the ECB seem to have done is essentially given the market a playbook for if nothing improves, which may not be what happens. I mean, we may see a de-escalation at some point that allows energy prices to come down. But if nothing improves and actually energy continues to go up, here's what we think we may need to do to keep inflation expectations well anchored. I think even under a scenario where they do have to hike 1 or 2 times, the market is priced in excess of that. And so the valuations there, I think, are getting particularly attractive. And I would say in the U.S., you know, why are they being dragged along? I mean, these markets are very global in nature. And so the U.S. market is not immune. But what I will say, when I look at the long end of the curve, you know, 10s at 430, you know, this is still the pre-existing range that we were trading in prior to the conflict in Iran. And I look at things like 5-year inflation expectations, which are actually stable, if not slightly lower on the day. And what you saw with the move yesterday was a 20 basis point range for 2s. But where we ended up actually reminded me a little bit of a risk, growing risk of a hawkish policy error, which is you had higher front-end yields and you had lower long-end yields and you had lower long-term inflation expectations. I get it. Central banks, they want to get ahead of this. They don't want to make the mistakes of 2022. But we also know they've made other mistakes where prior to 2022, where they responded to a supply shock in oil that was not accompanied by any robust demand. I think you really need to take into context the fact that where were these economies prior to this shock? The BOE thought the labor market was very weak and they were about to cut. In the Fed's orbit, we were seeing cyclical inflation come down. Job growth was essentially 0. They were looking to gradually normalize. That is a very different world from where we were in 2022, when you had double-digit nominal GDP growth, you had negative real policy rates, and there was a clear reason why central banks across the globe had to endeavor on aggressive hiking cycles.
Let's stick with your framework. That's where we've created value. Where haven't we created value in fixed income?
Well, credit spreads have moved wider, but I think they could continue to move wider and be under pressure in a scenario where oil stays very elevated. And so one of the things that we've been doing, we had our investment quarterly yesterday. Our senior investors come together for all across the globe. The timing was great, obviously, with everything going on. And we stressed, for example, investment grade corporates in a number of different oil scenarios. And in a scenario where we stay around here, or maybe we see that $150 a barrel oil, which we're already seeing in other parts of the oil market in Dubai, that could be a situation where corporate earnings will get hurt. And it's actually a more broad-based impact to corporate earnings than the tariff shock. And in that case, there are a lot of parts of the market that are still very, very tight. For example, in the European investment grade market, your banks and the lower in the capital stack part of the banks, they're still pricing in very snug valuations, not consistent with a situation where revenues and earnings turn negative because of a prolonged energy shock.
Kelsey, smart. Really, really smart stuff. Kelsey Barrett there of JP Morgan Asset Management. The curious case of risk assets right now, both credit but also equities. We've gone back and forth on this now for 3 weeks. It's an energy shock, the risk becoming a rate shock, and now you're starting to understand, trying to get your hands around, wrestling with the idea that it becomes a growth shock as well.
And that really depends on how long these disruptions are and how prolonged this conflict is. The Wall Street Journal has a piece this morning citing Saudi energy officials. You know, they never want to say what kind of price they think or price they're targeting, but they think if this conflict continues to last to the end of April, you're looking at $180 on Brent, not the physical cargoes, on Brent crude.
S&P 500 futures this morning negative by 0.5. In the next hour, we'll catch up with Jim Bianco of Bianco Research, Michael Zezas of Morgan Stanley, Paul Sankey of Sankey Research, and Terry Wiseman of Macquarie. The second hour, just around the corner.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
We have an economy that faces growth as well as inflation risks.
There are short-term impacts, but there are also longer-term impacts that these central bankers have to consider.
You can't hit the global economy with a shock of that magnitude and not expect bad things to happen.
No doubt, I think you are going to see uncertainty start to weigh on corporate confidence.
The risk of recession is higher than the markets believe.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Futures down again with negative 0.5 and heading towards a fourth consecutive week of losses, the longest such streak in more than 12 months on the S&P 500. In the bond market, yields shaping up as follows. Twos at the front end of the curve since this war started, up 50 basis points stateside, up another rate this morning, 386.83. And in the commodity market at the moment, Brent crude, since this war started, up 50%. Physical barrels, up a ton more than that. 109.41 on Brent, WTI 95.43.
The price keeps going when it comes to physical barrels, these barrels that are basically stuck, and now we have a bigger problem. And Halima Croft talked about we went from bad to worse in terms of the situation in the Middle East because energy infrastructure has been hit. And you're hearing from the heads of these companies like the Qatar Energy CEO, Saad Al-Kaabi, talking about force majeures are going to happen. They're not going to be able to fulfill long-term LNG contracts, which is why you see officials at the ECB incredibly concerned about inflation because it's going to hit them pretty immediately. It's looking very dire for some of these economies. And right now, Jonathan, although you do see Benjamin Netanyahu and the president almost looked calculated, coordinated in their effects in trying to tamp down what's going on, saying energy facilities will be no longer targets, that's not happening for the Iranians.
Let's just focus on energy, movement and production. For a long time through this war, 3 weeks of it feels much longer. For a long time through this war, we were focused on the movement of energy, the Strait of Hormuz. Is it temporary? How long does it last? Now we have to think about the long-term production impact. And that was the critical turning point of the conversation yesterday around Qatar and the strike on LNG and LNG capacity. And I think the most important line in the reporting, and it came from Reuters yesterday, was how long it's going to take to repair the damage that was done. And it wasn't 12 months. It wasn't in months. It was 3 to 5 years. That changes the conversation. And then all of a sudden the market started to turn. And there was just that moment yesterday for a few hours where we started to really consider the duration impact, how long this was going to last, and the damage it would do to growth over a longer period of time.
We are talking about years for these facilities to get back up and operational to where they are today. And we're just talking about one example in Qatar. We do know that a refinery in Saudi Arabia was hit yesterday. Overnight this morning on the East Coast, you had Kuwait had a facility hit as well. So they are picking apart pockets, as well as the UAE, picking apart pockets across the Gulf in terms of what the Iranians are willing to hit. And they say they are not going to back down.
And the longer it goes on, the more governments need to think about offsetting some of the pain, particularly over in places like Europe. Do they have the fiscal space to respond? In the UK, a little bit earlier, big headline crossing the Bloomberg. The highest yield we've seen on a 10-year maturity going back to 2008. Forget the Liz Truss stuff. We've had massive moves this month alone. At the front end of the curve by 100 basis points on twos. You're seeing it at the longer end of the curve as well. Why? I think it's a question about fiscal space here, particularly not just for the UK, but for the Europeans. Spain with this headline moments ago. They're going to cut fuel and electricity taxes in an economic relief package. How many more such packages will we see if this continues?
A ton. And I think you can take the context of Russia's invasion of Ukraine and what Europe did. They learned a lot from that, and they realized they need to move expeditiously when it comes to energy prices. And we already know energy prices in Europe are so much higher. They are importers of it, and also they tax it heavily. You're going to see a lot more economies probably say, we're going to have to give the consumer a bit of a break here.
For once, the action's elsewhere. Crude's actually pretty stable. At the front end of the futures curve, Brent crude 109, WTI at about 95. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research as the US and Israel attempt to de-escalate. Michael Zezas of Morgan Stanley as the White House rules out an export ban. And Terry Wiseman of Macquarie as bond markets feel the shock. We begin this hour with stocks extended declines as crude continues to climb. Jim Bianco of Bianco Research writing the West underestimated drone warfare, failed to secure Hormuz, and is now facing an oil-driven inflation shock. Jim Bianco joins us now for more. Jim, welcome to the programme. I keep talking about this. The numbers and prices we quote at the front end of the futures curve. Do you think that's masking the disruption that's taking place elsewhere?
Oh, yeah, I think it is. And I think the biggest thing about that is that the oil market is bifurcated into three different markets. The Middle East crude oil that goes to Asia is now trading at $160 or $170. The oil that basically goes to Europe is trading at around $115. And the oil that goes to the United States is still trading around $95. We've never seen the market break up this much into three distinct markets like it has before. Usually those spreads are a couple of dollars based on the quality and the transportation costs of the crude oil, but it's never been $80 like we've seen now.
The Energy Secretary speaking at the moment, Jim. I'm going to break in with these headlines and just get Anne-Marie's thoughts on things. This is what Energy Secretary Wright's got to say about unsanctioning Iranian crude. It would be absorbed in 30 to 45 days, and additional Iranian oil would help Asian customers. I just want you to think about what we've heard from the Treasury Secretary at the start of this year. The Treasury Secretary was talking about the war in Ukraine and the Europeans buying Russian energy still and financing the war against themselves. What is this move from the US side, unsanctioning Iranian barrels at a time when they're at war with Iran?
Well, sounds exactly like what Brussels was doing with Moscow and when it comes to still importing Russian gas. President Trump, in his first term and his second term, has been very direct when it comes to the policy proposals they want on the regime. Maximum pressure. Now they're potentially saying, well, there is Iranian oil that is out there on the sea. We're going to unsanction it, potentially. They're just talking now. They're saying that this would be absorbed in 30, 45 days. This means not all of it would just go illegally to China. Other Asia buyers could potentially buy some of this crude. But it's giving the regime money at a time when they are trying to combat this regime and topple it. And if you're selling this crude legally, how much more money is Tehran able to bring in then from these barrels?
Jim Bianco Research, still alongside us. Jim, forgive me for that. Just wanted to jump in and break down some of those headlines. It's starting to feel a little bit desperate. I think they understand that these markets are getting tighter. Jim, I keep going through this framework that we've priced in the shock to energy prices, started to do it into interest rates. Where are we in the process of repricing growth?
I think we're in the process of repricing it lower, but we have to consider where should interest rates be? They should basically approximate nominal GDP expectations. That's a fancy way of saying growth plus inflation. And what I think you're seeing out of the interest rate market, is particularly the short end of the yield curve, is we're going to get more inflation than we're going to get a reduction in growth. And nominal GDP is going to go up. And that means that the appropriate response for interest rates is to go higher. And the appropriate response from central banks might be to hike rates. This is the early 80s. What did we do when we had recessions in the early 80s because they were driven by high inflation? We raised interest rates. And this is what we could wind up seeing now. What would be a giant mistake is to be cutting interest rates into this. We have a deficit of oil right now. Jeff Curry was on with you the other day, did a great job of explaining it. We need 10 million barrels of oil to be consumed less. Somebody not has to buy it. If we're going to start cutting taxes and cutting interest rates to subsidize people to continue to buy higher prices, they're just going to keep going up and up until 10 million barrels are not bought anymore. So we're just going to keep driving prices higher. So I don't think that interest rate cuts is going to be appropriate until this war is over and we can assess the damage.
If we're missing 10 to 15 million barrels per day, as you say, prices will need to rise. At what point do they rise and it starts to hit demand production?
I think it's starting right now, especially out of out of Asia, because of the $170 price you're getting there. We're already hearing that some of the countries in Asia are starting to ration oil because they don't have enough. Now, in the United States, we're benefiting from, we are independent in our oil. We produce enough oil so we won't ever have to ration, but we're still going to be subject to the prices of the world market. We're going to pay a lot for it, but you're always going to be able to go to the gas station and it's always going to have gas available for you.
Right, but right now, if you are an American and you go to the gas station, on average, we're looking at $3.91. So we're about to hit $4 a gallon of gasoline. That psychologically, Jim, is going to be difficult for the American consumer. At what point do you think gasoline prices will be rising enough where it starts to hit corporate profits and other parts of the economy?
I think it's there already, and it will start to do that. I think the only question is, how long does it last? And the answer to that is, when does the oil start flowing? Remember that oil and trade is, everybody loves medical metaphors. It's the circulatory system of the global of global GDP. It's got a blockage right now in a very important artery. That blockage has to open. As soon as it opens and the oil starts flowing, then we can assess how long this is going to be. If it's $3.91 a gallon or that range for a couple of weeks, that's not going to be really debilitating. If it stays there for a month or two or three, then it's a bigger problem.
Jim, you said it's a mistake to cut rates. I don't see a sign of interest rate cuts anytime soon. Do you think it would be a mistake to hike interest rates in places like the UK, places like Europe?
It might not be at this point, because if they don't hike rates, again, that would actually act as a subsidy again, because what's happening in technical terms is their neutral rate is going up quite a bit. And if they don't follow the neutral rate up, then they're going to wind up with leaving rates where they are being too easy in terms of where the policy rate turns. So they might have to start following those neutral rates higher. And we're starting to see that in the United States. Just a couple of weeks ago, we were pricing hikes across the board, and now we're starting to price in, we're cutting cuts across the board. Now we're starting to price in small hikes, way less than 50%, but we're above zero for the first time in a couple of years in terms of where we think Fed policy is going to go, and that it is now leaning towards hikes more than cuts.
Jim, it's good to see you as always, buddy. Thanks for breaking it down. Jim Bianco there of Bianco Research on the change to rate pricing we've seen, and it's been aggressive. It's been fast. It's happened really, really quickly at the front end of the UK curve and across Europe too. Deutsche Bank, I mentioned this earlier, now expecting 2 hikes from the ECB over the next year, and Joachim Nagel of the Bundesbank, the German central bank president, out this morning, essentially leaning into the idea they could move pretty soon.
Basically, they're saying they can maybe, or he's saying there's capacity maybe to move next month. This means that the ECB, the European Union, they realize that they need to move quicker potentially, because Jim is right. After Asia, the next point that's going to get hit with the energy shock is Europe. And to your point earlier, Spain's already seeing it today. They're trying to get rid of the taxes when it comes to gasoline, because you know why? For consumers, these levels are just way too high. Futures,
stateside, largely insulated, relatively speaking, to what's happening elsewhere. Equity futures right now in the S&P down by just 1/3%. Let's get you an update on stories elsewhere this morning, worldwide, with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. The Trump administration is considering plans to occupy or blockade Iran's Karg Island. Axios reporting the operation would be used to pressure Iran to reopen the Strait of Hormuz. It would only be launched after the U.S. military further degrades Tehran's military. The Pentagon is considering sending more troops to the region, with 3 Marine units already on their way. Meanwhile, Iran is stepping up its attacks on energy sites on neighboring Gulf states after Israel bombed its primary offshore natural gas field. Iran striking an oil refinery in Kuwait for the 2nd straight day, forcing the plant to shut down some of its units. Brent has surged more than 40% since the war started nearly 4 weeks ago. And Saudi Arabian oil officials projecting oil prices could top $180 a barrel if the Strait of Hormuz remains blocked for another month. The Wall Street Journal reporting a prolonged war would bring huge Saudi profits, but could trigger a recession. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate the update. More from Yahara in about 15 minutes' time. Up next on the programme, downplaying crude concerns.
I thought it would be worse. Much worse, actually. I thought there was a chance it could be much worse. It's not bad, and it's going to be over with pretty soon.
Up next, we'll catch up with Michael Zezas of Morgan Stanley, live from New York City this morning. Good morning.
होएगा इस 5:30 will be there. न्यूयॉर्क सेशन ओपन होने वाला है आज भी मार्केट ऐसा लग रहा है साइडवेज ही जाएगा नॉर्मल ठीक है, फाइनली क्रूड ऑयल वापस नीचे आता हुआ देखते हैं, फाइनल टारगेट तक पहुंचता है तो। दिस इज द फाइनल टारगेट, कल से ही एक्सपेक्टेड है। नेचुरल गैस तो साइडवेज ही लग रहा है, मैंने जैसा मॉर्निंग पे बताया आपको। 10 पॉइंट की रेंज है 290 टू 300। ये स्मॉलर रेंज, एक बड़ी रेंज है 5 पॉइंट यहाँ से ऊपर, 5 पॉइंट यहाँ से नीचे। टोटल अपर रेंज 20 पॉइंट, इंटरनल रेंज 10 पॉइंट। देखते हैं किस साइड जाता है। नीचे अगर ब्रेकडाउन हुआ, अगर मान लो 290 के नीचे सस्टेन करता है तो फिर इस एक्सपेक्टेड सपोर्ट जोन के नीचे तो फिर प्राइस गिर सकता है ठीक ठाक टुवर्ड्स 270। सो ये बड़ा इंपॉर्टेंट लेवल रहेगा, नीचे मार्केट कहाँ तक होल्ड करता है, कब तक होल्ड करता है, दैट इज ऑल्सो इम्पॉर्टेंट। स्लोली स्टडी गया है नेचुरल गैस में भी, लिक्विडिटी ली इसने। कुछ ये प्राइस एक्शन लग रहा है अगर क्रिएट होता है तो, लाइक दिस। लिक्विडिटी ऑलरेडी ले ली है नेचुरल गैस ने भी, तो नीड टू सी आज कितना होल्ड करता है। अभी भी लग रहा है शायद एक पुल बैक हो सकता है, क्योंकि 10 पॉइंट की रेंज है, ज़्यादा मार्केट मूव तो करेगा नहीं। या तो नीचे सपोर्ट ब्रेक करे या फिर 300 के अराउंड से रिजेक्शन ले ले वापस। दोज टू लेवल विल बी अ नेक्स्ट, विल डिसाइड द नेक्स्ट मूव। बाकी क्रूड भी इंटरेस्टिंग रहेगा। फॉल अगर ये करता है डाउन साइड तक फाइनल टारगेट तक, क्या बीच में कोई रेजिस्टेंस बनाता हुआ गिरता है? बिकॉज अगर कोई रेजिस्टेंस बनाता हुआ नहीं गिरा तो पूरा स्पेस अभी भी रेंज का खाली रहेगा। बीच में यहाँ कोई रेजिस्टेंस बनाते हुए गिर जाए बीच में यहाँ कहीं, तो फिर नीचे के बायर ज़्यादा प्रेशर में आ जाएंगे, फिर कंटिन्यूसली लोअर लो बनने के चांसेस रहेंगे। Overall, crude is bullish, but from last almost 10 days, it is in a range from 8,400 to 9,400. ये 1000 पॉइंट की रेंज है, 10% MCX चार्ट में कह सकते हो। मार्केट इसके बीच में ही घूम रहा है। नाउ नीड टू सी लिक्विडिटी लेने बाइंग साइड पे 8400 की ओर कब आता है ये। करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम जिन लोगों ने लाइक नहीं किया। बाकी अभी कोई और न्यूज़ नहीं है बिल्कुल भी। मेजर एक न्यूज़ एंड डेवलपमेंट थोड़ी देर पहले एक ही थी जो मैंने आप लोगों को बता दी थी कि यूएस गवर्नमेंट कंसिडर कर रही है ईरान का जो खर्ग आइलैंड है, जो उनका सबसे बड़ा ऑयल रिफाइनरी सेलिंग जोन आप कह सकते हो, उसको टेक ओवर करने के थ्रू, फोर्स के थ्रू, सो दैट ईरान स्ट्रेट ऑफ हॉर्मोज को ओपन कर दे। रिसेंटली जो डेवलपमेंट हुई है, यूएस ने जो लगभग आई थिंक 40,000 सेलर्स, जिसमें बहुत सारे यूएस मरीन्स भी इंक्लूड हैं, उनको वापस रीडिप्लॉय करने का सोचा है मिडिल ईस्ट में। ऐसा लग रहा है कि शायद कुछ ग्राउंड ऑपरेशन हो सकता है। अगर ऐसा होता है तो अगेन देखा जाए तो यूएस के पॉइंट ऑफ व्यू से इट इज़ अ गुड न्यूज़ फॉर क्रूड ऑयल, मतलब प्राइस को डाउन जाना चाहिए अगर ऐसा होता है इन केस। तो कहीं ना कहीं ईरान पे प्रेशर आएगा कि वो स्ट्रेट ऑफ हॉर्मोज को ओपन कर दे, तो उससे क्रूड ऑयल के प्राइस डाउन जा सकते हैं। बट ऑन द अदर हैंड अगर ऐसा नहीं हुआ और इस ऑपरेशन में यूएस को लॉस होता है काफ़ी हैवी, या फिर ईरान बाकी के जितने गल्फ कंट्रीज हैं उन पे, उनके ऑयल इंफ्रास्ट्रक्चर पर फिर अटैक करना शुरू कर देता है और एग्रेसिवली, उस केस में ये क्रूड ऑयल के लिए बिल्कुल बुलिश न्यूज़ हो सकती है। फिर हो सकता है क्रूड ऑयल, यूएस क्रूड ऑयल स्पेसिफिकली, ब्रांड तो पता नहीं कहाँ जाएगा, यूएस क्रूड ऑयल भी वापस $100 के ऊपर चला जाए। सो दिस डेवलपमेंट इज ऑलमोस्ट लाइक यू नो टू वे सॉर्ट्स। जिस साइड भी गिर गई, सेकेंड वन इज सर्वाइव। The Trump administration is considering plans to occupy or blockade Iran Kharg Island to pressure Iran to reopen the Strait of Hormuz. Major news right now related to this war. यहाँ से बाय द वे ईरान का 90% क्रूड ऑयल का एक्सपोर्ट होता है। 90% मतलब पूरा ईरान अगर 100% ऑयल एक्सपोर्ट करता है तो 90% तो इसी आइलैंड से होता है। मोस्टली इनकी जो प्रोसेसिंग रिफाइनरीज हैं वो यहीं पर हैं क्रूड ऑयल की। एक्सपोर्ट 90% यहीं से होता है, तो दैट विल बी अ मेजर ब्लो फॉर ईरान इफ दिस हैपन। ऑब्वियसली अगर ये इस आइलैंड को ऑक्यूपाई कर लेते हैं यूएस फोर्सेस, तो ऑब्वियसली ऐसा तो नहीं होगा कि वहां पर जस्ट यू कैन बम्बार्डमेंट कर दे। आपको ग्राउंड ट्रूप्स भेजने ही पड़ेंगे, विच विल बी अ वेरी concerning for the US troops as well. तो इस न्यूज़ को देखते हैं। लास्ट टाइम आई थिंक वो यूएस के जो मरीन्स और 45,000 सेलर्स जा रहे थे मिडिल ईस्ट की ओर, लास्ट टाइम उनकी लोकेशन थी दैट इज़ अराउंड आई थिंक सिंगापुर, उसके आसपास देखी गई थी जिस एम्बीसी शिप से वो जा रहे थे। मोस्टली वही होगा। बाय द वे मैं दिखा देता हूँ कहाँ पर है आपका खर्ग आइलैंड। ये है अपना प्यारा भारत। नाउ दिस इज़ द ईरान, ये है आपका स्ट्रेट ऑफ हॉर्मोज, दिस इज़ पर्सियन गल्फ, दिस इज़ गल्फ ऑफ ओमान, ये है आपका स्ट्रेट ऑफ हॉर्मोज। यहाँ पर देखोगे फिलहाल के लिए कोई भी क्रूड ऑयल से रिलेटेड एक्टिविटी नहीं हो रही है। कुछ टैंकर जा रहे हैं, मोस्टली वो ईरान के खुद के ही हैं। ठीक है, यहाँ पर कुछ खास एक्टिविटी है नहीं क्रूड ऑयल टैंकर्स की। इवन क्रूड ऑयल टैंकर छोड़ो, नॉर्मली भी अगर आप देखोगे बाकी तो किसी भी तरह की कोई शिप की मोमेंटम यहाँ पर है नहीं। पूरा स्ट्रेट ऑफ हॉर्मोज फिलहाल के लिए ब्लॉकेट हुआ पड़ा है। या तो आधे शिप आपके पर्सियन गल्फ में है या फिर गल्फ ऑफ ओमान में है फिलहाल के लिए। ये है आपका खर्ग आइलैंड पर्सियन गल्फ में। ये है पर्सियन गल्फ, स्ट्रेट ऑफ हॉर्मोज, आपका गल्फ ऑफ ओमान, पर्सियन गल्फ। उनकी कैपिटल तेहरान। नॉर्थ को आएंगे तो यहाँ पर हमें दिखेगा खर्ग आइलैंड। दिस इज द खर्ग आइलैंड, दिस वन। रिसेंटली यूएस और इजराइल ने मिलकर यहाँ पर बम्बार्डमेंट भी किया था। चेक कर सकते हो, बहुत सारे फैसिलिटी डिस्ट्रॉय भी हुई हैं। तो यहाँ इस आइलैंड को ऑक्यूपाइड करने की ये सोच रहे हैं। ठीक है, अगर ऐसा होता है तो ऑलमोस्ट वेरी बैड फॉर द ईरान। इट इज़ करंटली, इसकी डिस्टेंस देखोगे मेन लैंड ईरान से लगभग 18 माइल, 15 या 16 किलोमीटर हो गया इंडियन मैं बात करूँ तो। मैं 16 सॉरी 18 माइल, at least 15 to 14 to 15 kilometer approximately. Sorry, 15 mile, not 15 kilometer. 15 mile from mainland Iran. 15 miles distance है. I think 12 to 13 किलोमीटर हुआ शायद फिर ये. तो अगर यहाँ पर यूएस ट्रूप्स जाते भी हैं तो फिर मेन लैंड से इन पर अटैक होने के चांसेस भी काफ़ी हाई रहेंगे. तो कैसे इसको ऑक्यूपाइड करके रखेंगे वो लॉन्ग टर्म के लिए, दैट नीड टू बी सीन. रिसेंटली हमने देखा था यहाँ पर काफ़ी बम्बार्डमेंट करी है यूएस ने. इफ़ यू लुक एट राइट नाउ, दीज आर द लाइव सैटेलाइट इमेजेस. हाँ, कहीं बम्बार्डमेंट हुई है, लग तो रहा है स्ट्रक्चर डैमेज है. क्योंकि यहाँ पर अगर ग्राउंड ऑपरेशन करने हैं तो आई डोंट थिंक सो एयरबॉर्न यूनिट जाएगी उनकी. मोस्टली एम्बिशियस शिप्स ही भेजेंगे वो यहाँ पर आइलैंड में, विच कैन एक्वायर जस्ट लाइक इन वर्ल्ड वॉर टू अलाइड फोर्सेस ने किया था. ये भी देखो, यहाँ पर भी डैमेज हुआ है. दैट इज ऑल्सो आई थिंक द एरिया जहाँ पर अटैक किया इन लोगों ने. नीड टू सी किस तरह से कैप्चर करते हैं अगर करते हैं. बट या दैट इज अ मेजर न्यूज राइट नाउ दैट यूएस इज गोइंग टू कैप्चर दिस खर्ग आइलैंड ऑफ ईरान. इस खर्ग आइलैंड को कैप्चर करने की सोच रहे हैं यूएस एडमिनिस्ट्रेशन करंट. Different marine units are on their way to the region. White House and Pentagon are considering sending even more troops soon, US official says. ठीक है, क्रूड ऑयल तो स्टक हो गया, ऑलमोस्ट मोमेंटम ही नहीं है। 5:30 2 मिनट रह गए हैं, न्यूयॉर्क सेशन ओपन होने वाला है, थोड़ा सा वेट करना फ्रेश एंट्री के लिए। बड़ी कैंडल बन सकती है, 5:30 न्यूयॉर्क सेशन विल ओपन। ये 5:30 हो गया है। क्रूड ऑयल, नेचुरल गैस दोनों ही जगह पे सेलिंग की कैंडल, स्पेशली नेचुरल गैस देखोगे तो ओपन इक्वल टू हाई भी है साथ में। क्रूड ऑयल इज नॉर्मल है। वॉल्यूम एक्सपेक्टेड है 5:30 के बाद लंदन सेशन के बाद न्यूयॉर्क सेशन ओपन। अब सीधा 7 PM पे यूएस मार्केट ही है, कोई डेटा तो आने वाला नहीं है आज। क्रूड ऑयल अब की बार आया नीचे लेवल पे, तो ध्यान रखना नीचे का लेवल भी मल्टीपल टाइम टेस्टेड है ऑलरेडी। 1 2 टाइम टेस्ट हो चुका है डीप लेवल से। मुझे लग रहा है इस बार अगर आया तो थर्ड टाइम टेस्ट होगा। अपसाइड गया, अपसाइड अभी भी ये रेजिस्टेंस है, इंटरनल लिक्विडिटी जोन अभी भी बना ही हुआ है, कल ब्रेक नहीं हुआ, दैट इज स्टिल इंटैक्ट। बट यहाँ पर भी हो सकता है अगर अपसाइड गया तो फिर 9500 टू 650। थोड़ा सा डीप लेवल से फिर से एक रिजेक्शन लेने की कोशिश करें। इसमें 10% की रेंज अभी भी इंटैक्ट है, कल हाई लेवल से सेलिंग लेके आया है। देखते हैं वापस नीचे आता है डायरेक्टली या फिर एक बार और ऊपर जाने की कोशिश करता है। कोई सपोर्ट तो नहीं बन रहा है। बड़ा इंपॉर्टेंट लेवल है नेचुरल गैस का ये एक्सपेक्टेड सपोर्ट जोन, नॉट दिस इज नॉट एग्जैक्टली सपोर्ट जोन बट एक्सपेक्टेड सपोर्ट जोन। प्राइस थोड़ा पुल बैक देता है तो वापस से हाई लेवल से यहाँ से वापस सेलिंग का प्लान है, थोड़ा सा रह गया शायद मुझे लग रहा है। नीचे आता है अगर मान लो ये एक्सपेक्टेड सपोर्ट जोन नहीं होल्ड करता है, यहाँ पर एसएल जाता है तो फिर नीचे हमारे पास सपोर्ट है वही 270 के अराउंड। बट यहाँ पर ही प्राइस मल्टीपल टाइम टेस्ट हो गया, ये लेवल पे भी प्राइस नीचे वाला लेवल देखोगे ना दिस वन, यहाँ पर पहली बार मार्केट ने हाई बनाया था, दूसरी बार लोअर हाई बनाया था, थर्ड टाइम लास्ट टाइम गया है एक और लोअर हाई, अब की बार आया तो फोर्थ टाइम आएगा यहाँ पर ये आइडेंटिकल सपोर्ट के साथ। रेजिस्टेंस स्ट्रॉन्ग है, कंप्लीटली स्ट्रॉन्ग। सेल स्ट्रिक्ट रखना नेचुरल गैस के बाइंग ट्रेड में, डे हाई के आसपास जाएगा तो बाइंग करेंगे, एसएल जाता है तो फिर थोड़ा 270 तक आराम से जा सकता है, नीचे स्पेस बहुत है। 6 PM हो चुका है, 7 PM यूएस मार्केट ओपनिंग देखते हैं। नेचुरल गैस थोड़ा सा ऊपर आए तो सेल वापस करेंगे, नीचे तो सपोर्ट थोड़ा दूर ही है, ऑलमोस्ट मिडिल ऑफ द लेवल चल रहा है। Crude oil open equal to low again and again. minutes left. US market is going to open in 30 minutes. थोड़ा सा अगर ऊपर आता है अब ये नेचुरल गैस वी विल सॉर्ट इट। थोड़ा जोन ही रेजिस्टेंस का है तो थोड़ा सा एसएल बड़ा होगा, ध्यान रखना वापस से। बट इस बार सेलिंग का टारगेट भी थोड़ा बड़ा रखेंगे। फ्रॉम 300 टू 305 द होल एरिया इज अ रेजिस्टेंस एरिया, तो 300 से 305 के बीच में सेल कर सकते हैं। अब करने को 300 भी कर सकते हैं, 305 का भी वेट कर सकते हैं, बट एग्जैक्टली कहाँ तक जाएगा वो कहा नहीं जा सकता। नेचुरल गैस अगेन सेल ऑफ। याद रखना ये इंपॉर्टेंट लेवल है, ब्रेक होता है तो प्राइस वापस चला जाएगा बॉटम की ओर 270 टूवर्ड्स 270। एक्सपेक्टेड सपोर्ट जोन है, देखते हैं लेता नहीं सपोर्ट। अगर ऊपर जाता बेटर था, यहाँ से वापस एक सेलिंग का प्लान है। अगर नहीं आया पहले नीचे आता है तो याद रखना नीचे भी प्राइस जैसा मैंने बताया फोर्थ टाइम आएगा और यहाँ पर प्राइस एक्शन थोड़ा सा इवन दो सपोर्ट स्ट्रांग है बट प्राइस एक्शन कुछ इस तरह का बना हुआ है आइडेंटिकल सपोर्ट आ रहा है फोर्थ टाइम, तो कुछ ये प्राइस एक्शन चल रहा है यहाँ पे। 10-minute left. US market is going to open in 10 minutes. ये देखो क्रूड ऑयल अगर वापस ऊपर जाता है तो फिर वही 9500 टू 700 इस हायर अपर रेंज तक वापस जा सकता है। अगर अपर साइड पे पहले चला गया, नीचे थोड़ा सा आता बढ़िया था, नीचे एग्जैक्टली नहीं आ रहा है। पता नहीं है स्टक करेगा यहाँ पर, ये नेचुरल गैस इस एक्सपेक्टेड सपोर्ट जोन। अब तो यूएस मार्केट ही ओपन करेगा। क्वांटिटी थोड़ा कम रखना, मैं फिर रिपीट कर रहा हूँ, एसएल स्ट्रिक्ट रखना नेचुरल गैस में इस लेवल पे बाइंग का, ठीक है। डोंट टेक हाई रिस्क ऑन दिस बाइंग ट्रेड इन नेचुरल गैस। सेवन मिनट लेफ्ट यूएस मार्केट। US market is just open in 2 minutes. Candle expected है US market opening पे 1 minute left now only. क्वांटिटी ऐसा थोड़ा स्ट्रिक्ट रखना नेचुरल गैस बाइंग के ट्रेड में. Seconds.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are down here across the board. Not huge drops, but a lot of risk managers may not want to go into the weekend holding right now. S&P futures down a quarter, NASDAQ futures down a third. You can see some IPOs. Janus Living ringing the bell at the New York Stock Exchange. They sold shares at the top of the range yesterday, so it's a happy group down there. And then Horizon Quantum ringing the bell down at the NASDAQ market site.
Oh, I love this kid in the front. He's catching the confetti.
I like it when they bring their kids. You know what?
Me too.
It's a bucket list event. It's the kind of thing that you tell your kids, your grandchildren about. I rang the bell at the stock exchange at the open, right?
Yeah.
You don't really tell them if you rang the bell at the close. It's the open that matters.
Yes, I like that. I like that a lot. Well, here at the open, Matt, I'm looking at shares of FedEx. They are up 5.3%, moving around a little bit. They boosted their full year forecast as its network restructuring takes shape. They also talked about the war in Iran on the call, saying that it won't have a material impact on the business for now, but they did flag, look, with the volatility, especially in energy prices, this could have wider economic ramifications.
Speaking of energy, let's take a look at some of these producers that Cole has in his portfolio. Actually, I'm going to talk to him about what he has in his portfolio. I don't know that these are the names, but Chevron, ConocoPhillips, EQT, all looking at gains today. They're mild, and you can see Chevron turning down, but it's in a down market. Let's get back to Smead Capital CEO, portfolio manager Cole Smead. It's, as I say, a complicated patch, right? Because we've got NYMEX trading at 95. Brent was up to 120 yesterday morning. Now it's at 110, but there's a big delta there now. I know that not all of our refiners are set up for WTI. How do you know what to buy? I mean, obviously you spend a lot of time in this industry.
Yeah, so we only own the producers. Now, why? Actually, Oxy recently sold off OxyChem, okay? The reason for that is you make the highest returns on capital upstream, and then as you go downstream, they're attractive returns, can be, but at the same time, they're really a fixed return relative to the upstream, okay? And so anytime you can go upstream at attractive prices, that's where the highest returns on capital are. So here's how I think about today. Are we going to see a bid and returns pick up across the space? Yes. Why? Because upstream returns are climbing massively. I mean, if you compare where we started in the year to where these companies are making free cash right now, to say they're doing 2 to 3 times the free cash flow may be an understatement on a daily accrual for cash basis. And so as you're watching these stocks go up, say 40, 50, 60% relative to where the returns on capital have gone, that's not that high. Now, I'll add one more thing. We are in a world where we just watched the SaaS apocalypse go on, and those are asset-light, high-return businesses, supposedly. Well, right now, the most capital-intensive industry, like energy, is outproducing higher returns on capital than SaaS businesses, and nobody still owns them.
But by the way, which producers? You're talking about the major integrated oil producers. So which ones do you own?
Yeah, so our U.S. side, our largest holding, both portfolios of ours, is Cenovus, oil sands producer. They took out Meg last summer. They've already announced in that Meg acquisition, Meg was producing about 108,000 barrels. They're going to do 150 in a couple years. Meg was bought for about $54,000 per flowing barrel as of November. That was at lower prices. So what is the value per flowing barrel that the market should be implying? As of these prices, we know it's higher. Is it 50% higher? Is it 100% higher? I point that out because it kind of gives you a nice comp for the market. Go look at APA. APA was $14 last April. We're talking about a stock at 37 right now. Okay, and so that's how quickly the prices have shifted, because ultimately the Permian producers were left in this, you don't have much inventory, Canada's going to be marginally more attractive, and now these Permian producers are being bid because ultimately the word is torque, right? Where is the price of oil moving the operating leverage in a business in a way that causes free cash flow to explode? And where that is the best is in the non-majors. Okay, so you're an independent producer like an APA. I will not be surprised to see more of these independents get picked up by the majors, because that's where free cash flow is exploding. All stock deals is what you're going to see. I'll throw out one other idea to you. Who's been really explaining this and really thinking about this cerebrally? Adam Watrous, who runs Strathcona Resources, ticker is SCR. He's been explaining how long-term bullish he is in the space. He's who put Meg in play. He didn't win it, but they're a producer that came from going public in 23, stock sitting at an all-time high after they just handed $10 of cash off late last year. And again, I know that name. You guys have never heard of that name. And that's pretty common in the energy business right now, because investors have had no interest in the space.
In order for this play to really accelerate, do you need to have elevated oil prices? You're describing a structural shift, but to get max bullish on this, what needs to develop in the Middle East, and what needs to happen to oil and energy prices?
Yeah, dogs chase cars and people chase stocks. That's never going to change in my lifetime. Okay, and that's just the nature of the beast. So, the capital cycle theory argues that, you get low prices, people cut supply. That's what we've just been through, right? We were watching, I think we own Diamondback Energy, for example, in our U.S. portfolio. Their CEO was talking about, look at the prices, and by the way, we are going to be reducing our supply and reducing our working capital and reducing our CapEx. So what's going on is there is no incremental CapEx going on, and what's happening to the returns of these businesses despite that? They're exploding in returns, okay? It's going to take a while for that to go away. The initial reaction this 2 or 3 weeks ago was like, oh, fade this. This is not that big of a deal. Kind of like Veni, as I like to call it, Venezuela. Veni was not that big of a deal, right? Oh, this is probably going to be fixed, and Trump's going to do something amazing. It's going to be wonderful, and oil's going to stay cheap. This is far more of a long-term conflict, a structural impediment.
So you don't see, even if we have, taco tomorrow, you don't think that Brent is going back to $70 a barrel quick?
Well, you got to get Iran to taco out too. That's the issue here. Iran's looking and saying, you know what, we're the tail that wags the dog right now. They're shipping oil. Everyone isn't. That's who's been moving, oil out of the Strait of Hormuz is Iran. Here's one other thing. Look at the futures market. I said the physical market's way tighter right now, and it truly is. Why is there such a spread? The market, the stock market operators, the speculators, they in general are less concerned about this. I think markets have been very slow to adapt. We've seen this. It's been very slow. But it continues to compound where people are becoming more and more concerned. And I think the real question out of this is, what do they choose to chase? If they chase the energy stocks, you're going to have high prices, because that will incentivize the American producers and the Canadian producers to produce more oil. But the futures curve is only giving them $70, say 18 months to 2 years out. Is that enough to really get me to go in the open market, build a big project, and hedge? It's just not there. Spot is tighter than the futures, and therefore we're going to see an environment where they over-earn. And it's just great. Stock buybacks look really attractive here. Mergers look really attractive here. Again, if you just if someone says, well, Cole, couldn't you just buy the XLE? Yeah, I'm sure you could beat the S&P the next 10 years in the XLE. That's been true for a while, by the way. But how do you make the best money in this is who's going to take advantage of these circumstances, whether they're the issuer trying to acquire others or who's going to be really aggressive on their buyback the next 12 months.
By the way, as oil and energy producers have risen, banks have been on the other side of this trade. They're now in a correction. Bank of America and JP Morgan, I know you hold both of them. Both are down more than 10% year to date. I was looking at a Ned Davis research note that they cut financials to sell, saying that there's a flattening yield curve and private credit concerns. Volatility from geopolitical instability means less M&A and IPOs. How are you thinking about the sector?
Yeah, just because rich people and institutional investors went out and bought products that they shouldn't have, and they're finding out they're less liquid and not as great as they were sold, that's happened numerous times. Like, why is this new way of losing money so different than the past, okay? Banks have been tied up in that because the idea is, like, we own Western Alliance. They're in a fight right now with Jefferies over one of these loans tied to Jefferies' asset management business. Ken Vecchione, their CEO, and Rich Handler got together for breakfast, here a little over a week ago. They sat down. They do not agree. Now, in our opinion, why is Jefferies, having that conversation? They're not really worried about the loan that they're dealing with Western Alliance. The question is, who's next in line? Okay, I think that's what's going on, and that's what people are really worried about, is who's next in line for some of the people around these alternative credit-related situations. But the idea that the economy is somehow going to get crippled, the average American, their house is the most important thing. Underwriting standards and mortgages have not changed at all. It's the underwriting.
The average American owns a ton of stocks right now.
Well,
right?
no. The average
relative
American,
to history.
The wealthy Americans own a lot of stocks, or a large amount of stocks relative to history. If you look at the Fed's, equities as a percentage of household financial assets, that's true. But the average American, the median American, doesn't own stocks. That's the catch. We have to not forget that you're in New York. You work in the finance business. I work in the finance business. You get to hang out with rich people. I get to hang out with rich people.
But isn't it a problem that that's the part of the world or the part of the American economy that's holding it up right now?
That's a myth. And I totally reject that.
Please talk more about that.
Here's what I say. That's like saying, okay, the people that had success in the past will stay there forever. I've met trust fund babies that end up with no money. That doesn't hold true. Now, you see these things where it's like, oh, the top 10% are doing half the consumption of America. Once you buy 3 houses, does the 4th really change your consumption? Once you have 4 cars, the consumption doesn't change as much as people think. So I think that's a big myth. What is big is government spending. 7% of our GDP is deficit right now. Why are we seeing this buffer all the time? Tariff tantrum, no recession. Even this, because ultimately that spending is going into Medicare and also Social Security and now defense spending. And that is such a good buffer. Now, is that problematic long term? Yeah. But do you see any politician running on austerity or fiscal, thriftness? No. So that's not going to end anytime soon. So I look at this as, go back to the 70s. Use that as an analogy again, okay? You had a technical recession early in the decade, 1970, okay? You had a real recession in 1974 when the Nifty 50 broke. We had an oil shock in 73 from, off of Yom Kippur. And we had multiple shocks during the decade. But 74 was the only real recession in the 70s. So here's my theory, okay? And I won't throw my colleagues under the bus on this one. But I think we're going to see an economy that does way better than people expect. That is different than risk assets, and that's different than equity risk or beta. Those don't look attractive. And who's going to have to pay the penance? Institutions and rich people.
Cole, I wish we had more time with you. This has been really fantastic.
I got a lot more. I'm looking forward to the commercial break because I have a lot more questions. But we don't have time. We got to go to the commercial. We have to pay our bills. Smead Capital CEO and Portfolio Manager Cole Smead. Coming up, FedEx's turnaround plans gains. The turnaround plan gains momentum.
Still, natural gas is sideways. बिटकॉइन भी देखोगे काफ़ी टाइम से रुका हुआ है कंसोलिडेशन में, काफ़ी बड़ा कंसोलिडेशन कर रहा है. अगर सेलिंग की वेव आ गई ना, अच्छा खासा गिर जाएगा. लास्ट इस तरह का कंसोलिडेशन नवंबर 2025 से जनवरी 2025 3 महीने का हुआ था. मार्केट वहाँ टॉप जो बनाया था उस स्विंग पे, वहाँ से 37-40% गिरा था. ये भी देखोगे कंसोलिडेशन मार्केट ऑलमोस्ट फरवरी से बना रहा है. 2 महीने तो हो गए, फरवरी मार्च, 1 महीना और कंसोलिडेशन में अगर गया और अगर मान लो यही स्विंग हाई है और यहाँ से फॉल करता है, बड़ी सेलिंग आ सकती है. 70,000 पे कंसोलिडेशन है बस. नो साइन ऑफ क्विक रिकवरी, रिवर्सल साइन भी नहीं बन रहा है. भी करते रहो गाइस. डोंट फॉरगेट टू लाइक दिस स्ट्रीम. नेचुरल गैस देखो ऑलमोस्ट कंसोलिडेशन में चला गया उसी लेवल पे. तो देखना पड़ेगा अब यहाँ से बाइंग आती नहीं बिकॉज कंसोलिडेशन काफ़ी देर से हो रहा है. ये बिटकॉइन में वैसे देखोगे नीचे सपोर्ट जरूर है 50 मार्केट ने जो लास्ट स्विंग बनाया है, बट लगता है वापस वहां तक वापस आने की सोच रहा है 57,000 के आसपास, 57,500 के आसपास। राउंड नंबर देखोगे 57,000 टू 59,000 विल बी सपोर्ट। लास्ट टाइम डीप लेवल से सपोर्ट लेके गया था, इस बार जब आया था मार्केट अभी फरवरी में खाली टच करके चला गया। ऊपर आपका वही 1,12,000 के आसपास रेजिस्टेंस है, विच इज फार अवे। बाकी बिटकॉइन अगर गिरता है, इस लेवल को होल्ड नहीं कर पाता है, लास्ट आप कह सकते हो लाइक 54,500। इसके नीचे अगर सस्टेन करता है डेली टाइम फ्रेम पे, सो वी कैन एक्सपेक्ट प्राइस फॉल टुवर्ड्स 32,000, इसलिए ये लेवल बड़ा इंपॉर्टेंट है। लास्ट लेवल आप मान सकते हो 54,500 से लेकर 60,500, ये 6,000 पॉइंट की रेंज है. Price should defend this range of 6,000 point. If not, then we can go towards 30,000 to 33,500. Means from current level, this is around 50%. From all-time high, it is almost 80%, I think. Yeah, 70 or 80%, 75%. So this level is very important right now for a higher time frame. ये लेवल वैसे प्रीवियसली काफ़ी स्ट्रांगली होल्ड किया था जब प्राइस यहाँ पर रिसेंटली कंसोलिडेशन किया था मार्केट ने, अप्रॉक्सीमेटली इन अप्रैल टू अगस्त, अप्रैल टू सितंबर या अप्रैल टू अक्टूबर 2024 कह सकते हो. उस टाइम फ्रेम पे यहाँ पर काफ़ी कंसोलिडेशन हुआ था मार्केट ने, इसके बाद काफ़ी बड़ी रैली दिखाई दी. द थिंग इज दैट मार्केट यहाँ पर इतना ज़्यादा कंसोलिडेशन हुआ था, डीप लेवल से बाइंग करके गया है, तो क्या यहाँ पर लिक्विडिटी भी और पेंडिंग होगी, दैट नीड टू बी सीन. यहाँ से जब मार्केट रिटर्न किया था लगभग 112% का रिटर्न था. अगर अब ये ब्रेक करता है डेली टाइम फ्रेम पे, सस्टेन करता है, सिर्फ कैंडल क्लोज होने से नहीं, एक के नीचे एक दो कैंडल क्लोज करते डेली टाइम फ्रेम पे 54,500 के नीचे, सो वी कैन एक्सपेक्ट या 30,000 टू 34,500 या 30,000 से 33,000 के बीच में जा सकता है. सो करेंटली इट इज़ ऑन मेजर सपोर्ट. ऊपर कोई मेजर रेजिस्टेंस नहीं है, एक मेजर रेजिस्टेंस सीधा 1,10,000 से 1,15,000 16,000 के आसपास ही दिखता है. Need to see will it go towards that particular level as well or not.
Yeah, I mean, it's quite a turnaround. S&P 500 right now on track for the fourth straight of weekly declines. This would be the longest slide in about a year at this point. We have the S&P 500 45 points lower right now, down 0.7% at 6560. The Dow Jones Industrial Average 134 points lower, that is down 0.3%. The Nasdaq 100 263 points lower, down 1%. It's technology that is leading stocks lower right now. As you look at Brent crude, that just turned lower, down about 27 cents, 108.34 a barrel. That's been up and down all morning long. Unilever in talks to sell its food business to McCormick, the spice people. No details on how any deal would be financed. Unilever's food unit has a potential equity value of as much as $33 billion. And then one of the other standouts today, satellite company Planet Labs. This is a Google partner delivering record revenue for the latest fiscal year, reflecting growing demand for satellite imagery. As those shares right now, 27% higher. Let me give you also McCormick. That was down about 0.6% on that Unilever news. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul. I'm doing the countdown to spring.
When is that?
It's coming at 10:43.
Oh, all right.
So
we started off this morning with winter because it was like 30 degrees here.
Well, you know, again, turn that frown upside down.
It's going to be a milder weekend.
Okay.
It's supposed to be nice around here anyway.
Yeah.
I mean, it's the Southwest.
I might just break out the Vespa from winter storage. We might be getting to that point here.
I need a few more weeks before I see you on Ocean Boulevard, Ocean Avenue.
The wind blowing through his hair.
Exactly. John Tucker, thank you so much. Appreciate it. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and Bloomberg.com as well. As John was just reporting, sell-off in the markets, but let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Natalia Kinijevic. Natalia, what are you looking at today?
Let's start with FedEx, guys. The ticker is FDX. Shares are up by 2%, but they were up as much as 10% in pre-market. So the company raised its adjusted EPS forecast. We see that even the bottom of this new range is above analyst expectations. FedEx said that it does not expect that the war in the Middle East to have a direct material impact on its business. However, of course, like some bigger consequences, such as higher fuel prices and potentially slower demand from consumers, that could be a headwind for the company. So Bloomberg Intelligence is saying that this outlook appears to be achievable, again, assuming that higher energy costs will not significantly derail consumer spending. And some analysts, an analyst from Morgan Stanley also highlighted that there is a sharp segment divergence, guys, because express segment did well, but freight segment materially missed on weak market conditions. So not everything is great within the company.
All right, good recap there of FedEx. What's next on your list?
Yeah, let's talk about Supermicro. That's a big story. So shares are down by 27% today. So the U.S. charged a co-founder with illegally diverting billions of dollars in NVIDIA-powered servers to China, which is a violation of U.S. exports control. So the company's co-founder and two other individuals allegedly sold servers that are assembled here in the United States, and they have NVIDIA cutting-edge chips, and they sold those servers to China. The total amount of servers that had been sold is about $2.5 billion. Analysts are saying this is a big reputational risk for the company. Potentially, it could impact potentially, we can see that the company will lose its share to Dell. And Raymond James analysts are also saying that Supermicro might be subject to greater scrutiny, and as a result, they can expect higher costs and delays in its operations.
All right, you got one more here.
One more. This is a company that potentially people don't really know about. It's called Swarmer. The ticker is SWMR. The stock is up by almost 1,000%, guys, this week. It went public. This is a small drone software company. The reason why it is important is, of course, that we see that Many companies from the defense industry are doing really well with these geopolitical risks and uncertainty. And analysts are saying even despite the fact that, I don't know, we have geopolitical tensions in the future or not, but military spending is going to be higher and higher. And it's not just this company. We also saw other companies from the defense industry, such as Aero Group or Voyager Technologies, that went public last year. They did extremely well. So defense sector is in focus.
All right, this is let's put this into focus a little bit. I'm just looking up this company. They did go public on March 16th, 3.45 million shares at $5 a share. And now it's $54. Wow. Lucid Capital Markets took them public. I don't know Lucid Capital Markets, but if you got into that deal, it's a pretty good deal. So,
and it's an unprofitable business, by the way.
Yeah, no kidding. Okay, no problem there. They're growing. They're growing the top line. They're growing the users. Natalia Kinyajevic, thank you so much for that. We appreciate it. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Boy, it's all been about the global crude market. That has been what's been driving these markets for sure. So you have to have a call on oil before you have a call on anything else. And our next guest has, I think, one of the calls on global oil, and that's Ellen Wald, president of Transversal Consulting. Ellen, put into context for us what you've seen over the last 21 days in the global crude market.
This is a wild ride. I mean, this is absolutely the most wild ride we've seen probably since 1973. We've got the Strait of Hormuz is still closed. We're starting to hear that the ships that are sitting there in the Persian Gulf are running out of supplies for the sailors. So we've got no crude moving. We've got attacks now on oil facilities, and still the price of oil today is about $104 a barrel, which seems extremely reasonable given the current circumstances. And I think what we're seeing is the fact that we had so much oil in storage, and that there's still the potential, if this does actually end and ships start to move, that things could get back to normal within, 2 months, I would say. But that window is very quickly coming to an end. We've got already long-term issues in the LNG market.
Yeah.
We're seeing shortages in developing countries. And we're at the point where once these oil stocks are used up, that there isn't going to be any turning back. Prices are going to shoot up and remain there.
Right. With every passing day, that idea that this will be a quick conflict kind of dies a little bit. Saudi Arabia has modeled scenarios where oil would hit $180 a barrel. Walk us through how we get there and what impact that would have.
So I think we should remember that this is a model, and it's their job to model all of these various scenarios. And so while $180 a barrel sounds really scary, it is just a number and it's just a model, and that doesn't mean that we're absolutely there at the end of April. On the other hand, it's certainly possible. I can see why. I can see that this doesn't seem unreasonable to me if we're in a situation by the end of April where oil still hasn't moved out of Hormuz. Things are still sitting there. I mean, then we're really going to start to see, potential for some wider spread destruction of oil facilities, and that can lead to some really long-term damage, which can take much longer to get back online, which in turn will impact the oil prices farther out. So right now, a lot of traders are looking at like 6 months from now, and they say, oh, well, everything could be back to normal. And so we're seeing, like lower prices in 6 months. And that impacts the prices that we're seeing now. This could change. And if this conflict continues for another couple weeks without any serious changes, and we still see the potential for destruction of oil fields, then I can see why they're predicting $180 a barrel. I mean, right now, they're selling Arab Light to customers at $125 a barrel. But when Aramco's stored oil runs out, that doesn't mean they'll have no oil, but it means that they won't be able to rely on what they have in storage, at the Sumed pipeline. Then they're going to start charging $145 a barrel, and it's only going to go up from there.
Ellen, 30 seconds left. What do we know about the damage to some of the infrastructure in that region?
So we still don't know a whole lot. We do know that there was damage to Qatar's LNG facilities, and we don't know how long it would take to repair that. You know, it really depends how long the conflict continues. It's not like you can go down to the hardware store and just get spare parts for these things, but they could see a decent portion of their LNG production offline for the rest of, say, 2026.
Oh, wow. Ellen, thanks so much. Really appreciate it. Ellen Wald, folks, she's, again, one of our go-to people on global energy. She's been doing it a long time. Great resources there. President of Transversal Consulting and a senior fellow at the Atlantic Council. Somehow zooming in from Boca Raton, Florida. Not bad. Looking at the markets here, again, WTI and Brent, they're pretty much unchanged on the day. I guess that's good news relative to what we've seen over the last several weeks, a little bit of stability. But again, this is what they've been warning about. Higher for longer. That's not good. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker. We're in the Bloomberg Newsroom with this Bloomberg Business Flash. Bond traders increasing their bets on an interest rate hike to 50% by October. There's concern that the the war in the Middle East could stoke global inflation, and maybe it's going to last longer than initially expected. Meantime, in conjunction with that, the U.S. sending as many as 2,500 additional Marines and 3 more warships, according to the Wall Street Journal. So that's raising the specter of boots on the ground, specifically with respect to Karg Island, because there's the possibility that might be targeted by the U.S. as well. Ground forces may be. FedEx Chief Executive Officer Raj Subramanian assuring Wall Street that FedEx's own performance is steady. They said on the conference call that demand trends fundamentally remain unchanged heading into the fiscal fourth quarter for FedEx. Those shares this morning up 2.2%. And as we look at stocks, the Dow Jones Industrial Average down 300 points. S&P 500 down 64 points. That's a 1% decline. The NASDAQ 100 now down 306 points. That's a decline of 1.25%. The 2-year yield is up 13 basis points right now, 393. The 10s are up 12 at 436. The long bond is 9 basis points higher. That is at 492. By the way, the average price of a gallon of diesel in the U.S. surpassing $5, and businesses growing more concerned about the impact of their operations and the economy. And I hate to bring bad news to everybody, but Chuck Norris has passed away. This is an Instagram post from his family. The actor, martial artist, was 86.
Yep.
So
it's a good run.
Great movies like Agent Recon, The Green Fog, The Expendables 1 and 2.
That was later in his career, The Expendables.
You're the celebrity lodestone, so I turn to you for everything Chuck Norris about this. So
I don't know. Chuck Norris was not aimed at my demographic.
Okay. The Way of the Dragon.
Sure.
Yeah, that was a big one. We checked the market. Never saw it. We check the markets for you all day long, right here on Bloomberg
Texas
Radio.
Rangers. That's the
Oh, okay. Yeah, on the TV. All right. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, good stuff. Thank you so much, John Tucker, and rest in peace, Chuck Norris. Let's take a look at these markets right now, and we want to bring in Jay Pulaski. Jay is founder and chief strategist at TPW Advisory. And Jay, I know you put out a note every Friday, and things have changed since last Friday. So I'm curious as to how you are thinking through right now this war in Iran and what it means for markets. We have the S&P 500 down today, and the past 3 Fridays, worth noting, the S&P closed lower as investors de-risked into the weekend.
I think you're right, Scarlett, right? It's a lot happening very, very quickly. And we note that in our monthly that is coming out later today, talking about whether our main thesis for this year, which is a continuation of the global growth long cycle, which would support global earnings and thus rising global stocks, whether that's at risk due to the Iran war. And our conclusion at this point is that it's not. Oil sensitivity in the major economies is nothing like it was in the 70s or 80s. Estimates suggest that it's down 2/3 in the United States, as an example. The market has derated significantly, worked through the tech overrating. For example, NVIDIA is now selling at a cheaper forward PE multiple than the broad S&P. The private credit worries, the software AI apocalypse, all this stuff has allowed the market to kind of deal with Iran in a reasonable fashion. So we think growth globally is going to be sustained. We note that folks like Apollo have done the work, and if you have even $100 a barrel oil in the U.S., which WTI is not yet at $100, but were that to be the case, Apollo estimates that the hit to GDP would be 0.1%. JP Morgan did work suggesting similarly $100 oil would take about 2 to 5 percentage points off earnings growth in the U.S. for this year. That would leave earnings growth at about 8 to 10% up year over year. JP Morgan has a year-end S&P target of 7,200. That's about 10 to 12% above where we are today. So, you know, notwithstanding the back and forth about missile attacks and who does what to who when, the bottom line, I think, is that the global economy enters the conflict in some pretty strong shape and accelerating, that oil sensitivities are much less than they were in prior crises, that forward earnings estimates continue to rise, that the hit to earnings should not be that significant. And therefore, we're the view that we want to hold here. There are some real winners. As an example, renewable energy. You can't ask for a better advertisement for EVs, for solar, for wind than what's happening in Iran. In addition, you have thematics like automation, all this talk about, you know, missiles being used up so fast and drones and things of this nature all point to autonomy and automation. And who is the leader in the globe in both renewable energy and automation? China. So we think China is a big winner in this. We think countries like Brazil and Latin America are big winners. And we think things like copper in the commodity space have been kind of oversold. Copper miners are down 30%. They ran hard, so pullback is normal to be expected. But everything that's happening suggests that the demand for copper is going to go up, not down. And therefore, we think there are opportunities that are presenting themselves for investors who have an ability to hold positions for more than, you know, a couple of hours.
Jay, if you're not that concerned about the geopolitical risks to growth, how about on the inflation side? We're seeing, you know, folks in the U.S. at the pumps paying, you know, 40% more than they were 3 weeks ago. That's a tax rate on their pocket there. How do you think about that?
Yeah, it's the same thing, Paul. The hit in terms of to consumers, oil sensitivity is, you know, down 2/3 from what it was in the late 70s or early 80s. And so these are facts. This is not, you know, a hypothesis or a theory. These are facts. The oil sensitivity is nothing like it was back in the 70s and 80s. However, you do raise a very, very important point, which I should have mentioned at the top, which is that politically, this is very bad for President Trump. And if there's one thing that President Trump is focused on, it's self-preservation. And so one of the reasons why we're not that concerned about what the Iran conflict means longer term is because we don't think there will be a conflict longer term. In other words, the potential for the president to search for an off-ramp is rising daily as his poll numbers crater and as things like, you know, you pointed out, gas up 40-30% in a matter of a month or so. That's not sustainable politically. And so we do think that the U.S. is looking for an off-ramp. And so while the talk is escalation and boots on the ground and things of this nature, we think the reality is that the U.S. is going to be searching pretty desperately for an off-ramp here in the next couple of weeks. Prediction markets suggest a ceasefire in the next 2 months. We think it's going to be sooner than that.
All right, good stuff. Jay, thank you so much. Jay Pulaski is Chief Investment Officer and co-founder at TPW Investment Management, saying that if there's one thing the market can be more certain of, it's that President Trump will find a way to preserve what he needs to.
Yeah, I'm kind of in that camp. I kind of feel like one day we're going to wake up and he's going to have a change of heart, whoever got
Declare victory in whatever form it is, right?
Yep.
Okay.
So we'll see.
Let's move on to some corporate news. FedEx coming out with results. It's seen as economic bellwether, even as it clearly has its own issues to work through, namely this overhaul of its businesses. Lee Klaskow is our senior transport logistics and shipping analyst here at Bloomberg Intelligence. And Lee, a good report here from FedEx, whose shares are right now up about 2%, a forecast that came in better than most people expected, including the range that it offered.
Yeah, it definitely was a nice print for their third quarter, which includes their peak season in December. It shows us that they're really executing on their plan. The beat was really driven by their express business or their parcel business. Their freight business, which is their less than truckload business, continues to struggle. That's really not a company-specific thing. That's an industry thing. The LTL market has been pretty weak over the last year, and we expect that weakness to continue. I think people were encouraged about the fact that they raised their full-year guidance. They did put out a $25 EPS target for 2029 when they had their analyst day a couple months ago. We've written over the last month that we think that might be conservative. If the company continues to execute on its restructuring plan, and assuming that the economy doesn't crater from here, a la a recession, I think that its numbers can be made.
Lee, I know it looks that some of my banker buddies got to this company at some point because they are going to spin off their freight unit, I guess, sometime in June. What are you looking for there? What's the story there, do you think?
Yeah, so I think they're following the footsteps of UPS. UPS also had a less than truckload business that they spun out, they sold, to TFI, a Canadian company. And I think what these parcel carriers want to do is they want to focus on, that they're parcel carriers and not some of these ancillary businesses. I think this will really sharpen FedEx's focus. The LTL business, or the FedEx's LTL business, is a great business. It's the largest less than truckload carrier in North America. It'll be an interesting spinoff. I mean, we'll see where valuations are by the time they spin it off in June. Like I mentioned, tonnage has been kind of depressed. So obviously, maybe they're not getting the most that they possibly can. I mean, because of the timing, but I think it is a good thing for them to do. And not only doing that, they're doing things that was unheard of maybe 3-5 years ago. They're combining their air and ground networks, and they're doing things within their businesses to really drive overall productivity. You layer on top of that technology investments to enhance productivity. This could be a company that can, generate earnings, north of that $25 number that they put out for 2029.
Lee, final question to you. We have about 30 seconds left. We know FedEx has sued the federal government for refunds on tariffs. Any update, any progress on that front? Is this a meaningful number?
Yeah, honestly, I don't know much about that. They really didn't talk that much about it on the earnings call, but it would probably would be a pass-through that they give back to their customers, so it's not really going to impact their bottom line. And if it does, it'd probably be, not meaningful.
All right, Lee Klaskow, thanks so much. Appreciate it. He is the transport czar for Bloomberg Intelligence. He covers all the rails, the trucks, the shipping, the air freight, all that kind of stuff.
If it moves, he covers it.
If it moves, he covers it. Exactly right. So we appreciate that. On FedEx giving some better than expected numbers there. So good news there. Some of their restructuring seeming to be playing off. And again, look for that spin out via an IPO, I believe, of their trucking
freight unit.
In June. So that could be interesting. S&P down 50 points, 0.75%, down towards the low of the session. The Nasdaq off 1.1%. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Bonds are falling in price. Stocks are falling. We have crude oil, Brent crude, up right now 49 cents, 50 cents a barrel, 109.13. Dow Jones Industrial Average down 242 points. The S&P 500 55 points lower. The NASDAQ 100 down 274. And the two-year yield 14 basis points higher. We are at just about 394. The 10s 13 basis points higher there. That is just about 438. Traders pricing in a 50% chance the Fed's going to actually increase rates by October because of concerns of a protracted war. The Wall Street Journal reporting the U.S. sending thousands more Marines and 3 warships to the Mideast. That raises the prospect of boots on the ground. Among the individual stocks on the move, let's check out Unilever in talks to sell its food business to McCormick, the spice people. That would be the biggest overhaul of the company since it was founded almost a century ago, Unilever. And then Supermicro Computer, that is tumbling right now after the U.S. charged the co-founder with illegally diverting billions of dollars in NVIDIA-powered chips to or servers to China. Right now, as we look at shares of McCormick, let's do that first. They're down 2%, and Supermicro Computer shares 28% lower. CBS News cut 6% of its workforce today. The editor-in-chief there, Barry Weiss, and President Tom Sabrowski said the affected employees would be informed by the end of the day. Well, they write them. I just informed them, I suppose. They write in this memo we're looking at. New audiences are burgeoning in new places, and we are pressing forward with ambitious plans to grow and invest so that we can be there for them.
Without you.
Without you, I guess. We think it's like 60 employees, but anyway, they're owned by Paramount Skydance. And we check the news for you, markets, all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Paul and Scarlett.
Okay, so on that note, you have concerns about the job market. You also have concerns about inflation. When I walk into any store these days, I'm thinking about inflation. You feel it when you are going to the gas station.
Yeah, but which is why I go to the place with the animatronic chickens who sing. Why I buy my eggs.
You're talking about Stu Leonard's.
Yeah, I went to the Yonkers store. I also got a Christmas tree there. Mm-hmm. So I'm a Stu fan.
Well, rising prices for staples like food due to tariffs and now gas following the start of the Iran war are certainly things that are top of mind for folks who are going anywhere right now. So let's check in with Stuart Leonard Jr. He's president and CEO of John Tucker's favorite market, Stu Leonard's, and he joins us from Connecticut. Stu, it's great to speak with you. No one likes having to raise prices, but at some point they need to. What's been your strategy when it comes to price increases because of higher costs on your end?
Well, we're in the fresh food business basically, and it ebbs and flows all the time. It could be bad weather some places. There could be a drought out in the Midwest, and that all affects food prices. So one of the things, look, we operate on very thin margins in the food business. All supermarkets do. And when something like this comes up, like the tariffs, when they hit us, now we got the fuel surcharges that are hitting us right now. We try to just eat it for as long as we can, and just hold on. I grew up in this business. I've been doing it 50 years. I grew up on the floor here, and I got to think about the people pushing the shopping carts around the store. I want to think like a customer, and they're fed up right now with their food bill right now is up to their chin. So what can I do? I got to hold it as long as I can, but I can't do it forever. Otherwise, I'll start losing money.
Stu, based upon your experience so far this year with the higher tariffs, kind of I know you try to work with your suppliers to kind of share the cost here. How is it kind of shaken out? How much has been borne by you, the retailer, by maybe your suppliers, and then maybe by the consumer?
Well, I think your opening comment that you had today, nobody wins when you raise prices. Okay, the suppliers don't win, The ranchers don't win. The farmers. Stu Leonard doesn't win. So everybody holds off. Usually what we're end up probably doing, we're starting to get some fuel surcharges hitting us right now. We're bringing fresh product in from the beef from the Midwest and you know, berries and produce from Florida and California. You know, and those fuel costs, I mean, the guy's got to fill his truck up to get it here. So those costs have been going up. Usually what we can do is say, we'll split it with you. That's the first step. So that's what we're probably going to start doing. And then hopefully, the way I feel, this is going to be short term. I hope the government is going to get this all worked out with the flow of oil, and I hope energy prices will be coming down in the future.
Yeah, well, I think that's something we all hope for. Of course, we also know that the Supreme Court struck down President Trump's tariffs, and I'm wondering where that leaves you, Stu Leonard's, and where that leaves prices on those goods where they had gone up because of tariffs.
Hey, you know what? I think that's above my pay grade right there. You know, we're a family business here in the Metro New York area. I don't really know how they're going to rebate people. I know Costco was suing the government, and I think our wine suppliers just wrote that there's some money coming back from the tariffs on the liquor end of the business. But I don't really know how that's going to work out. I like getting a refund check, I guess, if it happens.
Hey, Stu, one of the areas that seems to be a persistent area of inflation for shoppers is just the cost of beef. And, you know, we've been told that the actual cattle herd in this country is at a very low level. What's your understanding of that market?
Hey, look what I have for you right here. I brought one of these. How's that look?
Oh, there we go. The tomahawk.
That's what our ranchers, when they come back from the Midwest, that's what they want to eat. It's a ribeye, you know, tomahawk steak, and they're great. But you know what? Right now, there is a 50-year low supply of cattle right now. It's at the low. The herd sizes are the smallest they've been. So obviously, it's going to drive price. One of the reasons is there was a great drought. The grass wasn't out in the pastures, so the ranchers had to start feeding the cattle food instead of letting them eat the free grass. So that drove the price up of beef, and it's held up there. A lot of the ranchers we talked to are starting to expand their herds now. So I sort of see prices coming down on beef as supply increases a little bit. But you know, here's what you can do if you want to save money. Instead of buying beef, like if I want to go get a New York strip right now, it's going to be roughly around $15 a pound. What you can do is instead, if you go to pork, which I've done, we have this prime pork from Pennsylvania, and it's delicious. So you could switch from a $15 product down to a $5. You could do it with chicken. So we're noticing customers a little bit are starting to alter their diets a little bit by buying lower price items right now.
Makes a lot of sense, and certainly everyone's taking a closer look at those price points when they make that decision. Stu, thank you so much for joining us. Stuart Leonard Jr. is president and CEO of Stu Leonard's, a very popular market across Connecticut. As John Tucker has mentioned, also in Yonkers. I go there pretty regularly.
Cool. Yeah, we don't have those in Jersey. They could come to Jersey. That'd be pretty cool.
What's your local market in Jersey?
Oh, they are in Jersey. Okay.
Not in your part of Jersey.
Yeah, not my part of Jersey. I don't know. We go to the shop right in Belmar. It's a very nice store.
I think I've heard you mention that a couple of times.
Yeah, they take care of us there. It's all good. It's all good.
All right. Well, we are looking at markets that are on the move. We're ending the day, or I should say ending the week, with declines, if these declines do hold. The S&P 500 down 0.8%. We have a lot of options expiring today as well. $5.7 trillion in options contracts expiring, so that could add to volatility, especially at the close of trading as well.
Yeah, absolutely. And I'm just looking at the relative strength index for the S&P 500. We are at about 32, a reading of 32, and a reading of 30 is typically believed to be an oversold territory, or approaching oversold territory. That's that's the only technical and
well, we're at a 4-month low, and yesterday we closed below the 200-day moving average, the long-term trend line.
So that's
the
either
first time
breaking
since
down,
May.
or I don't know.
Yeah,
So
something significant is happening.
Yeah, I'm not taking any risk into the weekend, that's for sure. This is good.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and streaming live on Bloomberg.com/video. That's how it works there. The business of sports. Nobody does it better than our next guest, Randall Williams, U.S. sports business reporter for Bloomberg News. He doesn't mail it in from home like the rest of these folks. He's live in the Bloomberg Interactive Broker Studio, and we appreciate that. Randall, I'm so glad you're here because, to me, I've been following closely this WNBA collective bargaining agreement because what I think we've all noticed over the last several years is just the explosive growth of women's women's sports in general, but certainly the WNBA. And boy, I did not think the economics for them reflected that. Does it now with this new agreement?
I remember when Caitlin Clark was drafted, I think all of us, Bloomberg included, ran the story that she was going to be making either was $76,000 or $78,000. And you think about the growth that she brought to the league, as well as many, many others. I mean, the league was growing before she arrived as well. And then she and her rookie class, Angel Reese and Cameron Brink and so many more, served as a tidal wave. And so their salaries didn't reflect that, but they will soon.
They will soon, but there was a lot of bad blood between the commissioner, Kathy Engelbert, and the players union leading up to, the agreement that they'll come to something together. Where do they go from here? Because I wonder how much of that kind of casts a pall over how they work together going forward.
It's a great question. And I think there was a picture that was posted by, I want to say it was by the the union side of things. And they toasted when they got a deal and everyone looks happy. And of course, they have to have a deal in order for the league to continue. Right. At the same time, there were some very, very strong comments made that in all my years of covering sports, both professionally and then as a kid, I've never heard anyone make comments like Nafisa Collier said about Kathy Engelbert. And, we also reported that Kathy had conversations about whatever her next chapter was, meaning that she could depart the league. Now, is that still a factor now that a deal is close to being done? We're going to find out probably in the months and maybe a year or so to come. I think that the next time she talks will be at the WNBA draft, and I have no doubt that someone will ask about it.
Well, we know across sports globally, the main driver of the economics is the rights fees, media rights fees. Where's the WNBA these days?
So that was a big part of this, was that the WNBA agreed to a new media rights deal. I believe it was in 2024 with Amazon, ESPN, and Comcast. And so that deal is going to pay them at minimum $200 million a year. And okay, so when the players were having conversations about it, they're like, listen, we're seeing expansion fees rise. We're seeing our media rights fees rise. And so they were like, if all of this money is rising, when is it going to come down to us? And the league and the players saw it two completely different ways for a long time, but they got on middle ground.
All right, and it's about time, frankly.
I agree.
Let's talk about college basketball because it is March 20th, and March Madness is in full swing. Here at Bloomberg, of course, we have our brackets for a cause. If you have a Bloomberg terminal, it's BRKT Go, where we've invited folks to put together their bracket and appoint the charity that would get a winning donation if they do come out ahead. And these are always full of surprises.
Absolutely. I mean, yesterday we saw Duke almost get upset by
almost being the key word there.
I was at a CBS watch party yesterday, and everyone was on edge. And then, of course, BYU lost to Texas, and so that first round and that second round are always dangerous. And I mean, Ken Griffin is leading right now, so I mean, it sounds like if he continues down this track, he'll be the winner.
I am close on his heels. I'm in the top 4% of.
How many points do you have right now?
26. I'm 568 out of 12,872 people.
Who do you have winning, Paul?
I have Duke winning. I just pencil in Duke, then I work backwards. Oh, and yesterday, let's not forget, Carolina lost.
Oh, here we go. Where'd you go to school again? In case anybody.
Yeah, exactly. So it was a very good day yesterday. So, how big is this for the media side of the business? Because it just seems a lot of people are concerned and upset with college athletics in general because it's maybe swung too far the other way with NIL and the transfer portal, and it's lost some of its cachet a little bit. Are we seeing that in the numbers anywhere?
I think you're seeing it across competition more than you are with the numbers, because I mean, you look at Duke's game yesterday. Again, I don't want mean to shame you because they came out on top, but you have more of these results and more upsets happening because college players are being paid more. So they have the choice to go and play for a smaller school that might be close to home, or maybe go somewhere far away that offered them an incredible price. Now, from the media rights perspective, Duke loses, and I can guarantee you there are media executives who are not going to be happy. And so Duke, Kansas, all the blue chip schools, the farther they go, normally the better the rights, the better the ratings.
And because of name, image, and likeness, these athletes and the transfer portal, these athletes can go to schools where last year, wasn't even on the map. So which schools look most interesting based on the players who have come over from other teams?
Which schools look? I need to be in college to answer that question because ultimately I would jump schools every single year if someone was paying me more. That's the right thing to do. I mean, unfortunately that's the manipulative part of this. Is that if you are in the transfer portal, let's say you make $80,000 your freshman year, then you make $120,000, then you have a good season that same sophomore year. Now someone's offering you $500,000. Now you're being offered $1 million. Why wouldn't you try to be a college basketball player for as long as you possibly could if you have no aspirations or you're not good enough to go to the NBA? And that's what's happening.
And that ties into a story that Janet Lauren had yesterday from Bloomberg News about some of these kids leaving the Ivy League.
Which didn't used to happen.
No, because they can then, because Ivy League does not pay nil money, but if you have a good season in the Ivy League, maybe a power school will pay you. So, boy, it's a whole new world. I just kind of characterize it as the Wild West. And
it is the Wild West.
There needs to be some regulation, and I think we're starting to move that way. There's a growing recognition there. Randall Williams, U.S. sports business reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. March Madness. We'll see how today unfolds for me. I got pretty good yesterday. We'll see how today rolls. I'll probably get beaten up. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. And it is presented by Golden Crest Metals. Stay tuned for more Bloomberg Intelligence. This is good.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Good Friday morning, everyone, from the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu. We're, of course, watching oil prices. They're not doing a whole lot this morning, but we are seeing stock prices decline because investors haven't wanted to go into the weekend long, given what's been happening overseas in the Middle East. So we'll check in with Becca Wasser. She is our defense lead for Bloomberg Economics here, and Mike McGlone, our senior commodity strategist, on not just what's happening strategically in terms of geopolitics, but also where oil prices are headed. We're also going to check in with Eric Kazatsky because it is Friday, which means munis are in focus. Paul loves it.
Yes.
Jody Laurie is our credit analyst. She's going to give us the latest on the cruise industry and Six Flags and other companies that have come under pressure as yields have moved up. And we're also going to check in with Garima Kapoor, co-founder and co-CEO of Min.io, on how the global AI race is now evolving. First, though, let's go to Charlie Pellet for our Bloomberg Business Flash.
All right, I thank you very much, Scarlett and Paul. We do have the Dow, the S&P, NASDAQ very much in the red right now, close to session lows. And this Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. goldencrestmetals.com/guide. S&P 500 index on track for a fourth week of declines as investors grapple with the conflict that has upended energy supply chains and reignited fears over inflation. West Texas Intermediate crude is higher, up 1.6%, 97.66 now on WTI. Brent crude 109.79 right now, up by just about 1%. S&P 500 index down 54, drop there of 0.8%. Dow Industrials down 264, a decline of 0.6. NASDAQ is down 1.3%. The VIX just below 26 with a 10-year at 4.38%. The 2-year 3.92%. Gold is down 1.6%, $45.73 the ounce. As for the overall market backdrop, Jay Pulaski is Chief Investment Officer at TPW Investment Management. And right here on Bloomberg Intelligence last hour, he said, big picture, there is reason to be optimistic.
You know, notwithstanding the back and forth about missile attacks and who does what to who when, the bottom line, I think, is that the global economy enters the conflict in some pretty strong shape and accelerating, that oil sensitivities are much less than they were in prior crises, that forward earnings estimates continue to rise, that the hit to earnings should not be that significant.
TPW's Jay Pulaski interviewed on Bloomberg Intelligence. Oil stocks higher. ExxonMobil, case in point, up 2.1%. Chevron up 1.6%. ConocoPhillips up by 1.2%. The Justice Department today filed a new lawsuit against Harvard University, saying its leadership failed to address anti-Semitism on campus, creating grounds for the government to freeze existing grants and seek repayment for grants already paid. Recapping, S&P down 0.9%. West Texas Intermediate crude up 2%, 98.05 a barrel. Brent 110.12 the barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and Bloomberg.com as well. Boy, this just came across my social media feed from Vail, Colorado. They closed the back bowls today. I mean, that is...
Lack of snow?
Early, yeah. I mean, high temperatures, lack of snow, that is like so early. There's some years they're skiing there till literally July.
Yeah, 2026 has been brutal. You were just in the West Coast, right?
I was just in Colorado at Aspen, and we got, I'm going to say, the last good week of skiing. And now there'll still be some spring skiing, but they had some snow the week before we were there, which made it decent.
Right.
But boy, there's just, it's tough out there this year. But to close the back bowls, this is the earliest I've ever seen.
And it also raises the odds of fires.
Exactly.
Forest fires later on.
Yeah, because the snowpack is their big source of water out in that part of the world. If they didn't, no snow, no melted snow. So anyway, tough stuff out there. Markets moving lower, as Charlie was just reporting. Let's take a look at some of the stock movers on the day. We can do that with Natalia Kenyajevic from Bloomberg News. Natalia, what are you looking at?
Before I start, I also want to say something about skiing.
Go.
I was in Killington this weekend,
Okay.
like this.
Yep.
It was really good.
I know. All the good snow's in the east this year.
I know. I wanted to go to Colorado because I bought an Icon Pass.
Yep.
And I was so upset because I can't use it because there is no snow in Deer Valley, no
Nope.
snow in Colorado.
Nope.
But I don't know.
So
Maybe next
you know
year.
what people that were really searching for snow? Japan. That's where they went this year.
And you have a strong dollar on top of that.
Yes,
so
exactly.
Good point. Good
bonus.
Good call.
Yeah, so going back to stocks, first of all, of course, energy. I'm looking at Occidental Petroleum. The ticker is OXY. Shares are up by 2.3%. JP Morgan upgraded the stock to neutral from underweight. Price target is now at 63 versus 49 before. So what the bull case here is because Occidental has 85% of its upstream production here in the United States. It will benefit, of course, from higher energy prices and increased cash flow as a result. However, the company does have one facility in the UAE, and according to JP Morgan, that facility suffered a physical damage in the Iranian attack in mid-March. Production is now halted, and analysts assume that facility will be offline through the middle of 2026, second quarter of 2026. Of course, analysts said that if a ceasefire was reached, of course, energy prices would decline.
All right, let's talk about chemicals companies, which of course are very closely tied to where oil prices trade. You're looking at one of them.
Yes, it is also one of the biggest stories that we are tracking. One of them is Mosaic. The ticker is MOS. Shares are down by 6%, dropped to the lowest level since December. Bank of America cut recommendation to the fertilizer company to neutral from buy. So Mosaic is one of the largest producers of phosphate, if I'm saying this correctly, and potash, which are used for crop nutrition. And now analysts are a little bit concerned. So on the one hand, these stocks are rising because increased attacks tighten supply. But analysts are saying this conflict in Iran is inflationary for raw materials. So some of those companies will suffer eventually.
Super Micro. What's going on there?
Yes, a big story, guys. The stock is down by almost 28%. The U.S. charged the Supermicro co-founder and 2 other people from the company that they illegally diverted billions of dollars in servers that were assembled here in the United States, and they contain NVIDIA's cutting-edge chips. And those servers were sold to China. As a result, that is a violation of U.S. export controls. Analysts are saying that raises reputational risk for the company. There is a risk of share loss to Dell, a competitor, and Raymond James analysts are also saying that Supermicro might be a subject for greater scrutiny and may face higher costs and delays in operations.
All right, good stuff. Natalia, thank you so much for our market drivers, and for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So we are now day 21 of this Iran war, and that country continuing attacks on Gulf Arab neighbors, even after comments from Israel and the U.S. that hint at some de-escalation. Energy infrastructure is what we're all focused on here. It determines where oil prices are headed, and it determines how long this conflict may last for as well. So let's bring in Becca Wasser. She is defense lead for Bloomberg Economics and joins us from Washington. Becca, the U.S. indicated it is considering an operation to take over Karg Island, which is Iran's major oil export site, as a way to pressure Iran to reopen the Strait of Hormuz and get the flow of oil moving once again. Walk us through how that might look, because there's also talk that Iran could look to, I don't know, get in the way of that by destroying its own oil facilities if they're convinced that the U.S. wants to seize control.
So the theory behind this, or at least as best as I can parse, is it's the U.S. essentially saying to Iran, look, we can hold Karg Island and your oil facilities at risk if you continue to hold the Strait of Hormuz at risk. And really here, we're seeing additional deployments of U.S. Marines to the Middle East. And I think there it's going to take them a little while to get to the region. So it's once again President Trump trying to up the ante and have the threat of force be enough to get Iran to capitulate. But, you know, there are tons of ways that Iran can, you know, really gum up that plan. One being that they could destroy their own oil facilities. Another is just with some of the drones, missiles, and other low-cost weapons they have to attack U.S. forces directly. If U.S. forces were to try and blockade or occupy Karg Island, they would be, in many respects, sitting ducks for Iranian attack.
Becca, from your sources, is there any expectation that these Marines heading towards the Middle East, and in addition to the already military personnel there, would they be deployed anywhere on Iranian soil? What's the thinking now?
Well, President Trump has said that he doesn't want boots on the ground. He's been very clear about campaigning against that from the start. However, he's also said that forces on the ground don't give him the yips. So we could see U.S. boots on the ground. That said, the White House has not been clear about what these additional deployments will actually be for. And so we shouldn't just jump to conclusion that the Marines are going to be there to take Karg Island. However, it does seem as though there are some serious considerations at the White House about the potential for U.S. forces on Iranian soil in some way.
Yeah, definitely of concern to large chunks of the groups that voted for President Trump in the last election. Excuse me. The other thing we know is that J.D. Vance, the vice president, met with oil executives this week. And I'm not sure that that came to any kind of outcome, but was the goal here to kind of address the surge in oil prices and see what options the U.S. has on its end?
I think right now we're seeing a lot of moves by whether it is Vice President J.D. Vance or President Trump himself to try and calm markets and to meet with whether it's oil executives, whether it's tweeting out various things, trying to get it so that the economic impact is not biting as hard as it currently is, particularly at this point in time where we see Iran ratcheting up its attacks on critical energy infrastructure, both oil and gas, throughout the Gulf.
Becca, thank you so much. We appreciate it. Becca Wasser, the defense lead for Bloomberg Economics. She's based down there in D.C. We are seeing oil start to tick up a little bit. We got Brent up about $1.10 here, just under $1.10 per barrel. WTI crude up $1.80. That's sitting right at
Given
$98.
recent moves, this is like nothing, right?
Yeah, exactly. But still, sending additional Marines to that part of the world, that's an ominous sign for a lot of folks. Mike McGlone joins us here, global commodity strategist here. Mike, are your friends in the oil trading pitch? Are they just kind of watching the news like we are here?
Definitely, and one lesson I learned as being the father and son of U.S. Marines, as I know you're in military families, you don't mess with the Marines.
Yep.
So we'll see how that works. We'll see how that works out. But right now, the key thing to remember is the front crude oil contract, the most widely traded contract, is actually down on the week. It's traded around 96. It ended last week around 98. Now that's a switch in contracts from the April to the May. But that's the problem crude has. It has to climb up that wall, that curve. And if you look at the December contract, which is significant because that will be the front month when we meet the midterms, it's running around $78 a barrel. So the key theme right now is it's a weekend. We have to worry about major strikes. Are we going to wake up Monday morning and see more burning oil tankers? That's a problem. But the key thing I'm fully expecting is the U.S. military forces and Israeli military forces are just going to keep pounding until we stop seeing Iran aggression.
So, Mike, you've been clear about looking at the front month contract for oil and then something like the December contract and how it's still holding relatively subdued compared to the front month. But we have seen some increase in that price as well, right? What has that looked like over time?
Well, that's a key thing to point out. I'm glad you did, Scarlett, because I look at the December contract. It just made a new high for its life. It's been around since 2017. The key thing, remember about 2017? The U.S. was a net importer around 3 million barrels a day of crude oil and liquid fuels. Now we're a net exporter around 3 million barrels a day of crude oil and exports. And the highest volume price in that almost 10 years is traded is around $53 a barrel. By the time we get to midterms, I expect to be there. Maybe even lower. Now, this is a very much of almost a replay of 2008 in a different way. But just remember, the peak in 2008, crude oil was up at the peak 53%. Right now, it's up almost 70%. So it's actually worse.
Talk to us about what's happening in the gold market here. I mean, it's just a blink ago, we were at $5,000 an ounce, and now we're down to $4,500 here. What's the play here?
Gold preempted this. Gold was the great store of value safe haven last year, and now that what's happened, you can say, oh, gold made it somehow predict this. The problem is it went up too much and it shifted from a store of value to a speculative risk asset. Right now, the volatility in gold, Paul, is 180-day volatility is more than 2 times the S&P 500. That's not a store of value. That's a speculative asset, and we're seeing the hitting of that. But I think one key thing also remember about gold is it's worried about higher rates and potentially a more secure world once the strait is cleared and secured.
Can't talk about gold without talking about Bitcoin, which some people like to call digital gold. Worth noting that gold is down in March, but Bitcoin is up about 6.5%. I know that a lot of it has to do with the big sell-off in October, but what accounts for Bitcoin's relative resilience compared to gold since the war in Iran began?
Scarlett, I'm glad you went there. One thing to remember about bear markets, they do bounce. Before this month, Bitcoin was down 5 months in a row. It went down to 60, really good support. Now it's bumping up to near 70. I think it's just a bear market that's bouncing. They're going to continue to roll over. The key thing about Bitcoin, anybody who's bullish this space, you have to have one thing in your favor, particularly the U.S. stock market going up. So I think Bitcoin's more likely to head towards 50 or lower rather than stay too much above 75. And the bottom line is, I'll end with this. The most important thing is stock market volatility, 180-day volatility, is still very low. It's almost a 10-year low. That's just an oxymoron with all this volatility going on. And I think that's just starting to pick up.
All right, Mike McGlone, I mean, if you like, I don't know, sunny and low 80s for as far as the eye can see, then you go to Miami. If that's your thing, all right, that's your thing. You can go there. Mike's, he retreated to Miami. He did the right move. He's a senior commodity strategist for Bloomberg Intelligence. He's going to enjoy the good weather down there in Miami as we continue to follow what's going on in the global commodity space. Mike is indispensable there. Then again, so gold, a little bit lower here today, but WTI and Brent are just kind of hanging in there. So we'll keep an eye on that here. But they are certainly higher. Question is, how long will they be higher? Coming up, it is Friday, so that means Munis in focus. Eric Kazatsky, Managing Director and Client Portfolio Manager at Mackay Municipal Managers. He's going to join us to give us his thoughts on the muni bond market. Jody Luria Joni Lurie, Bloomberg Intelligence Credit Analyst. We'll talk about some fun companies, cruises, casinos, theme parks, all that kind of good stuff. How are those folks doing with a challenged consumer, certainly in certain parts of this economy? She follows it from the credit side. That's coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:20 on Wall Street. We do check markets all day long here at Bloomberg. And this Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Turmoil in the Middle East sparking fresh losses across stocks and bonds. We do have the S&P 500 index down now by 0.9%, down another 60 points to 65.45, on track for another losing week. Dow Industrials down 260, a drop there of 0.6%. NASDAQ Composite Index down 294. NASDAQ is down 1.3%. The 10-year at 4.38% with a 2-year 3.92%. Gold is down $86 the ounce to $45.63, a decline of 1.9%. And West Texas Intermediate Crude 97.40 for a barrel of WTI. That is up 1.3%. Brent 109.44, barrel of Brent up by 0.7%. Again, Dow, S&P, NASDAQ all in the red. Two new developments in the fight for Janus Henderson. Trian Fund Management, Janus Henderson's largest stakeholder with a 20% stake, released an investor presentation today strongly opposing Victory Capital's unsolicited proposal to acquire Janus Henderson. Also, investment teams overseeing the vast majority of Janus Henderson Group's assets have expressed serious concerns to the company about being acquired by Victory Capital. Janus Henderson Group shares down now by 1.9%. Recapping stocks lower, S&P down 0.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellett. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Let's talk municipal bonds because, hey, it's Friday. That's what we do. We check in with Eric Kazatsky, Managing Director, Client Portfolio Manager, Mackay Municipal Managers. He's down there in Princeton, New Jersey. Eric, talk to us about kind of the performance year to date in your municipal bond market, because, boy, there's been some turmoil in financial markets over the last 3.5 weeks.
Yeah, absolutely. Good morning, and thanks for having me. Well, the last time we spoke, Paul, munis were off to their best start in probably 6 or 7 years. They delivered about 52% of 20-year average returns in the first 2 months. Obviously, March has been a much different story. We're down about 140 basis points this month. I think where the story is now going to go for munis is we went from an absolute value story to a relative value story, and we're solidly outperforming, most other areas of fixed income right now.
So what's been the impact from the geopolitical volatility, the rise in yields overall? The 2-year yield, the 10-year yield are both now at the highest since July.
Yeah, I mean, look, if you think about it from an opportunity set standpoint, investors have sort of this second bite at the apple because rates are higher. I know for the muni market, a lot of people missed out on the meaningful rally probably the last 4 or 5 months in 2025. So we now have a backup of about 25 to 30 basis points along the AAA municipal curve. On a tax-adjusted basis, those yields and those rates are looking quite interesting again.
So what have we seen? I know one of the key themes over the last couple of years and expected to even accelerate again this year in the municipal bond market is new issuance. So how's that playing out in a world where, boy, there's a war out there and there's volatility? Yeah. What's that mean?
I mean, it's seemingly unaffected, right? So right now, we're about 110 billion on the new issue side year to date. That's about a 5% year over year growth. Now, you would think that we'd probably see a drop off in some of the new supply coming onto the calendar with just the backup in rates alone. Forget about the geopolitical volatility that's going on, but we really haven't seen a lot of deals moving off the calendar, which is very, very positive. In fact, I would say, if anything, the market has been behaving pretty orderly given the backup in rates.
What do we tend to see historically in moments of geopolitical volatility and rates going haywire? Do issuers start to hold off on coming out with new supply, or do they, they have to move because they need the money?
But that's exactly right, Scarlett, right? They have financing plans in place that they've already gone from bond ballot and have approval. So there's things that are in motion. Now, look, if you were trying to do an economic refunding and all of a sudden rates really move against you, that's a totally different story. But that's just a smaller portion of our market now. So look, if we keep ticking higher, could you see some things on the margin fall off the calendar? Sure. But by far and large, like to your point, they still need the money and they still need to finance and they still get to do it in the tax exempt side of the market, which does still save them money.
So, Eric, one of the concerns, I think, in the marketplace over the last 3 to 4 weeks is perhaps this war may result in some higher inflationary pressures out there. How do municipal bonds tend to perform, I guess, in an inflation environment?
Yeah, historically speaking, they tend to outperform. And again, look, munis are an uncorrelated asset class. You want something in your portfolio that's going to really be sort of this differentiating ballast. And munis are really checking that box right now, both on the taxable muni side and the tax-exempt muni side. If we look periods of like higher inflation in the 80s and 90s, munis have actually outperformed not only corporate fixed income, but also many areas of the equity market as well. So pretty reassuring on a relative basis.
All right, Eric, thanks so much. Appreciate it. As always, that is our daily dose of the municipal bond market. And if you live in a high tax state like I do, boy, munis make a lot of sense. Eric Kozatsky, Managing Director and Client Portfolio Manager at Mackay Municipal Managers. Let's go over to the consumer side. When you think about where consumers spend money, well, for enjoyment and entertainment and all that kind of stuff, they can go take a cruise, they can go to a casino, go to a theme park, all that kind of stuff. But if the consumer may face some additional challenges going forward, what does it mean for those businesses? What does it mean for those businesses' credits out there? Jody Laurie, she's a Bloomberg Intelligence credit analyst. Jody, how do you think about some of the industries you follow? Again, kind of the cruise industry, the gaming industry, the theme park business, hotels, all that kind of stuff. What's your view of the consumer and what are your companies telling you?
So I think, Paul, there's a couple of things to tackle here. First of all, of course, there's the pressure from the Iran war, which at the end of the day, I think there's more of an echo effect event, and it's more just adding to some of the pressures that the consumer is already feeling. We've been talking about the K-shaped economy. We've been seeing some of the effects of the K-shaped economy in hotels, in theme parks, in cruise lines, in gaming, but we haven't necessarily seen a broader scale effect of this inflation pressure on the consumer when it comes to higher income consumers. And so I think that's where you're going to start seeing a little bit more of that creep in and that pullback by the consumer. But I think at the end of the day, when you look at the companies, a lot of them are really well positioned. It's only the lowest rated companies that we're concerned about, the ones that are operating on a tight sort of cushion at the moment, such as Six Flags, such as Hertz, the names that really are trying to get their balance sheets in order and trying to address fundamental issues at their companies that we're concerned about at this moment.
Right, especially when you look at the fact that traders are now betting on the possibility of a rate hike as well. Not only have they priced out rate cuts for the rest of this year, they're now looking at possibly the Fed needing to increase interest rates because of rising inflation. A rate hike would really be bad news for a lot of these weak borrowers with a lot of debt coming up, wouldn't it?
It would absolutely, Scarlett. And I think the key here, though, is that a lot of the companies have been proactive in terms of deleveraging. And so for 2026, we actually don't have that much debt outstanding for a lot of the companies that we cover. It's really as you get into 2027, 2028, when it's that prolonged sort of view, that's when you start feeling the pressure. If this is a sort of, 1 year blip or so, I don't think it's really going to affect them. I mean, we did an analysis on a company like Carnival, for example, which, they've been working their way towards investment grade ratings. They obviously are feeling the strain of something like Iran, and it's going to possibly affect booking levels for a lot of their consumers. But at the end of the day, for someone like Carnival, they've been proactively deleveraging, which is certainly a positive. And when we've looked at similar times in the past, it really hasn't affected EBITDA margins that much. Net income might be a different story, but EBITDA margins not that much, which is a little surprising for us. I think where we're sort of hesitant to feel really comfortable for a company that's unhedged on their fuel exposure is more in that secondary and tertiary effects related to something like this massive event, and also the consumer feeling pressure. By that, I mean, as consumers, if they're not spending on the scuba diving, if they're not spending on the random excursions the same way, you're not going to have that gravy of cash flow that a lot of these companies feel.
It's the first weekend of March Madness, which makes me think about sports books. And my favorite sports book in Vegas is at Caesar's Palace. It is just awesome. They take care of you there. And I noticed, Jody, that Caesar's is, I guess, there's some reports that maybe they were going to be taken private by Tillman Fertitta. What does that mean for its bonds? What does that mean for bonds of other kind of leisure companies out there?
Well, Paul, we've been a little bit concerned about some of our companies just because we're towards that tail end of a really good momentum of the past few years post-COVID. And so for someone like Caesars, while they do have change of control provision, which what that is that's a protection measure for anybody who owns their bonds to put back the bonds at 101% of par. While those bonds do have that there's reports by Wall Street Journal and others that indicate that Caesars may have found loopholes around their relationship with Vici Properties, which is the one that owns about 50% of their properties. They have a sale leaseback with Vici. So not to get into too much detail, but if they're looking at ways to skirt conversations with key counterparties, I'm a little bit concerned when it comes to creditors, particularly when you look at where the bonds are trading and they're trading so much below par. I think that's a sign that maybe perhaps whatever deal might be forming is not necessarily going to be creditor friendly. Then if you think about Caesars in general, the long history, legacy Caesars, what happened with their LBO, what happened with their restructuring. Now we have El Dorado as the management team. They're the ones who bought Caesars and took on the Caesars name. At the end of the day, though, I think a lot of investors have a hard time getting over a name that burned them in the past, feeling comfortable with this discussion going forward. We have a lot of companies within our sectors. We actually just published something yesterday on it, looking at the risk related to activist investors for a lot of our companies and what that could mean for these credits.
Jody, thank you so much. Appreciate that. Jody Lurie, Senior Credit Analyst for Bloomberg Intelligence. Scarlett, I like what Jody was saying about if you've burned the bond market or the bank market, they don't forget.
Long memories.
I'm talking 10 years, 20 years. And what she was talking about, that name does not sit well in the high yield market. That's true. I was shocked when I first learned that on Wall Street that, oh no, this guy burned me 20 years ago or 15 years ago.
I'm not doing anything with him.
Exactly. I mean, it's unbelievable.
That doesn't happen in equities.
No, I don't. I mean, you could blow up a company today, and how many times do we see it? 2 years later, you come back with another thing, and especially
you just come out with a new narrative, and everyone's all in.
But boy, those creditors, they remember.
Why do you think that is?
I think it's because it's their money, it's real money, and they have an agreement with you as a borrower to pay me back. As an equity guy, I know I'm taking equity risk. As a bond guy, I'm not taking that risk.
Right.
I have a credit agreement with you. We agree that you're going to pay me back at such and such date. And if you don't...
There are numbers, there are dates attached.
Yeah, it's really funny. So it was interesting to hear Jody use that language because, again, in the world of fixed income and credit, boy, they have long memories there. So you got to be... That's why a lot of these companies, they'll do anything to stay right with their creditors because they can be shut off the market for them for a long time. S&P off 55 points, 0.8%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower, Middle East hostilities showing no signs of a let-up, sparking fresh losses across stocks and bonds. Oil higher. S&P right now down 57 at 65.48. That is a drop of 0.9%. The Dow down 270 now, down 0.6%. Nasdaq down 278 for the Nasdaq Composite Index, a drop of 1.3%. The VIX very close now to 26, moving higher. The 10-year 4.37%, but the 2-year 3.91%. Gold, spot gold 45.60.